Trade like Warren Buffett. James Altucher Chapter 1. Does Warren Buffett trade? My favorite holding period is forever. Warren Buffett first. I have to apologize in advance. This book barely mentions Coca-Cola or the Washington Post. I also don't really talk about the many fine companies that Berkshire Hathaway has bought over the past 3 decades. See's Candies, The Pampered Chef, Dairy Queen, National Furniture Mart, and others. There are many excellent books that cover these topics, and while Warren Buffett has made billions of dollars from these investments, I don't think I can add to the already great dialogue
that has taken place on these topics. Nor is this book really about value investing. There are many definitions of value investing and many treatises on value versus growth. But
even Buffett has stated that on the whole, the distinctions between value and growth are nonsense. This book is about the various ways that Buffett
has applied the concept of margin of safety outside of his buy and hold strategies. He has had a longer and more diverse investment career than
just about anybody. There are several people in the world, fewer than 10 actually, who have had more years' experience than Buffett at picking stocks, but I can think of no one who has traded and invested with a more diverse group of strategies over the past 50 years. It is these strategies that I write about. Many of them are normally thought of as trading straight geese instead of the buy and hold investing for which Buffett is famous. When I went to the Berkshire Hathaway annual meeting in 2003, I had no idea what I would encounter. I met one man who bought 200 shares of
Berkshire Hathaway in 1976 for $15,000, give or take. He sold half of those
shares a year later for a solid double. Who can blame him? And today the remaining shares are worth over $9 million. He now hangs out skiing in Tahoe for most of the year. I asked him why he had bought those shares, and he said that he had heard of Warren Buffett while growing up in the same town as him, had heard he was smart, and liked the insurance industry. One can argue that this man I had spoken to was an incredible investor. He had turned $15,000 into $9 million over the course of 25 years, a 50,000% return. Not everyone at the meeting was as lucky. Most of the people at the
meeting were fairly recent owners of their shares and were either mildly up
on their investment or flat. At the time of this writing, Berkshire Hathaway is close to making an all-time high, so hopefully most of these people have held onto their shares. Throughout the meeting I asked people why they were there. After all, it was the most popular annual meeting in the company's history, with approximately 15,000 people in attendance. Some PAO PLE were there because they just wanted to see Warren Buffett. What
zeitgeist had he been tuned into all his life that he could start with $100 and
compounded into $40 billion, while at the same time maintaining his home spun humility and simple lifestyle? He still lives in the same house he bought
40 years ago for $30,000. Buffett supposedly found these incredible deals through the principles
of value investing. Again, there are many good books out there about value investing that try to explain Buffett's value approach. Point 1 at the end of this one. The most famous of the books is Robert G. Hagstrom's The Warren Buffett Way.
Investment Strategies of the World's Greatest Investor. Others include How to Pick
Stocks Like Warren Buffett, Profiting from the Bargain Hunting Strategies of The World's Greatest Value Investor by Timothy Vick, and How to Think Like Ben Graham and Invest Like Warren Buffett by Lawrence Cunningham. All of these are
good books that focus on investing in companies with solid management, good core, great governance, high return on equity, a good brand, and so on.
Does Warren Buffett Trade? Book. I try to provide a comprehensive suggested reading list of the major books written about Buffett. However, Buffett achieved much of his early success from arbitrage
techniques, short-term trading, liquidations, and so on rather than using the
techniques that he became famous for with stocks like Coca-Cola or Capital Cities. In the latter stages of his career, he was able to successfully diversify his portfolio using fixed income arbitrage, currencies, commodities, and other techniques. And further, in his personal portfolio he tended to stick to
the style of deep value investing that marked his early hedge fund years.
This book is titled Trade Like Warren Buffett, and the phrase alone brings up several contradictions in the traditional mythos about Buffett. First, Warren Buffett supposedly does not trade. He finds an undervalued gem, then buys and holds onto it forever. After all, it takes 1,000,000 years
to turn a piece of coal into a diamond, and a good company should always
bear that in mind. For example, Buffett bought Gillette in the 1980s and, to his credit, many multiples later, he still holds onto it. After all, people will
always shave, so the demographic for Gillette is approximately 3 billion
citizens of this planet. How can you go wrong holding this stock forever? Exhibit 1.1 represents the holding period of some of the Berkshire Hathaway trades that Buffett held for less than 5 years. Second, the world of trading usually evokes images of day traders,
fingers on the trigger, ready to scalp stocks for a few ticks several dozen times
a day. Seldom do people think of Warren Buffett, known for holding onto stocks for years, when the subject of day trading comes up. However, the texture of value investing now is very different than when
Warren Buffett was making his early profits, let alone when Benjamin Graham and David Dodd wrote their classic text security analysis. Back
then, there was only a limited set of eyes that had the access to information. Not to mention the desire to locate companies that fit a certain deep value criterion. But today, if I want to sift through 6,000 stocks to find some that fit specific earnings, return on equity, P/E, price over earnings ratio, and other criteria, then I can easily do so with any number of stock screeners online. And, believe me, countless value investors are doing just that. The information arbitrage that existed in the 1960s and earlier
is nearly non-existent today. Buffett would spend hours going through Moody's reports on each stock, sifting for the gold among the dirt. And, after spending hundreds of hours
doing that, an activity that might now take 1 hour, tops, he would have to then figure out how to actually buy the shares he wanted. For instance, when
Buffett was trying to buy shares of Debster Mining, he had to drive to the
town where they were based and convince locals to sell their shares to him. There was no liquid market out there like there is now, so when he bought the shares, he had to hold them for longer than he might have wanted to.
So, value investing the way Buffett and Graham practiced it no longer
exists today. There are thousands of mutual funds and hedge funds competing for those arbitrage opportunities, not to mention retail investors with access to the Internet. During Buffett's hedge fund years, between 1957 and 1969, there were Some years in which more than half his profits came from what he called
workouts, special situations, merger arbitrage opportunities, spin-offs,
distressed debt opportunities, and so on. Playing with semantics, we can argue that all of those opportunities represented value, that is, buying something that is cheaper than what it was worth, whether it was a spread between two securities, a distressed bond, or a stub stock that everyone ignored. However, these situations are not usually described as value investing. Instead, over the past 2 decades we have seen Buffett dip his investing prowess into commodities, his foray into silver in 1997, fixed income
arbitrage, many instances of distressed debt through the use of private
investment in public equity, PIPE, vehicles, merger arbitrage, relative value arbitrage, and so on. In addition, Buffett has made his first forays
into technology investing, owning over the past few years a number of
shares in telecommunication services company Level 3 and the debt of e-commerce company Amazon. The latter is a company that had never produced a dime of earnings when Buffett first invested in it, let alone an
easy means by which someone could compute future cash flows.
There are 3 stages to Buffett's investment career, and we will focus on techniques used inside each of those phases. The early years, Buffett's hedge fund years, were when he built his fortune from essentially nothing to about $25 million at the time he was interviewed by Adam Smith for his 1971 classic, Super Money. During this time Buffett had 3
techniques. 1. The cigar butt technique, into which category Berkshire Hathaway, in
its original form, fell. This meant buying stocks that were selling for less than tangible assets. Buffett would sometimes accumulate enough shares that eventually a change of control would occur, giving him
direct power over how the assets of the company would be disposed.
2. Value investing, but combined with some of his partner Charlie Munger's ideas on growth and the potential of brands. This resulted in Buffett's American Express play, among others. 3. Special arbitrage situations, workouts, distressed debt, merger arbitrage, spin-offs, and so on. The middle years.
The 1970s and 1980s were the decades when Buffett made the full transition
from successful hedge fund manager to operator, asset allocator, and insurance company magnate. Why the insurance business? And why did he leave the hedge fund business? We know now in retrospect that he was a very good market timer, although prone to being early, just as Bernard Baruch said, "I always sold too soon." So it could be argued that Buffett's departure from the hedge fund business right before an essentially flat decade was a sign of good market timing. However, I don't believe this.
I believe that Buffett did anticipate a potentially horrendous decade for stock market returns, and in fact, 1973–74 was the worst downturn since
the 1930s. But I don't think that Buffett would have stopped his hedge fund for fear of poor market returns. Rather, he was always more enthusiastic in
his annual letters to his partnership investors when the market was doing
its poorest. He prided himself more on outperformance than absolute performance. A return of 20% in a year when the market was up 30% would have been a disaster for him. Far better would be to
return 5%, with the market returning -20% for the year. So,
the fact that the market was about to make a strong downturn would not have been the impetus to cause him to wind down his hedge fund and go into the insurance business. Rather, I think he saw an opportunity unlike any he had encountered in
the past and he wanted to pounce on it. The way Buffett's partnership was structured, he took a 0% management fee and 25% of all professor.
It's. As an example, if his fund had $5 million in it and he returned 20%, or $1 million, for his investors, then he would take 25% of that, or $250,000 of that, as his fee. However, an insurance company is much more attractive to a master asset allocator like Buffett. An insurance company works like a hedge fund. Except Buffett gets to keep 100% of the profits. People invest their money when they pay their premiums and only get to take their money out again upon illness or disaster. In a well-run insurance business, the cost of float is ideally zero. That is, you spend no more in payouts than you take in
premium. In this way, all profits go to the owners of the business. If the cost
of float is zero, then the economics of the insurance business are much better than the economics of a hedge fund. Rather than retire to a lifetime of bridge playing, Buffett ended up
buying for $40 per share most of the Berkshire Hathaway shares that he had
originally bought for his investors, profitably for them at prices ranging from $7 to $16 per share, then, while Buffett used Berkshire as his base. The rest of the 1970s became a roll-up of insurance companies, regional
banks, and other cash-producing assets ranging from the Nebraska fur Nature Mart to See's Candies. It was during this period that he became less focused on his workout
plays and more focused on his control plays like the insurance companies, furniture companies, and chocolate companies he was buying in his generals, the big value plays like Coca-Cola and Gillette that ultimately created billions of dollars in investment profits for Berkshire. There is no one way to sum up Buffett's investment style during this period. Early on, he was certainly interested in buying companies for less
than their book value. The Washington Post is a great example, where he
began accumulating shares at a fraction of their liquidation value later on. However, particularly in the 1980s, his methods were much less quantitative and bordered on highly subjective. A case in point is Coca-Cola, which Buffett began accumulating in 1988. He ultimately became the largest share
holder. Coke was trading at 13 times earnings, hardly a discount to the
market at that time, which was trading around 10 times forward earnings. That said, Buffett was convinced, and he was right, that Coke was trading at a huge discount based on the future earnings of the company.
The middle years, or perhaps the least interesting period for me. However, this period, the 1970s and 1980s, is the subject of countless
books on Buffett. Hagstrom's book The Warren Buffett Way too set the tone and documents Buffett's stock picks during this period. To The Warren Buffett Way, Robert Hagstrom, Wiley, 1993.
I repeat the following refrain throughout the book: it is not possible
to trade exactly like Warren Buffett. The goal is to use whatever means possible to approximate his trading by attempting to quantify the term margin of safety. The later years, the 1990s and then the 2000s, created an interesting dilemma for Buffett. One that no other company has ever faced. He simply had too much cash to put to work. As much as he loved finding quality companies and stocks, the World was just too small for him at this point. In lectures that he occasionally gave to college students, he would often sentimentally reflect that if he
had less money he could still return 50% a year in arbitrage situations. But with $50 billion to put to work, this was just impossible. Nor is it.
Chapter 3 Equities. Warren Buffett has repeatedly stated that when he buys shares of a company, he thinks of himself as an owner of that business, rather than as someone who simply wants to flip those shares for a small profit, i.e., a trader. As stated in Chapter 1, there are many occasions where Buffett does take a rather short-term, less-than-forever view of a stock, and he occasionally takes short-term profits or losses. However, that does not diminish the deeper sentiment expressed in his statement that you should not buy a stock unless you can put yourself in the shoes of an owner of that business and be able to say, this business is going to generate a return worthy of my investment. The best example is that of the old-fashioned lemonade stand. When you set up a lemonade stand, you outlay some cash for the table, cups, the first batch of lemonade, and maybe the sign that you put up the street pointing people in your direction. Whether or not your initial outlay of cash was a good investment is directly related to whether this lemonade stand is a good business. Several factors play a role. For each dollar you put into the business, will you expect to eventually make that dollar back plus additional money, the return on your investment? Could you have taken the same money and had a better investment elsewhere, either in setting up another business or simply putting the money in a savings account? A corollary to this is that a better investment can also mean an investment with a similar return but less risk. As simplistic as it sounds, this is how Warren Buffett evaluates all his stock buying and selling decisions. He doesn't do anything based on sophisticated technical analysis, volume indicators, chaos theory, or neural networks. However, the reason it is hard to get high stock market returns is that for a somewhat complicated business, the predictability of what the business is going to earn, and what other alternative investments are going to earn, is very complicated. At this point, most investors snap their fingers and say, aha, let's break out the dividend discount model. A business should be valued on the basis of its total cash flows from here to eternity, discounted by whatever the risk-free rate is. Why the discount? Well, assume that your business can earn 5% a year forever and that I can get a 5% return forever from treasury bills. Your business is essentially worthless, then, since as long as the US government is here to stay, putting my money in T-bills will be a better choice for me than putting it in a risk-filled business. Example. My story. My own example of the dividend discount model coming into play
occurred in early 2000. I had started a wireless software company.
And at the time, wireless was a favorite buzzword among investors. Despite the fact that we had minimal revenues and were burning money at a fairly quick rate, we were, after all, a startup company. We were already being wined and dined by every investment bank in analyst. On one occasion, a group came in from a Tier 1 investment bank to pitch us. The head of the group started off by saying that Mr. X, a well-known analyst now barred from the securities industry, would cover our stock despite the fact that we were a wireless software company and he was an e-commerce consumer analyst. Then came the fun part. Valuation. The junior member of the team broke out his dividend discount model. Apparently we were going to stop losing money within a year. Thank God. And then start growing earnings per share at a rate of 25% a year compared with a risk-free rate of 9%. That
miraculous growth, about as miraculous as miracle hair growth cures from carnivals of the 1920s, would continue for 10 years, why not?
And then slow down to a more terminal growth rate of 10%. It all
sounded good, but the reality never quite matched the pretty picture. This analyst created, although fortunately the company still exists, as
compared with most of its peers. So the question is, if the intrinsic value of a business can be determined by its future cash flows, then how can we improve the predictability of
those cash flows? Note that if investors could truly predict cash flows, then
Warren Buffett would never have been able to achieve his above-average market returns. The key is not only to find companies where the cash flows are somewhat predictable but also to find companies where, for whatever
reason, the market perceives those cash flows as being at risk. The more risk the market perceives in those cash flows, or the more unpredictable
those cash flows are, the higher return an investor must demand to compensate for that risk. For example, American Express in 1963 fell victim to the notorious salad oil scandal. Anthony DeAngelis, a New Jersey meatpacker who started a company called Allied Crude Vegetable Oil Refining, was sending supposed shipments of vegetable oil to a warehouse in Bayonne, New Jersey,
which then issued receipts for the oil. With those receipts, DeAngelis was able to obtain up to $175 million in financing, on the basis of $60 million
worth of vegetable oil as collateral, and then use that money to speculate on vegetable oil futures. The whole thing fell apart, as these things usually do, when DeAngelis lost it all on his speculation and had to go bankrupt. The company that vouched for the warehouse receipts and
allowed DeAngelis to obtain his financing was American Express.
When American Express did an audit to collect their collateral, they found that instead of $60 million worth of vegetable oil there was only $6 million. The vegetable oil had been watered down to make it appear as if there were more. To their credit, American Express very quickly made good on the hundreds of millions of dollars in potential liabilities, but this also created a very big black hole on their balance sheet, temporarily wiping
out all shareholder equity. Shares in American Express fell from $60 to $35 over a 2-month
period. Shareholders and speculators were both playing a momentum game. If it can fall $2 today, it will probably fall $2 tomorrow, and some had legit fears that American Express was going bankrupt. To some extent, these fears were not entirely irrational. If American Express management was lax enough to let this scandal happen, who knows what other problems might lie underneath? First, however, Buffett was comforted by management's instant and honest response to the losses, taking the hit, and indemnifying many of the third-party victims to the scandal. Second, Buffett recognized that this scandal had nothing to do with
American Express's core businesses, the traveler's checks and credit
card businesses. Third, Buffett is always impressed by businesses where a large float can provide liquidity to the underlying operations of the business, as in, for instance, the insurance business. The traveler's checks business involves Consumers paying cash up front to American Express. American Express
pays out that money at some future unspecified date. In the meantime,
American Express can do whatever it wants with customers' money. This idea of a float-based business is almost like getting a zero-interest loan. Eventually, American Express has to pay all the money back, but with no interest charges attached. The cost of financing doesn't get any better than this, at least until the 2003 Squares bonds that Buffett himself put out, the first negative interest bonds in history. Finally, Buffett wanted to see what the consumer perception was of American Express's problems. He went out to Ross's Steakhouse in Omaha,
stood behind the cashier all evening, and watched as customer after
customer used their American Express cards to pay for their meals. He was able to conclude two things. 1. The American Express brand was not affected at all by the scandal. In fact, it was stronger than ever. This idea of brand strength was used by Buffett repeatedly, starting with this incident, over the next 40 years as
a gut predictor of future earnings. 2. It was clear that the merchants were not worried about being paid by
American Express. In other words, the salad oil scandal was a one-time
hit against earnings, but the underlying business was strong and
getting stronger. Buffett started accumulating shares at $35 a piece and sold them. Between 2 and 4 years later, 5 years after the incident, American Express shares were trading as high as $185 a share. Note that this was not a long-term buy and hold, forever investment for Warren Buffett, even though it had many of the characteristics of his buy and hold investments. Later on, strong brand, predictable earnings, strong moat, and so on. But at this point, the cash Buffett had to put to use, which consisted of the money in his hedge fund, was a lot smaller and allowed him to be more nimble. Taking advantage of this nimbleness in a way that he can no longer do
to his enormous size allowed him to go in and out of trades as needed,
ing profits and moving on to the next opportunity. What created the phenomenal trading opportunities and excesses of the dot-com era from 1997 to 2000 was directly related to the notion of intrinsic value. Basically, people had no idea what these companies would make. However, it was clear that the Internet was a revolution on par with the printing press. Suddenly, the cost of commerce got much cheaper. PAO could shop from their homes, implying that the bricks and mortar approach of setting up stores everywhere, and the costs inherent with that kind of business, were not necessary for the winners in the Internet
commerce gain. Additionally, the Internet also decreased the costs of
communication as well as the costs of software development, since network
protocols and interfaces were built into the underlying ideas of the web. With all of the costs out of the picture and a potential customer base in
the billions, the earnings created would be phenomenal, and so would the returns, if it were possible to pick the winners. The idea that the Internet was a bubble is often implied by Buffett ADHER.
Hence, but not necessarily by Buffett himself. He simply states that he had a
hard time valuing these companies simply because he was not a computer expert. He had no way of determining what the future cash flows of these companies would be or which companies would be the winners. Nor does Buffett take a VC-style approach to his investing. Buffett likes to make as few bets as possible. With luck, every bet pays off. a typical venture capitalist portfolio might have 20 investments, with 10 failures, 8 break-even investments, and 2 home runs. What happened in the so-called Internet bubble is that the public became venture capitalists instead of value investors. Many
of the companies did turn out to be worthless. But the basic idea was correct.
There were enormous opportunities in the Internet space, as evidenced by eBay's earnings just a few years after its inception. See Exhibit 3.1. Never have a company's profits grown this quickly so soon after its
birth. Does this mean that all of the Internet speculators were correct and Buffett was wrong? Absolutely not. It is just a different approach. And the
eBays of the world happened once in a lifetime. Buffett's results, however, have stood the test of time over a 50-year period. I was always very surprised with all of the investors who consistently turned up their noses at the
Internet and refused to even acknowledge that the potential was there.
Even in the summer of 2003, Barron's had a cover article suggesting that
perhaps Yahoo, Amazon, and eBay were in another bubble. The magazine
picked the exact companies that would end up doubling their earnings
growth yet again over the next year. That said, Buffett likes to keep it simple. He looks for earnings
predictability with companies that might be distressed but whose quality of business still remains high. Why might investors, Mr. Market, be putting more risk on the future earnings flow than Buffett? Here are a few reasons.
Market risk. In recent years, the market has become fearful that a
future terrorist attack might slow down the U.S. economy and put pressure on even predictable earnings streams, as detailed in Chapter 12. Buffett does not care so much for market or systemic risk, assuming that there is no real event that can so drastically change the value of all securities in the market that he worry too much. Fear of corruption. When the Enron scandal broke in late 2001, the shares of many energy companies, even the most conservative utilities, fell in sympathy despite the enormous predictability of those earnings. In Chapter 7, we will see how Buffett took advantage of this market fear to place a private investment in a public utility. Litigation risk. In the tobacco industry, the market and earnings have always been predictable, but the fear of mass class action litigation has often kept the price lower than would be suggested by any measure of intrinsic value. Setback in the business. When mad cow disease surfaced in England, shares of McDonald's reacted, reaching multi-year lows. Investors had to assess whether this would have a permanent effect on the business. If the answer was no, then the assumption would be that the shares would go back to where they were before the stock started to fall, about a 50% return. If the answer was yes, then one had to assess how far the stock had yet to fall. If the stock had another 10% to go, but you felt there was more than a 20% chance that the market had already discounted enough the effects of mad cow disease, then the buying was certainly worth it. The risks of investing go on and, in each specific case, are usually fairly straightforward. When a market or stock starts to sell off, there are usually countless news articles, internet message board postings, and television
commentators documenting the rise and fall of once proud companies. The
Internet has closed the information gap and has made it possible to quickly assess the veracity of any story quickly. Similarly, very standard tools can be used to examine the predictability of future cash flows. Note that we are talking about future cash flows and not necessarily price, earnings, P/E ratios. In Chapter 11 I discuss the pros and cons of trading based on P/E ratios, but this section necessitates a few comments. First, the P/E ratio refers to the price the stock is currently trading at, divided by its net income per share. For instance, if a stock trades at $20, has 30 million shares outstanding, and earned $30 million last year, then it trades at a P/E ratio of $20 times $30 million divided by 30 million shares outstanding, or 20. Many people also look at the earnings yield, which is sim. Apply the P/E ratio upside down, or EP. In the above example, the earnings yield would be 5%. The earnings yield is what the company could potentially pay out to shareholders if it did not reinvest its earnings in the business. If the earnings yield of a given stock is much higher than Treasury
bill interest rates, that is, if the P/E ratio is low, then many investors think
that the stock constitutes a good investment. We'll look at this later in Chapter 12. Note that the E in this equation might not be real earnings at all, but a modified definition of earnings, which might include various non-cash charges such as depreciations, amortization of goodwill, and, should a company do this, options-related expenses. Also, for each company, the method for booking revenues varies significantly and is often an issue. The same can be said for how expenses are booked. For example, can a marketing expense
be amortized, as WorldCom tried to do to the tune of billions of dollars? AOL
was notorious for doing this throughout the 1990s, but it didn't slow down the rise in their stock price. WorldCom, however, almost instantly went
bankrupt when their accounting discrepancies were exposed.
P/E ratios also do not tell you anything about the predictability of future earnings, the quality of current earnings, or the fundamentals of the business. Nor do we have any reason to believe that Warren Buffett looks at the P/E ratio. In fact, many of his acquisitions are occurring precisely when earnings are falling and the P/E ratio is skyrocketing higher. In Chapter
11, I take the analysis one step further and examine whether P/E ratios
are truly predictive of the future. What tools can be used, then, in helping predict future cash flows? Growth of the U.S. economy. In general, if the U.S. economy grows at a certain percent a year, then the cash flows of the market are most
likely growing at the same rate, give or take 1 to 5%. The
market has grown slightly faster than the economy only because the multiple over those cash flows has grown slightly over the years. If stocks go up much faster than the U.S. economy, as happened in the 1990s when the gross domestic product, GDP, was growing at approximately at least 6% a year and the Nasdaq was going up almost 30% a year, bad things can eventually happen. Operating margin, return on equity, ROE, or return on capital,
ROC. A study by John Schmitz and Sean Cleary on what fundamental criteria have been the most predictive for stocks on the Toronto
Stock Exchange from 1989 to 1998 determined that return on equity and operating margin were consistently among the top factors for
every time period. The higher the ROE and operating margin, the more
likely a stock would go up in the next period. Return on equity is defined as the net profits of a firm divided by the Total amount of equity invested in a firm. In our lemonade stand example, if someone started with $15, $10 for the table, $3 for the first set of cups, and
$2 for the first batch of lemonade, and earned $10 in the first day, then the
ROE would be 66%. If the stand's owner has a high operating margin, gross profit over sales, then he or she would presumably need to reinvest relatively little of the profits in order to sustain the current level of profitability. Companies with a high fixed asset base, where assets are depreciating
and occasionally need to be replenished, will suffer severely if the
operating margin is hurt for any reason or if the business slows in general. Does this mean Buffett simply does a screen on all public equities and buys companies with high ROEs and high operating margins? Absolutely
not. In some cases, Buffett bought companies that were experiencing declining earnings. The Washington Post is a good example, but Buffett believed
in management and in the industry. In one case, Coca-Cola, Buffett bought a business that had suffered in the past. He wanted to capitalize on the
turnaround despite the fact that the business was neither cheap, nor was
there necessarily a catalyst that was going to drive up the stock price. In another case, Geico, Buffett bought into a business that to all outward appearances was completely falling apart, but he had a belief in the underlying fundamentals of both the business and the industry. The lesson we can take from all this is that there is no one formula for success. Chapter 4. Current holdings. This chapter provides a list of Buffett's current known holdings, along automatic data processing symbol ADP, NYSE, date purchased, 2003.
ADP is the world's largest provider of outsourced payroll processing
services. Despite 10 years of steady revenue and earnings increases, the stock dipped in 2002–2003 during the general market decline. Buffett and/or Berkshire Hathaway started to accumulate the shares. He played it for the small dip and subsequent rise, and then got rid of the shares in the first half of 2004. Dover Corporation. Symbol DOV, NYSE. Date purchased, 2001. Dover is a modern, behind-the-scenes conglomerate. Rarely mentioned in the media, it makes everything from gasoline pump nozzles to automated printed circuit board assemblers to tractor-trailers. They have shown consistent
revenue and earnings increases throughout the 1990s, both
internally and through acquisitions. Buffett bought shares in the first quarter of 2001 and kept adding to his position until early 2003, approximately around the time that the stock bottomed. Paul Tudor Jones, one of the greatest traders ever, once stated, "Losers average losers. I think it is more a matter of to each his own." Buffett clearly likes to buy good companies that are going through hard times and then average down as the stocks become cheaper. With Dover, Buffett had a company with so many years of consistent
growth and earnings that he was confident, once the recession of
2001–2002 was over, that it would return to its old form. As of the end of 2003, when Buffett started selling his shares, Dover's book value was the highest it had ever been, even after the dip of 2002.
American Express. Symbol AXP, NYSE. Date purchased, 1991.
American Express is the world's largest issuer of charge cards and travelers' checks. They also provide other financial services such as financial planning. investment advisory services, insurance, annuities, mutual funds, and so on.
American Standard symbol. ASD NYSE, another mega conglomerate in Buffett's holdings, American Standard. Makes products ranging from kitchen equipment to air conditioning
systems to bathroom fixtures. When Buffett was rolling up furniture painties and carpet companies, he was also probably assuming that the
housing bust would lead to more purchases in American Standard's domain. He first purchased American Standard stock in 2002.
H&R Block. Symbol. HRB, NYSE, date purchased, 2001. Death and taxes are here to stay, but I would add to that by saying, death,
taxes, and shaving. The purchase of H&R Block stock beginning in 2001
reminds me of another, larger Berkshire holding with Gillette. Every day. 1 billion people or more around the world are shaving. Similarly, every year, hundreds of millions of people pay taxes, and H&R Block has the
intangible brand that people know they can trust for cheap, easy, and
money-saving tax advice. The stock dipped in 2000 along with the general market. Buffett, realizing that the fundamentals of the business had not changed at all but that the market was suddenly giving away stock at a
cheaper price, began to buy Coca-Cola. Symbol. CO. NYSE. Date
purchased. 1988. What can be said about this investment that hasn't already been said? Robert Hagstrom's summary of this investment, which appears in the Warren Buffett Way, 1 is excellent. Despite the steady and consistent revenues,
earnings, and row of the 1990s, this was initially a turnaround play that
Buffett bought at the tail end of the turnaround. In the 1970s, Coca-Cola was trying out new businesses from clothes to movies. Then, in the mid-1980s, the installation of CEO Roberto Goizueta got the company back on track. It was definitely not a Graham-Dodd play in the classic sense,
whereby a company is bought for less than its net tangible assets. However,
this is where the influence of Charlie Munger played a role. Buffett made an
estimation of how to value the intangible of Coca-Cola's brand name. In effect, he was still trying to go the Graham-Dodd route but adding the intangible value of the brand name to the net tangible assets. How is it possible
to determine the value of a brand name? To some extent, it can be done by looking at return on equity. The beauty of capitalism is that money doesn't grow on trees. If there
were such a tree, then everyone would instantly converge on that tree and
pick all the money off until it were bare. High return on equity businesses are equivalent to such fictional trees. Capitalism kicks in by profit. Current holdings 57. The Warren Buffett Way, Robert Hagstrom, John Wiley & Sons, Inc., 1993.
In competition until the row decreases in response as margins go down. The
mythology of the brand is what keeps entrepreneurs and potential competitors at bay and forces them to look toward other businesses and industries. Interestingly, the rise of water as a marketable product, paying $5 a gallon for what you can get for free from your tap, is probably what has
slowed Coke down a bit around the world. Buffett has repeatedly said that
this is one of his permanent holdings, and at 34% ROE, it is not a bad place to keep the billions Buffett has here, but he hasn't added to his position in
a while. My guess is that he won't in the near future.
Costco Wholesale. Symbol. COST, NASDAQ, date purchased, 2000. Buffett has always said that one of his biggest mistakes was not buying Walmart. He thought the price was too high when he looked in the 1970s. And kept waiting for the dip that never happened, when Munger and Kerr aged Buffett to look at the Costco model. Munger is on the board of
Costco. Buffett may have seen it as his second chance. Munger has always been a fan of the Costco model and said so at the Berkshire Hathaway 1999 annual meeting. "I'm such an admirer of the Costco culture and the Costco
system that I'm not sure I'm totally rational. I love the place. That isn't so bad in life, to find a couple of things you love." Costco is a great example of how Buffett approaches a stock purchase. He doesn't simply say, "This is a great company. I need to buy it." Buffett likes to play the mean reversion game. When bad news affects a stock, people have a tendency to react in a strong fashion, and that reaction usually turns into an overreaction. When Costco missed analysts' earnings estimates by a penny on May 24, 2000, the stock fell 22%. At that point, Buffett must have examined the news and asked himself, "Are people rationally selling this stock, or is this news serious?" Perhaps Costco was growing too fast. Or maybe the margins were starting to get hit by increased competition from ex-Buffett mistake Sam's Club, owned by Walmart.
We don't know for sure what Buffett looked at between May 24, 2000, when the shares sold off, and September 30, 2000, by which point he had
accumulated 24 million shares of the company, but presumably he wanted to see that the high-margin items, pharmacy, one-hour photo centers, Opti, Cal, were still doing well. He probably wanted to make sure that management
was still just as tight on their cost controls as they had always been.
He definitely would have examined their inventory turnover to make sure they were still selling goods as quickly as before. Once he found a comfort level that the general market was being too aggressive on the sell side, he began buying. Although we don't know his average cost, it was probably
somewhat near where it was after the 2000 sell-off, in the low $30s.
Currently the stock is slightly above $40. First Data Corporation. Symbol FDC, NYSE. Date purchased 2002. First Data Corp. Does credit card transaction processing for over 3 million
merchants around the world. First Data also owns Western Union. Steady
revenue growth in the 1990s was not enough to fight off the market contraction that occurred in mid-1998, and Buffett began to buy. He bought more in late 2002 when the stock dipped despite increases in revenues,
earnings, and return on equity. Gannett Co. Inc.
Symbol GCI, NYSE. Date purchased 1994. Gannett is the publisher of USA Today and others news publications. This is another of Buffett's permanent holdings, and there are countless case studies of the investment, including ones in Robert Hagstrom's books, Mary
Buffett's books, and of course, Andy Kilpatrick's of Permanent Value. Gap Incorporated. Symbol GPS NYSE. Date purchased 2000. The
Gap started having trouble in 2000 when decreased consumer spending, heavy expansion costs, and lower margins started affecting both
It's and the stock price. The company had been making record revenues, profits, and increases in same-store sales right up until 2000–2001. The fact
that they had had a non-record-breaking year shouldn't be considered Earth-shattering, and yet that is exactly how the market treated it. Buffett was perhaps impressed by its prior consistency and assumed that the
strength of its brand, backed up by its prior high row, would help the
company stage a comeback. It proceeded to do exactly that by 2003 when its margins and row doubled and the book value reached a record high. Buffett began accumulating in 2000, continued his accumulation all through 2001 when the gap was going through the worst of its troubles, and finally began selling in late 2003 when the shares began to rebound. Gillette Company symbol GNYSE, date purchased, 1989. As will be covered more extensively in Chapter 7 on pipes, Buffett initially bought Gillette as a convertible preferred issue directly from the company. Where he was being paid a 9% coupon, he later converted his holdings into common equity and has held for the duration. HCAINC symbol HCA, NYSE, date purchased, 2003. HCA is a hospital chain based in Nashville, Tennessee, owning almost 200
hospitals and over 80 surgery centers. When Berkshire's Geico unit, where
the investment decisions are made by Lou Simpson, Buffett's current number 2 on the investment side of Berkshire Hathaway, began buying up shares of
HCA in 2003, the hospital chain had just reported a 31% decline in profits.
Again, Berkshire rarely buys companies where the earnings are 100% consistent. No company, unless it is managing its earnings, is consistent forever. However, the market always makes the assumption that companies should and will have consistent earnings. Buffett, Simpson, Munger, Berkshire, and Geico all wait for the usual earnings shortfall, the typical market overreaction. See the straight line in the HCA chart that occurred in mid-2003, then they begin buying after thorough due diligence. In this case, the due diligence had to examine what had caused the earnings shortfall. Would it occur again? Specifically, in mid-2003, the company announced that the information system it had put together for the purpose of keeping track of its account receivables was not working too well. They dropped the system, taking a charge of $130 million, or 15 cents per share. They also increased their reserves for questionable receivables by $106 million, or 13 cents per share. One factor that helped Buffett in his due diligence was that HCA had been in an accounting scandal before and had only a year earlier settled with the Department of Justice involving claims that they had overcharged the Medicare system. Part of the settlement involved the company's hiring auditing firms to conduct regular company-wide audits. The scandal also brought back prior CEO Tom Frist and his second-in-command, now CEO
Jack Bovend, who helped restore corporate governance and fiscal sanity
to the company. With all of these eggs lined up, Simpson was probably confident that the write-offs were truly one-time events and that the company would get back on track, becoming profitable again. Iron Mountain Inc symbol IRM, NYSE, date purchased, 2001. Buffett began buying up shares of Iron Mountain, the nation's largest document storage company, in late 2001, accumulating the bulk of his holdings in Q3 of 2002. This is another company that was consistently losing money, but still had a strong enough model that Buffett decided to buy during its Growth phase. The company bought over 110 other companies involved in
the same business. That, plus building new facilities for storage, kept
earnings down but at the same time increased the company's moat over the competition. Once you have hundreds of thousands of your company's documents stored at an Iron Mountain facility, it is unlikely you are going to switch vendors. And with the complete accounting busts of Enron, WorldCom, Global Crossing, Tyco, and others in the 2001 and 2002 document, storage became more important than ever. Buffett began reducing his shares in 2003. Iron Mountain exemplifies the fact that debt, by itself, is not a bad thing, although it is usually considered so by many value investors. The very same value investors that are eager to see companies buy back shares and pay high dividends are usually loath to buy companies saddled with heavy debt. However, debt can be thought of as a type of equity whereby the company is forced to do a share buyback. An interest rate payment, that buyback can be more easily predicted than
the normal share buyback. The end goal is that the debt gets reduced to
zero, making the enterprise value per share that much higher than it was initially, even though no dividends have been paid or real shares bought back. Debt is only a negative when it is used to buy growth and earnings to hide the fact that the organic business and model is faulty. For instance, WCOM
used debt to fuel acquisitions that, in turn, hid the fact that the core company
was not making any money. When WorldCom failed to buy Sprint, the jig was up and the only way to hide the lack of earnings was through massive accounting fraud. Because the addition of debt makes due diligence that much harder. And also, any debt at all always increases the risk of bankruptcy during hard
times. Value investors tend to shy away from companies with debt. It is important to note, however, that Buffett doesn't avoid these companies, provided that all the other characteristics of the business are positive. M&T Bank Corporation. Symbol MTB NYSE. Date purchased 1991. In the early 1990s, Buffett began scooping up banks when the banking industry was going through one of its worst periods ever. Buffett had been buying
banks since the 1960s, and if there was any business other than insurance that he could be said to know well, it is certainly the banking industry. Buffett was familiar with M&T Bank, based in Buffalo, New York, by virtue of his ownership stake in the Buffalo News. In fact, it was news publisher Stan Lipsey who introduced Buffett to Robert Wilmers, the CEO of M&T. Interestingly, this was not a straight stock investment for Buffett. M&T needed some cash to make 2 acquisitions, so Buffett made a PIPE investment in the company, a private investment in a public equity. Buffett lent them $40 million in exchange for a note that yielded 9% a year and was convertible at any time within 5 years into stock, pre-2001 split of $78 per share, a 20% premium on where the stock was trading at that moment. In 1996, after collecting several years' worth of the 9% coupons, Buffett converted his shares. His initial investment was $40 million, and it is now worth well over $600 million. The key issue when doing due diligence on a bank like M&T is whether or not the bank's risk-taking is excessive when lending money. A good shortcut to determining an answer to this is to look at insider ownership. Then decide whether this is a shareholder-owned company or a company whose managers have less stake in the future results. Robert Wilmers, the
CEO, owns 3.5 million shares of the company and, prior to the bank's
acquisition of Allied Irish Banks in 2002, was the largest shareholder after
Berkshire Hathaway. When the CEO of a bank owns the bulk its stock,
he or she is much less inclined to take excessive risks with the balance sheet. Whereas Buffett intuitively grasped this, it was also the conclusion reached through empirical means by Sok Wheein Lee, professor at
Soonchunhyang University. Moody's Corporation. Symbol MCO-NYSE. Date purchased 1999-2000. When the firm Dun & Bradstreet spun off its Moody's division in 2000, Berkshire
Hathaway became the largest shareholder, with the ballooning in corporate debt over the past 2 decades. Moody's and Standard & Poor's, the
latter owned by McGraw-Hill, became the two behemoths in the space, both through the strength of their own brand names and SEC regulations that put
70 trade like Warren Buffett too. Insider ownership and risk-taking behavior at bank holding companies. Sok Wheein Lee, Journal of Business Finance and Accounting, Volume 29, 2002.
Them, along with Fitch, as the premier debt ratings agencies. With over $30
trillion in the debt out there having been assigned Moody's ratings, it is going to be hard to knock the company off its pedestal. Nike Inc. symbol NKE, NYSE. Date purchased 1999. Nike, like Coca-Cola and Disney, is a classic brand story for Buffett. The world's largest seller of athletic footwear and apparel is held aloft by its strong brand and strong identification with athletic superstars like Michael Jordan and, more recently, LeBron James. Throughout the past 3 decades, the company has had consistent earnings and ROE, so when the company
slightly faltered in 1998, and its stock along with it, Buffett became a buyer,
making a bet that the strength of its brand backed up by the strong ROE would keep the company on top. In its latest report in 2004, Nike returned to its former ways, reporting its largest revenues, income, and margins ever.
Outback Steakhouse Inc. Symbol OSI NYSE. Date purchased 2001.
In 2001, for the first time in years, Outback Steakhouse reported earnings that were down from the prior year. The stock languished as a result and
Buffett became a buyer. Once again, there are similarities between this stock and many of the other stocks reported in this chapter: consistent
earnings, ROE, margins, and growth in book share for years, followed by one downswing in earnings. The stock is published and Buffett is a buyer, knowing that at the very least he is buying a company that knows how to generate profits from its equity base, has a strong brand name, and knows how to generate consistent earnings. Note that despite the consistent earnings and the clear strength of the business, Buffett only started taking the dip in when the water got warm enough, that is, when the company experienced difficulties in its growth. The idea once again was that if a turn
around were in the works, as could be expected by the prior strength in
ROE and the consistency of earnings, then that turnaround would be a list for the shares. Symbol STI, NYSE. Growing earnings, consistent ROE, increasing book share every year.
But perhaps the most important aspect of this investment, one of Buffett's largest, is that SunTrust contains the only handwritten formula of the
Coca-Cola syrup in a safe in Atlanta, Georgia. Buffett has to protect this. Investment. Symbol. WPO, NYSE. Date purchased, 1973. The purchase of Washington Post Company has been detailed in countless
books and articles about Buffett. Buffett loved the newspaper industry
since he was a paperboy as a youth, and when he had the opportunity to buy WPO at 20% of book value, he seized it. The Washington Post proba. Bly is the best example of a cigar butt stock in the Graham-Dodd sense. 74 trade like Warren Buffett SunTrust Bank's Inc. Symbol. STI, NYSE. Growing earnings, consistent row, increasing book share every year.
But perhaps the most important aspect of this investment, one of Buffett's
largest, is that SunTrust contains the only handwritten formula of the Coca-Cola syrup in a safe in Atlanta, Georgia. Buffett has to protect this. Investment. Washington Post Company symbol. WPO, NYSE.
Date purchased. 1973. The purchase of Washington Post Company has been detailed in countless books and articles about Buffett. Buffett loved the newspaper industry
since he was a paperboy as a youth, and when he had the opportunity to buy WPO at 20% of book value, he seized it. The Washington Post proba. Bly is the best example of a cigar butt stock in the Graham-Dodd sense.
A company trading well below book that is perhaps good to pick up and
take one more puff, but that's it. It then grew up to become a growing permanent holding in the Berkshire stable. Much has been written about Buffett's influence on the board of WPO and his effect on its corporate governance practices, but I think that WPO has had just as much an effect on Buffett. This was really Buffett's
first major permanent holding. Even American Express, a great company
that Buffett was able to buy in turnaround fashion in the mid-60s, did not
notch in a permanent place until the 1990s. Without the success of WPO, Buffett may have never taken more aggressive chances with companies like Coca-Cola. Wells Fargo. Symbol. WFC, NYSE. Date purchased. 1990. Wells Fargo is another case study excellently covered in Hagstrom's books, and others, on Buffett. Suffice it to say, Buffett was a buyer when the market was cruelly punishing bank stocks and particularly California banks in the fallout of the savings and loan crisis.
Chapter 5 Merger Arbitrage like Warren Buffett. Give a man a fish and he eats for a day. Teach him to arbitrage, and he will eat for a lifetime. Warren Buffett. We sometimes enter the arbitrage field when we have more money than ideas. Warren Buffett, 1985 Berkshire Hathaway Annual Report. Buffett went from a trader of Berkshire Hathaway shares to a long-term investor as the result of an arbitrage gone bad. The company itself was trading for almost half its book value and was regularly
buying back its shares through tender offers. Buffett would buy its stock, wait for the tender offer, and then sell the shares. This was almost a riskless
arbitrage. He was buying stock for less than its liquidation value, and the company was regularly offering to buy back shares at higher prices. It is this double-edged margin of safety, more than one possible exit strategy from the trade, that is the hallmark of a Buffett trade. In any case, it was this out that afforded Buffett the luxury of building a company worth more than $100 billion. The company's CEO at that time, Jack Stanton, asked Buffett at what price he would tender his shares. Buffett said 113/8 and then the company went ahead and tried to lowball him with a tender offer.
At 111/4. Don't mess with Warren Buffett, is not necessarily a phrase
Purred in the halls of Buffett's companies, and yet someone should have definitely advised Stanton against testing the great trader. Buffett ended up rejecting the tender offer, buying more shares, and outing Stanton, ultimately taking the CEO and chairmanship role for himself. We can only hope Stanton held onto any shares he might have had. Early in his initial partnership, Buffett divided his investment activities
into 3 buckets: generals, workouts, and controls. Generals were long-term
value plays determined primarily by their discount to book value. Although some qualitative standards were used as well, for example, when Buffett put much of his fund in American Express stock after the Salad Oil scandal in 1964, controls were usually promoted or demoted, depending on your point of view, to generals, where Buffett bought so much stock. He ended up controlling the company, usually in the case of a cigar butt stock, a stock that was so undervalued Buffett was able to buy shares at a significant discount to book value. Buffett didn't mind taking ownership in the company so he could control the liquidation in order to secure his ability to make money on the investment. He called these cigar butt stocks because if you find a cigar butt on the ground, it might be good for one more puff, but that's about it. And, finally, there were the workouts. The following is from Buffett's letter to investors in 1963. These are the securities with a timetable. They arise from corporate activity, sell-outs, mergers, reorganizations, spin-offs, etc. In this category we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activity. Ties of this sort. We wait until we can read it in the paper. The risk pertains not primarily to general market behavior, although that is sometimes tied in to a degree, but instead to something upsetting the apple cart so that the expected development does not materialize. Such
killjoys could include antitrust or other negative government action,
stockholder disapproval, withholding of tax rulings, etc. The gross profits in many workouts appear quite small. A friend refers to this as getting the last nickel after the other fellow has made the first 95 cents. However, the predictability coupled with a short holding period produces quite decent annual rates of return. This
category produces more steady absolute profits from year to year
than generals do. During any given year, 50% or more of Buffett's profits on the year could come from workout situations. Over the course of his 50 years
of investing, Buffett has engaged in many forms of arbitrage, including
merger arbitrage, relative value arbitrage, convertible arbitrage, fixed
income arbitrage, and other special situations that involved short-term trading
unrelated to his usual bread and butter of stock picking. Does he still practice every form of arbitrage there is? No. In some cases, the sheer size of the amount of money Berkshire needs to put to work in a deal makes it
inappropriate to attempt forms of investing where the capacity of the strategy
is much smaller. Later in this chapter we will examine Buffett's use of arbitrage and interview a Buffett-like manager who does merger arbitrage, John Orico
of the Arbitrage Fund. What does it mean to be Buffett-like? In many cases, it is a
son of apples and oranges. For instance, Warren Buffett seldom, if ever, engages in merger arbitrage these days, nor is Berkshire Hathaway going around buying companies that are trading for less than their book value. Usually these companies, if they exist, are too small for him. That said,
there are many managers out there who have successfully applied Buffett's approach to investing in their own methods. This approach primarily
consists of an obsession with margin of safety. Buffett once said, in the last chapter of The Intelligent Investor, Graham said the three most important words of investing: margin of safety. I think those ideas, 100 years from now, will still be regarded as the three cornerstones of sound investing. So what does margin of safety mean? In the basic Graham-Dodd analysis for a stock, it means buying a stock that is trading at 2/3 of its liquidation value. However, even Buffett quickly moved beyond that understanding of the phrase in the early 1960s when he began focusing on more qualitative aspects of a stock such as brand value, earnings growth, and so on. It is probably easier to figure out what margin of safety is not. When it comes to investing, it is not buying a stock because it closed above its 200-day moving average. Shorting a stock because a 200 P/E is ridiculous. Buying calls in a stock on takeover rumors. In other words, the margin of safety will help prevent you from getting into a situation where the risk cannot be quantified or understood in terms of
the size of the potential loss. Merger arbitrage. What is it?
The classic arbitrage took place frequently in the early 1900s. Securities and London might, for more than a few microseconds, trade at one price on the London Stock Exchange and then a different price on the New York Stock Exchange, simply because information did not flow as quickly between the two exchanges as they do today. The complete lack of information flow severely disrupted the plans of an efficient market god. Computers and now the Internet have replaced the telegraph as the bridge toward bringing about a global marketplace, where severe information disconnects like the ones Baruch exploited no longer exists. When an arbitrage exists between any
two assets, computer models often immediately pinpoint the spread and bill.
Lions of dollars instantly go to work toward making that spread converge. The question now is, do opportunities continue to exist? In the Berkshire Hathaway 1999 annual meeting, Buffett stated that techniques like arbitrage would still enable an investor to make more than 50% a year. The first example of arbitrage to examine is risk arbitrage, which we will more accurately call merger arbitrage. The reason it is often called risk arbitrage is that the word arbitrage often implies there is no risk. How can there be risk if you are selling gold for $401 in London and buying it back
for $400 in New York simultaneously? But with merger arbitrage, enough
risks exist such that a spread is created between the two assets involved that supposedly anticipate and define that risk. A potential merger arbitrage situation is created when any merger is announced in which the target is a public company, often the target company trades for less than the amount offered for that company. A trade
exists where you can buy the target company shares and sell them when
they reach the price specified in the deal. For instance, if company XYZ announces it is acquiring company ABC for $15 per share in cash and company ABC is trading at $14, then you can buy shares in ABC with the idea that
those same shares will be sold to XYZ when the deal closes at $15 per share.
why would there be risks to a merger? Why wouldn't the target company trade immediately at the price at which it was being acquired? There are at least 4 types of deal risks that can prevent a deal from closing.
1. Due diligence risk. After the deal is agreed upon, there is usually a due
diligence out, meaning the acquirer can back out of a deal, usually after paying a breakup fee. 2. Regulatory risk. For instance, the GE-Honeywell merger was blocked by antitrust concerns from European regulators. 3. Another acquirer can step in, particularly in a hostile takeover
situation. A white knight might become involved. This would most
likely be great for those who are long the target's shares, but in a stock deal, arbitrageurs who are short the acquirer's shares as a hedge will lose money. 4. Interest rate risk. If a deal is going to take a year to close and the spread between the target company and its acquisition price is 4%
and interest rates are 5%, then an arbitrager would rather sit
tight in bonds unless the spread of the deal got wider. Typically, when a potential merger is announced, the stock of the target runs up, settling down near the level of the deal price. The spread between
the price it trades at and the eventual deal price is dependent on the risks
described above and how much the market, particularly the group of arbitrageurs who are stepping in to make money on the spread, value those risks. In an all-stock deal, the stock of the acquirer will also most likely come down as arbitrageurs short the stock to hedge their risk. The amount of risk an arbitrageur takes in the deal is usually related to the amount the
stock ran up the day the deal was announced. If news of the deal had been
leaked in the days prior to the deal being announced, then an arbitrageur must include that increase when taking into account the size of the risk. In each type of merger, there are different methods of assessing the value of the deal for an arbitrageur and the value of the spread. Some types of mergers are cash deal. Company X offers cash to buy the shares of Company Y. In this situation, an arbitrage exists, as in the previous example, when X trades below the price being offered. The arbitrageur buys shares in X and holds until the price converges. The value of the deal to an arbitrageur is measured roughly by this formula: V equals P, D minus T, T, where V equals the expected value of the deal if the deal works out. P equals the probability the deal will be completed. D equals the price the target stock will be if the deal works out, the deal price. T equals the price of the target stock when the arbitrageur acquires it. Example: if XYZ is being acquired for $11 per share in cash, it is a small, friendly
takeover. You feel it has 100 chance of completion, and it trades at $10, then V equals 1 times 11 minus 10, 10 equals 10%. This doesn't present the full picture, but it's a start. Next, the arbitrageur
must consider the likelihood that the deal takes place within a CER toin number of days, let's call it X, and then the annualized value, AV, of the deal can be calculated as AV equals V times 365, X. To continue our example, if the deal is estimated to take a year, then the annualized value of the deal to an arbitrageur considering it would be 10 times 365 365 equals 10% if this annualized return is better than the returns the arbitrager can make. On any other deal, then he or she would begin considering it. All-stock deal. Company X offers to buy Company Y for Z number of shares, for instance. On April 2, 2003, First Data Corporation announced it was going to buy
Concord EFS by paying 0.40 shares of each First Data stock for each share of Concord EFS stock. First Data was trading at 34.68 at the time of the
merger, and Concord EFS had close to 500 million shares, valuing the deal at approximately $7 billion, even though the deal placed the value of
Concord EFS shares at 13.87. CE shares immediately traded from a range of 9 to 10 to a range of 11 to 12 over the next several weeks. Why was there such
a big discount? The regulatory risk played a large part. The combination of Concord EFS and First Data would create the world's largest debt transaction processor, and the Justice Department was going to definitely have regulatory issues. This could potentially cause the deal not to happen, but at the very least it would slow the deal down, increasing the risk that there were
better deals out there for arbitrageurs to enter. In January 2004, First Data
reached a settlement with the Justice Department to avoid antitrust issues. And on February 26, 2004, the deal closed. In an all-stock deal, the problem of just going long the target stock.
In other words, buying the stock of the company being acquired, is that
the acquirer's shares might go down, in which case the deal price also goes down, because the target stock is pegged in a fixed ratio to the
acquirer's stock. Various other types of deals, including mixture of cash and stock, mixture of cash, stock, and debt.
Stock deals where there is a collar, meaning the ratio changes upwards if the stock of the acquirer falls below a certain price. In a hostile takeover, the formula for calculating value would be similar to the example, but the risks of a deal falling through would be much greater, as well as the risk that another acquirer would step in. The formulas about determining the value of a deal are only a starting point. And even with those formulas there is a big, gaping hole. How to assess the probability that a deal will close, and, if so, how to estimate the time needed for it to close. With most clear-cut, systematic strategies, a fair amount of discretion and reevaluation must take place. On top of this reevaluation and decision-making is also deciding how much capital to put to work. Ideally, you would have more than 100 of capital at work, using leverage in many uncorrelated merger arbitrage opportunities, uncorrelated so that the success of one is not dependent at all on the success of the others. How does an arbitrage opportunity become uncorrelated with other opportunities? Different industries, different sizes, different countries, different type of deal. For example, some deals in a merger arbitrage portfolio might be all cash, others might be a combination of cash and stock, all stock, stock and debt, and so on. When taking into account whether you should use leverage, it is also important to take into account the interest rate you are paying on that leverage. The lower the interest rate, the longer the possible time frame to deal completion is allowed, depending on the initial spread after a deal is announced. Part of the decision-making process is the hedging method. In the basic stock-for-stock deal, you short the acquirer and buys the target. However, What if the acquirer's shares are difficult to short? In order to short, you need to find shares of the acquirer to borrow. The brokerage firm you trade through will tell you if shares are borrowable for shorting, in order to sell them in the shorting process, because there is a lot of money invested in merger arbitrage funds. It quickly becomes impossible to find shares to borrow.
All of the arbitrage funds have borrowed them already. Here are two possible solutions. 1. Don't short as much as you should, thereby adding to the risk of the
deal but placing a bullish bias on the result. 2. Most of the price movement in a stock is strongly correlated to the prices of the market in general, and even more so with prices of stocks
in its sector. You can short a basket of stocks in the sector or index.
Exchange-traded funds, ETFs, and futures. This leaves you with stock-specific risk, meaning that the company could suddenly fall apart without affecting any of the other companies in its sector. The beauty of
doing this is that the upside risk of the hedge is now negligible. In
other words, if the deal falls through, the acquiring stock will shoot upwards as the hedgers in the deal depart from their short positions. But the shares of other stocks in the sector will not go up as much. Merger arbitrage funds often have access to sophisticated resources, ranging from analyst reports to computers to constant evaluations of the
spreads, probabilities, and so on. However, the average trader can certainly
take advantage of the internet resources out there to compete on an almost equal, if not more advantageous, playing field, due to the lower amount of money that he or she needs to put to work to have a successful annual return. My favorite internet source for merger arbitrage data is at
thedell.com. Exhibit 5.1 shows a snapshot of the type of information that
thedeal.com provides to the aspiring arbitrager. Thedeal.com does all of the basic calculating for you, in terms of figuring out the spread, the annualized return, and even the estimated date that the deal is expected to close. All of this information is not shown in Exhibit 5.1, but it is available on the website. The big question now is, what deals should you do? We saw in the first case mentioned above that Warren Buffett likes to give himself more than one way out. In the Berkshire Hathaway example, when Berkshire came in with a tender offer Buffett was unhappy with, he was also content to simply buy up the shares and ride it out a little longer. In his 1988 letter to Berkshire Hathaway shareholders, Buffett attributes much of the success of the 1987 portfolio to arbitrage, and this in a market that had suffered through the 1987 crash. In the letter, he describes how he evaluates the risk in an arbitrage situation, and then goes through the specifics of the Arcata 1981 deal in which buyout firm KKR was involved. To evaluate arbitrage situations, you must answer 4 questions.
1. How likely is it that the promised event will indeed occur? 2.
How long will your money be tied up? 3. What chance is there that something still better will transpire, a competing takeover bid, for example? And 4. What will happen if the event does not take place because of antitrust action, financing glitches, etc.? Arcata Corp., one of our more serendipitous arbitrage experiences, illustrates the twists and turns of the business. On September 28, 1981, the directors of Arcata agreed in principle to sell the company to Kohlberg, Kravis, Roberts & Company, KKR, then and now. A major leveraged buyout firm. Arcata was in the printing and forest products businesses and had one other thing going for it.
In 1978 the U.S. government had taken title to 10,700 acres of
Arcata timber, primarily old-growth redwood, to expand Redwood National Park. The government had paid $97.9 million in several installments for this acreage, a sum Arcata was contesting as grossly inadequate. The parties also disputed the interest rate that should apply to the period between the taking of the property and final payment for it. The enabling legislation stipulated 6% simple interest. Arcata argued for a much higher and compounded rate. Buying a company with a highly speculative, large-sized claim in litigation creates a negotiating problem, whether the claim is on behalf of or against the company. To solve this problem, KKR offered $37 per Arcata share plus 2/3 of any additional amounts
paid by the government for the redwood lands. Appraising this arbitrage opportunity, we had to ask ourselves
whether KKR would consummate the transaction since, among other things, its offer was contingent upon its obtaining satisfactory financing. A clause of this kind is always dangerous for the seller. It
offers an easy exit for a suitor whose ardor fades between proposal
and marriage. However, we were not particularly worried about this possibility because KKR's past record for closing had been good. We also had to ask ourselves what would happen if the KKR deal did fall through, and here we also felt reasonably comfortable. Arcata's management and directors had been shopping the company for some time and were clearly determined to sell. If KKR went away, Arcata would likely find another buyer, though of course, the price might be lower. Finally, we had to ask ourselves what the redwood claim might be worth. Your chairman, who can't tell an elm from an oak, had no trouble with that one. He coolly evaluated the claim at somewhere between 0 and a whole lot. We started buying Arcata stock, then around $33.50, on September 30, and in 8 weeks purchased about 400,000 shares, or 5% of the company. The initial announcement said that the $37 would be paid in January 1982. Therefore, if everything had gone perfectly, we would have achieved an annual rate of return of about 40%, not counting the redwood claim, which would have been frosting. All did not go perfectly. In December it was announced that the closing would be delayed a bit. Nevertheless, a definitive agreement was signed on January 4. Encouraged, we raised our stake, buying at around $38 per share and increasing our holdings to 655,000 shares, or over 7% of the company. Our willingness to pay up, even though the closing had been postponed, reflected our leaning toward a whole lot, rather than 0 for the redwoods. Then, on February 25, the lenders said they were taking a second look at financing terms in view of the severely depressed housing industry and its impact on Arcata's outlook. The stockholders' meeting
was postponed again, to April. An Arcata spokesman said he did
not think the fate of the acquisition itself was imperiled. When arbitrageurs hear such reassurances, their minds flash to the old saying, "He lied like a finance minister on the eve of devaluation." On March 12 KKR said its earlier deal wouldn't work. First cut ting its offer to $33.50, then 2 days later raising it to $35. On March 15, however, the directors turned this bid down and accepted another group's offer of $37.50 plus 1/2 of any redwood recovery. The shareholders okayed the deal, and the $37.50 was paid on June 4. We received $24.6 million versus our cost of $22.9 million. Our average holding period was close to 6 months, considering the true BLE this transaction encountered. Our 15% annual rate of return, excluding any value for the redwood claim, was more than satisfactory. But the best was yet to come. The trial judge appointed 2 commissions, one to look at the timber's value, the other to consider the interest rate questions. In January 1987, the first commission said
the redwoods were worth $275.7 million, and the second commission
recommended a compounded, blended rate of return working out to about 14%. In August 1987, the judge upheld these conclusions, which meant a net amount of about $600 million would be due Arcata. The government then appealed. In 1988, though, before this appeal was
heard, the claim was settled for $519 million. Consequently, we
received an additional $29.48 per share, or about $19.3 million. We will get another $800,000 or so in 1989. Another example of arbitrage, similar to the example at the beginning
of this chapter, occurred in July 1992 when General Dynamics made a tender
offer for 20% of its stock. The price would be determined by Dutch auction at prices ranging from $65.37 to $72.25 per share. Buffett began buying shares in anticipation of tendering them, but once he started buying them, he decided that he liked the fundamentals of the company and chose to hold onto the shares instead, quadrupling his investment. Again, this is an example where he could have taken the safe money of the arbitrage, but he had the extra out for himself by knowing after studying the fundamentals that he could hold onto the shares and ride the investment. In his 1963 letter to investors in his partnership, Buffett presented the
details of a very straightforward merger arbitrage situation in Texas.
National Petroleum, TNP. Buffett mentions that he had heard rumors that TNP was going to be acquired by Union Oil of California, but he did not act on those rumors and in fact reported, "I never act on such information. And there is no need to, when profits can be straightforward once the deal
is announced." A deal was announced and Buffett determined what he would do with each category of security that TNP had. TNP had debentures yielding 6.5% that would be called once the
deal was done. Common stock for which Union Oil was going to pay $7.42 per share. Warrants. Buffett was able to acquire each class of security in the 6 months leading up to the merger at a reasonable spread between his buy price and the acquiring price. In particular, on the debentures, he was also able to get a nice 6.5% interest rate while he was waiting. Additionally, Buffett noted that risk of stockholder approval was nil, since the deal was negotiated by the controlling shareholders. There were no antitrust problems or legal problems.
Buffett therefore had a high degree of comfort that the deal would be
done. The only issue on the timing was that TNP needed a tax ruling by the IRS. The ruling took slightly longer than expected by about 2 months. And Buffett's return on the entire investment when it concluded was an annualized return of approximately 21%, the longer time span allowed Buffett to get more payments on the bonds. His comment on this, which applies to most arbitrage situations, is that 1. The deals take longer than originally projected, and 2. The payouts tend to average a little better than estimates. He also notes that, I definitely feel some borrowed money is warranted against a portfolio of workouts, but feel it is a very dangerous practice against generals. The big question is, does merger arbitrage work in general? There are 3 directions in which we can look to determine an answer to this question. The first is academia, where studies have been done on every merger announcement over the past 20 years to determine what the results would have been had one blindly played each situation possible.
The second is the results of hedge funds and mutual funds devoted only
to merger arbitrage. The third is statements by Warren Buffett, who has engaged in merger arbitrage for almost 50 years. Each of these directions has problems in determining a complete answer, but perhaps the aggregation of the answers will give us insight. On the academic side, perhaps the most comprehensive study has been done by Mark Mitchell and Todd Polvino. Point 1, I categorize them as acad. Mike, but both of these professors have been active in actually trading merger arbitrage deals, having become partners in AQR Capital's merger arbitrage
fund. In their paper, Characteristics of Risk and Return in Risk Arbitrage, they analyze every merger from 1963 to 1998 and blindly play the spread that existed on the day after the announcement in every case. Altogether they studied the results of 4,750 mergers. The results are roughly summarized in Exhibit 5.2. 94 Trade like Warren Buffett. The big question is, does merger arbitrage work in general? 1. Characteristics of Risk and Return in Risk Arbitrage, Mark Mitchell and Todd Polvino, Journal of Finance, Volume 56, Number 6, December 2001.
The Value-Weighted Risk Arbitrage, VWRA, return in the exhibit refers to the return that would be generated if you were to value each merger by
its size. The Risk Arbitrage Index Manager (RAIM) return represents what
would happen if you played each merger subject to more realistic constraints. For instance, only limiting each position to 10% of your portfolio and also restricting yourself to deals involving more liquid securities. The results demonstrate that even if you blindly play every single merger that exists, you can still obtain a slight risk-adjusted premium to the
market. The spread between the risk-free return and the value-weighted return is 10% in the value-weighted index and 4% in the
RAIM index. While I think this study demonstrates that merger arbitrage is a decent strategy, it also is very conservative for the following 2 reasons. 1. An arbitrager won't blindly do every deal, but will instead use a variety of factors to limit the risk in a deal. 2. An arbitrage fund may use leverage to attempt to get the risk-adjusted returns multiplied by the leverage factor. Also interesting is the fact that the VWRA portfolio in the above table returns more than the index, which does not take into account the size of the deal. This suggests that the larger the companies involved, the more Likely it is for a deal to succeed. Eliezer Fitch and Irina Stefanescu, two who are both from the University of North Carolina, confirm this by demonstrating that when an acquirer is in the S&P 500 index, the risk arbitrage portfolio returns are 85% higher than when the buyer is not in the index. Perhaps most interesting is to look at the results of the Credit Suisse First Boston, CSFB, hedge fund sub-index devoted to merger arbitrage. Exhibit 5.3 shows the summary tables. Since inception, the merger arbitrage index has underperformed the CSFB hedge fund index, 8.39 versus 10.59%, but the standard deviation has been much less, 4.48 and 15.85%, making the equity curve
much smoother. 96 Trade like Warren Buffett 2. Expanding the Limits of Merger Arbitrage, by Eliezer Fitch and Irina Stefanescu.
University of North Carolina Working Paper, 2003. None of this takes into account Warren Buffett's own studies on the possible results of merger arbitrage. In his 1987 letter he writes, "Though we've never made an exact calculation, I believe that overall we have aged annual pre-tax returns of at least 25% from arbitrage." Although the academic studies as well as the practical results demonstrated by the hedge fund index show that merger arbitrage is a viable risk-adjusted strategy, the one problem both of those studies and approaches have is that they have to trade every year, and in almost every situation.
Buffett, not being specifically an arbitrager, can wait for the situations
that he feels afford an extra level of safety. This leads to one of the biggest aspects of Buffett's career that I admire. He writes his own rules. Many hedge funds out there, and this is definitely the case for almost all mutual funds, are obligated to tell their investors their monthly results. These monthly results can be like a straitjacket. The second the results begin to dip or become volatile, there is always the risk that the investor can pull out. It is this desperation for smoothness to the equity curve that compels many hedge funds to be extremely risk-averse and not always take advantage of every opportunity available to them, even when the odds are greatly in their favor. Buffett clearly stated to his investors, "I'm open for business one day a year," and that was that. Once a year he could tell investors how he was doing, and if they didn't like it, so be it. Modern hedge funds also abhor style drift, the propensity to switch styles midstream. A fund will not go from value to growth stock picking, or suddenly start day trading futures after having advertised itself as a
biotech investor. The primary reason for this is that the primary allocators
to hedge funds or fund of funds have very specific mathematical models for how to allocate and diversify their own portfolio. If they invested in you because they thought you were a merger arbitrage fund, then you had better remain a merger arbitrage fund. Buffett didn't care for any of that. He did what he wanted to do, and told investors their results when he felt like it. Power to him. How to arbitrage like Warren Buffett. Buffett mentions in his 1988 letter the 4 conditions that an arbitrager must ask. In addition to the obvious question, "What is the spread?" they are: 1. What can cause the deal to fail? 2. What is the time it will take for the deal to occur? 3. What other opportunities might be available? 4. What are you going to do if the deal does not go through? It is this fourth question and the way he phrases it that most intrigues me. The question is not, what is your downside risk? As is most often asked in textbooks on arbitrageurs, but, what are you going to do if the deal is not completed? This emphasizes the importance of having a backup plan, an extra exit in case the deal does not go through. Also, before making a trade, it is possible to eliminate the cases that statistically offer more risk. Buy deals in which an S&P 500 company is the bidder. Buy deals in which the targeted company is trading for less than book. Don't do a deal when it is a hostile takeover, it is less likely to be completed. Try to do deals in which you are bullish on the fundamentals of the underlying company or its sector. Buy a deal in which there are multiple bidders. Some examples of having an out in an arbitrage trade are when the targeted company also happens to be trading below its liquidation price. Deals like that do not happen very often, but occasionally they do. A recent example from the penny stock world was when Liberty Media controlled Open TV, OPTV, was making a bid for IATV in mid-2002. IATV was burning a lot of money, but also happened to be trading at a market cap well below the cash it had in the bank, and with no debt, it had approximately $1 per share cash in the bank, and the deal was priced at approximately $1.10.
In OPTV stock. Because OPTV was itself a penny stock, trading around $2.
There were no shares around to borrow. The spread was therefore enormous. In addition, on several occasions the deal was postponed, and Liberty
Media, run by John Malone, was notorious for changing deal terms.
At the last minute, IATV traded down as low as 50 cents before finally summiting the deal in March 2003. It was a roller coaster ride for the arbitrager, but the ride was worth it, and the consolation if the deal did not work out was the solid $1 per share in cash that the company had left in its coffers. As Buffett has said, "I'd rather have a lumpy 15% than a smooth 12%. That said, it usually doesn't get any smoother than a portfolio of merger arbitrage situations. The next section is an interview with John Orico, a merger arbitrage specialist who strives to take as many risks as possible out of the trade. Before making the trade, the arbitrage fund is a mutual fund that focuses on merger arbitrage situation. Interview with John Orico.
Of the arbitrage fund. Yeah. Can you give us some personal background?
Joe. When I got out of Georgetown, I went to Morgan Stanley and worked in corporate finance for 2 years and institutional equity for 2 years. From the mid-80s to the mid-90s, after Morgan Stanley, I held a variety of positions in trading, institutional equity, as an analyst, and
as a portfolio manager. Yeah. When you say trading, that's primarily.
Joe. At Morgan Stanley, I was at the institutional equity desk. I was on the over-the-counter desk and actually making markets on stocks there. When I went to Instinet, when that firm was still in its infancy, I ran
the institutional equity desk there, but we didn't commit capital, so there was no principal trading involved. It was really more agency.
Brokerage. Then, Instinet got bought out by Reuters, and I wanted to get to the buy side. So, I took a couple of steps back to do
that, among other things. And I've worked as an analyst for a while at
one firm. I got a job as an assistant portfolio manager at another firm. Yeah. What kind of portfolios do you normally pick? Joe. When I worked as a portfolio manager for the U.S. investment arm of a Japanese life insurer, they were clearly just long-only portfolios, bonds, and stocks. The hedge fund was pretty much a rapid trading hedge fund.
When I had some experience working for a small hedge fund, but
again, long and short strategies, but primarily looking for trading ideas. Yeah. So like something that would pop on earnings? Joe. Exactly, special situations, deep value type of situations.
yeah. How did that work out overall? Joe. Unless you're a great stock picker or you really want a balanced
portfolio in terms of the long-short strategy, I think those strategies are really kind of victim to the ups and downs of the market. It's easy to make money if you're a long-only type of trader when the markets are rising. It's, of course, much more difficult in flat, volatile, or down markets. I just think it's a lot harder than it seems to a lot of people, and I
can speak for myself and say that early in my career I had no clue. When I look back, I really had no knowledge of the type of hedging
techniques and strategies that are or were out there and available. It's really about getting in front of the right people, working for the right people, getting into the right shop where you can learn a lot of those things, whether it's on the buy side or the sell side. A lot of people do run funds, limited partnerships and trading vehicles. But I think the number of people who do it really well consistently over time is quite limited. That's just my own feeling after having seen it all and knowing a lot of people in this industry. My history prior to going to work for Martin Gruss at Gruss & Company, which is a private family trust where I learned a skill set around merger arbitrage, was really as a kind of a trader, a money
manager with kind of a long focus. I then went to work for the Gruss family, for their family private
accounts. They have been utilizing merger arb and event-driven strategies for decades. So I went into a shop that really had a history with this particular strategy and knew what they were doing, where I could learn. Yeah. What was your initial attraction to those strategies? Joe. I really didn't know when I first went there. When I walked in the door.
It wasn't to go work with the merger arb team, it was to work on a
team that was running the internal hedge fund there, a long-short kind of fund. But after getting introduced to the merger team and their strategies, it became clear to me that the merger arb and event-driven strategies, whatever you want to call it, although they do talk about event-driven as inclusive of merger arb, really force you not only to understand the underlying companies that you're involved with but also to take a directional bet. You can still take a directional bet if you have a strong feeling one way or the other, and that comes into the way you hedge and into the strategies you develop around your position. So what attracted me to it? The very analytical and quantitative skills that come into play are very important in that strategy in terms of analyzing the underlying assets that you're investing in or selling short. You need to understand the situation and be able to follow the strategic rationale behind each event, and you can describe many of these events as binary, or events that are not predicated on overall directional moves in the marketplace. Yeah. Can you give an example of one situation in which you might have taken a directional bet? Joe. Back in the late 90s, when Conrail put itself up for sale, we had two of the largest railroads in the country bidding for this property, which Had no peers, couldn't be replicated, and most likely would never be for sale again. In that particular case, our analysis told us that this bidding war between the two interested parties was likely to continue, driving the asset price much higher than what we thought might be its intrinsic or fundamental value. That doesn't mean that there is no risk, but it means there might be a way for us to increase our exposure to that particular deal. The option markets are very liquid, and typically with a lot of the bigger situations, there are ways to hedge yourself. The outcome may take a couple of months to unfold, but when we're playing a situation in which we think prices will go higher amid more aggressive bidding, we will buy some stock, marry a put to it, and just go to sleep. It may be an out-of-the-money put, but as long as we can measure our downside, in a general sense, that's how we view our business. We want to be able to understand what our downside looks like. In some cases, our upside is well defined, in other cases, it's not. That's what attracted me to merger arb. It's a much more interesting strategy than just taking a bet on a stock. You can always take bets on stocks, and we can always figure out ways to hedge ourselves. However, in the context of a deal or how a deal will be viewed by the street, whether it's a merger, a takeover, or a hostile bid, there are always other ways to look at the event as it unfolds and other ways to play it. There may be an event unfolding that we're quite bearish on, where we don't like the probable outcome. Even if the deal goes through, we may not like the combined entity. We may think it's too over-leveraged. We may think the market may not like it. We think the shareholders may vote it down. So it doesn't mean we're always betting on a successful conclusion. We can anticipate a successful conclusion, but anticipate share prices going lower. Every deal has its own twists and turns, and there's always a different way to look at any particular deal. But as long as we can get a sense for what our downside is, that allows us to continue to run a business day in and day out and always be around to play another day. Yeah. In the Conrail example, do you think that Conrail initially was trading below its own intrinsic value or your calculation of intrinsic value? Joe. I guess the question is, were we looking at the stock before the null decision was made at Conrail to put itself up for sale? In that case, those shares trade based on the fundamentals of that particular industry, relative to their peer group, but as an entity that had some governmental oversight and some government control to a certain extent. Once we understood that transaction was given a green light, meaning that the sale of that asset was going to be allowed to go forward by the regulators, then it puts a whole different light on what underlying value might be. Then you're talking about the types of synergies that a potential buyer will be able to extract from that particular asset. That could increase by some factor related to the synergy that the new buyer brings in. How much traffic can the new buyer run over those rails that it's now shipping inexpensively by truck or by air? Once we understand the rationale of the deal, then we're able to examine what the benefits are and what benefits will accrue to the buyer or the entity on a pro forma basis. It puts a whole new evaluation on the deal. In this particular case, it's a one-of-a-kind asset. There aren't going to be any more rails into the Northeast or into the ports of New York, Philadelphia, or Boston once this thing is off the market or not available to other buyers. That's it. It will never come up for sale again. So if you're a strategic buyer and that asset could be strategic to your firm's overall growth, you're probably going to pay more than what it's worth because it can't be replicated. So that's a special kind of situation, and that doesn't always happen. Look at a deal that's taking place today, such as Pfizer's deal to buy Asparian Therapeutics, a company that doesn't have any UCTS on the market, just in development, and Pfizer is willing to pay almost $2 billion for this asset. You have to ask yourself, what does Asparian control? What has it developed, or what potentially does it have in the way of technology that makes it that desirable? If it's that desirable to Pfizer, does it mean that other players are aware of this technology or this drug pipeline and may be interested
as well? Or is it just more valuable to Pfizer than anyone else because
Pfizer has such a big stake in this particular segment of the health care industry already? Here we're talking about cardiovascular disease and the drugs that have to do with controlling cholesterol levels in the body. Pfizer has a big platform that's already dominant in the field. This particular company has new technologies on the horizon and new products in the pipeline, and a lot of people in the industry think it can be quite valuable. Does it ensure Pfizer's success in this field into the next decade? Does it give them a platform by which they can then extend the patent life on their current drug portfolios? I mean, what's it really worth to Pfizer? It's hard because then this asset is worth different values to different players. To a player that wants to get into the market and doesn't have a presence in cardiovascular treatment, maybe this is a springboard into that, avoiding the startup costs related to doing it on your own. For Pfizer, which is looking to extend its current platform and develop the new technologies it may feel are needed to ensure it remains number one in the field, it needs to pay top dollar for this and keep it out of anyone else's hands. Who knows what it's worth to any one particular buyer unless you understand how that buyer is positioned, how it competes, how it would potentially compete with or without this particular deal, and how the regulators are going to look at it. It gets complicated because as much as you try to put yourself in the shoes of the buyer, it's hard. You'll never know everything they know. You'll never know what's in their product pipeline or what's on their drawing boards, so we can guess a lot. We can try to understand by talking to the companies, by talking to analysts, by talking to other players in the field about what makes this asset so attractive to a particular player and really try to build our own models around what we learn. Yeah. Why is it so necessary to know what's on the mind of the buyer? You know they want to buy the company, and at that point, let's say there's a regulatory risk or a risk that the deal is not going to go through. How does knowing what is on the mind of the buyer help you deal with those and other risks? Joe. Well, for instance, in the biotech sector, a buyer is also concerned about how the trials are going. When do the new benchmarks or results come out? During the course of the next 3 months, we may
hear some significant news on some of these drugs in development
that may torpedo a deal if they find that the endpoints were not met. Look at First Data's deal to buy Concord, which ran into some regulatory problems. The potential for regulatory problems is always on our minds. What's also on our minds, though, was that these were related to Concord's economic performance for the duration of this deal. Many Concord contracts with some of its largest banking customers Tomers come up for renewal, and many of those customers may not renew their business relationships with Concord in terms of debit and credit card processing. How much of Concord's business could bleed to the loss of renewals or the loss of new business before first data says the economics of this deal don't make sense anymore? That was a concern. Because there's always a disruption to the target's underlying business.
Concern among customers, concern among employees, you may lose
some top salespeople when you're going through a potential transaction. On Caremark, which is in a whole other field in terms of pharmaceutical delivery, is buying advanced PCs, which just lost a large contract to a competitor, and we know it has other contracts up for renewal. So we ask ourselves what the merger agreement says with regard to business losses. In Caremark's merger agreement, it does not have to go through with this deal if revenues exceeding a certain percentage of Advance's business disappear between now and the close. They can weigh that condition and go through with the deal anyway. But these merger agreements contain numerous conditions not only on the regulatory side but also on how much business it's willing to divest in order to meet regulatory requirements. Clearly that's usually carved out. Also, what are the economic requirements? Are there revenue targets, EBITDA, earnings before interest, taxes, depreciation, and amortization targets, earnings targets? Many of the merger agreements today have conditions such as those. Say you have a deal that's been negotiated based on a particular value. Let's say $30 in stock is going to be distributed at close. Well, if the acquirer shares fall from
$30 to $15, it goes from a 1-to-1 exchange to a 2-for-1
exchange. Some companies will not go through with a deal if their share prices fall to a level such that they have to issue significantly more shares. What was an accreted transaction then turns into a diluted transaction. But again, you have to ask yourself why the acquirer's shares fell from $30 to $15. Does that open the door for another buyer to step in? Every deal has its own twists and turns, and it really forces us to examine the quality of the companies that are involved. When I say quality, I'm talking about their earnings consistency, the quality of earnings, the transparency of their accounting, and the type of management that runs the company. What do the balance sheets look like? What are the peer group valuations relative to these two companies? And what is their competitive position within the industry? What factors could impact any of those issues? And that's just the basics. That's just to get comfortable with where we are in the deal before we invest in it. It's much easier with larger companies and larger deals. Everybody knows Bank One and JP Morgan. You have 50 analysts following the two companies. But in some of the smaller deals, like in the
healthcare technology field, software and hardware, it gets a little
more complicated. We're not experts in any one particular industry. We're basically generalists. Over the course of my career, I've been involved in a couple of 100 financial deals or dozens of HMO deals. You start to see things again and again, and you begin to know what to look for. Having a history helps because typically you've seen the merger agreements and the language before. You can get an early heads up when something doesn't look or smell right, or something is done differently. Yeah. Is there any type of deal you won't do? Like for instance the Bank One JP Morgan deal. Where would your edge or your margin of safety be? In that deal, if you were to play it, a deal had just been announced at the time of the interview. Joe, I don't believe we have an edge when it comes to a deal that size, which is well covered by the street and by the ARB desks. If there is an edge to be had, it's going to come from taking an independent view of the deal from a valuation and earnings standpoint, taking a look at what, for instance, the new management team from Bank One will bring to this combined entity and what it will do in terms of valuation. Overall, in terms of P/E multiples, we'll look at how it will sit with the analysts on the street. We know that there will be a number of upgrades as a result of this deal. At the end of the day, after we do all our work and look at the numbers, the pro formas, valuations and peer group valuations, we'll talk to the analysts and get a feel from the company how quickly cost cuts can take place. When all of our analyses are done, we may think that JP Morgan is an undervalued stock now, whereas that wasn't the case before. Our edge is bringing our experience and analysis to bear in a situation and maybe coming up with a way to look at this deal that other people don't. That might mean to be hedged instead of selling JP Morgan short. We're going to pay some premiums for those puts. We may end up setting up JP Morgan Bank One not at, let's say, a 5% annualized rate of return, but using puts, we're going to set it up at a worst case, 1.5% to 2% annualized rate of return. When I say worst case, I mean our puts get an exercise and we put our short on 2.5 points lower than where it is. But the upside is that we're going to give JP Morgan room to run. The stock opened up on the morning after the deal announcement. It closed at $39 and change, opened at $39.70, and traded down following that open, basically closing unchanged on the day. The stock is above that level since, but we have never witnessed a bank deal of that size where the acquiring bank traded up. Yeah. What happened on the morning after that announcement? Did every body in your firm get in early and start crunching the numbers? Joe, we actually saw the announcement the previous night, so we had some opportunity to crunch numbers, take a look at the pro formas, see what the analysts had to say, and attend a conference call and watch the press. We did get a head start, but we came in at 8 a.m. the next day like we normally do. Some of my analysts are here earlier. They were watching JP Morgan initially trade down 50 cents at $38.70 and then begin to trade up. From 8 to 9, it went from $38.70 to $40.25 as we got some bullish comments. Maybe the market was acting better overall. People liked the deal. Everyone likes Jamie Dimon. Who knows why, but it traded up significantly, and we had never seen a bank financial deal move up that much. We actually shorted a little bit of stock in JP Morgan early.
Before the open as it moved up, without buying Bank One, because
we thought we had a $62 billion deal here. If 10% of that deal is held by the ARB, a significant amount of short selling will have to take place in JP Morgan over the next few weeks into the duration of the deal. You get the pre-opening kind of euphoria around the deal, but our history tells us this stock will most likely, at some point during the day, trade lower than its prior close. Sure enough, every share that we sold in the morning was a great sale. We were really able to set that up, not at the spread at which it was trading at any one time, but at Probably a level 2 to 3 times that. Yeah. At that time, at the open, did you start buying Bank One shares as well? Joe. We waited for the short sellers to come in. We waited for the ARB community to come and put some pressure on JP Morgan, while we could have bought Bank One at the open and set it up at a decent spread. Based on where we had sold JP Morgan, we waited. I think on that day, Bank One opened at $51.20, and relative to JP Morgan, it had about a 75 or 85 cent spread. We waited, and JP Morgan came down, during the course of the day, $1 from its opening price. Then we began to buy Bank One, and we set it up at a much more attractive spread. But that's more of a trading opportunity that doesn't always present itself. Yeah. What do you do when a deal is announced and by the time you start shorting, there are no shares left to borrow? Joe. We'll go to a prime broker and get them to commit to us the number of shares early. And in some cases, we can lock those shares up. Even if we don't sell short on that particular day, we can lock up. We have
to pay a fee for it. But we can say we want to get a borrow at 100,000
shares and commit to that for 30 days. So they'll charge us even though we don't actually affect the short sale. We may never affect the short sale, and that's the price we pay to be able to have that stock available to us. In some cases, we may have a problem maintaining our short position. But clearly, if we're working with our prime broker and they know what they're doing, they're going to borrow shares for us, and they're going to lock up shares for us that they consider to be a good borrow and on not a short-term basis. If we have a concern that it's a very difficult to borrow name, and let's say they identify a certain amount of stock in one of their clients as willing to lend it on the borrow, we'll sometimes lock those shares up and actually enter into an agreement to maintain that short position, to maintain that borrow through the duration of the deal. Instead of earning a rebate, we end up paying a fee, and we'll agree to pay that for a period of 90 days, 120 days, or whatever. If we think the deal will last 120 days, we'll lock up the shares for 120 days. So there are ways to protect yourself, to protect your borrow and not get caught having to go into the marketplace and buy the shares because the borrow became too tight. So that's not typically a problem for us. Yeah. What types of deals do you find to be safer, such as large cap, small cap, all cash, stock for stock? Joe. There's no rhyme or reason. The better we understand the companies, the higher the comfort level we have with the way we think that deal will play out. But across the board, some big deals are going to run into antitrust, regulatory problems, or they're going to take longer to close. The longer it takes to close something, the more technology changes and the more the economy changes. Some utility deal that's announced today could close in 12 to 15 months. I don't know what's going to happen in the utility sector between now and then, so it's tough to go out that far in any deal. So timing is a factor. The quicker the deal, the more certainty we have that the deal will get done. Fewer things will happen along the way to interrupt it. The higher the quality of the companies, the larger the bet we're willing to take. So it's all about managing your risk. If I have a stronger comfort level with the intrinsic value of a target, I might take a bigger position, knowing that even if the deal were to break, my downside is limited. I may have more risk in a deal break of my short position going against me significantly. Another buyer may come in and make a bid for the acquirer, or maybe the acquirer's shares become severely depressed during the duration of the deal. If it were to walk away from the deal, maybe those shares will bounce back up to where they were prior to the deal. We're always examining where our risk lies. Is it on the target's shares or on the acquirer's shares? If it's a cash deal, I only have one side to worry about. But I may have financing to worry about at that point. Maybe it's a cash deal, with a condition on financing. Yeah. How did you fare during the 2002 market? How did you survive that? Joe. We survived by always anticipating the worst. We were nimble and small. We were in and out of deals in a heartbeat. If we got wind of bad news, we were out and we could get back into it the next day. There was so much volatility in the market in general that if we were quick and nimble enough in watching our positions, we could trade in and out of positions. Arbs, arbitrageurs, aren't always willing to stick their necks out and keep buying more and more, especially when there's a lot of volatility in the marketplace. If we see a spread go out from a $1 to $2, it's not going to be just a knee-jerk reaction to put some more into the portfolio. People want to know why it's out at $2. Maybe it's out just because of fundamental sellers of the target shares. There are not enough buyers among the ARB community to absorb that selling. It also could be that there are no more short notes, no more borrowing capability of the acquirer's shares, so ARBs can't put any more of it on. Because we can't get a borrow, spreads go all over the place for a number of reasons, especially in a volatile market. Is it an opportunity or a warning? That's the tough part. Trying to figure out if a widening spread is indicative of a problem or a potential opportunity coming your way. We tried to put stuff on when it widened and take it off when it narrowed, and we did that with enough frequency and stayed out of trouble. A lot of the deals were structured with pricing mechanisms. So as the acquirer's shares fell, we needed to have a greater short position. We needed to sell more to get their value. Or, you may have a static fixed ratio on an exchange. Maybe the acquirer's shares are between, let's say, $40 and $60, but they then fall below $40. You may be getting a different type of consideration on the deal. You may have to short more. So we try to anticipate that, and in 2001, 2002, and 2003, we tried to be a little bit proactive in the way we hedged. If we anticipate the worst case, the market looks heavy and fundamentals aren't really improv. The ARBs are going to have to keep shorting more stock as it drops. So let's get out in front of that selling and short early. Let's buy some puts early so we have an opportunity to exercise those puts, establish a short position if the shares do fall, and then leg in on the long side. We always wanted to be prepared for the downside in the 2001 and 2002. And even in the 2003 market. That insurance, putting structure in call Lars around your acquirer's shares by buying puts, selling calls, whatever, will typically cost you money. When you have as much volatility as we did in 2001 and 2002, it helped protect us. It gave us an additional hedge, and it allowed us to set up some deals at extremely wide rates of return. In 2003, it probably cost us a couple of % because we were so cautious. Yeah. Do you find that when an acquiring stock is starting to get near its floor, the bottom of the collar, there's a magnet effect? Joe. When the acquirer's shares begin to trade down toward the bottom of the collar, people worry that if it breaks through that, the deal could suddenly be off, and we're also going to have to short more stock. You're going to see ARBs panicking. Northrop fell through the bottom of its collar in one day. It traded between $105 and $130, which was the collar for 6 months of the TRW deal. Then, before that deal was closed, in the pricing period now, the stock opened down 15 points one day. Now it not only opened down 15 points, but it opened below the collar. So you had to be short that much more, and many ARBs were prepared for it. We kind of structured the deal. We put a collar on the shares. We bought the 95 put and we sold the 125 call to pay for it. Our risk came if it went well north of 125 because we're going to be short the 125 early. It didn't come to that. It broke through the bottom of the collar. We had our puts on, and we were set. We didn't lose money there. It actually gave us a chance to buy more TRW cheap. We hate to be in a position where we're panicking with the rest of the street. To the extent we can anticipate that or maybe be a little bit prepared, we're going to try to do that. It doesn't always work, but that's what we try to do. Yeah. It seems like as soon as a deal is announced, the entire merger arbitrage community gets in and the spreads go down to almost nothing. Very quickly. It sounds like you're able to overcome that by trading around the initial position like you did with JP Morgan and Bank One. But is that possible in general? Joe. In today's environment, spreads are really tight, and they typically get very tight very quickly. So how do we add value as managers in this space? We've got to look to add value by understanding what's actually happening in the transaction. If we want to take a directional bet, if we want to find another way to hedge other than by shorting stock, it's about being able to look at other ways to play the deal. Waiting for the right opportunity, just being patient, but it means you've got to monitor these things every day. On that one day when something gets out of whack because the market sells off or a fundamental seller comes in and knocks the spread open, you've got to be there. You've got to be ready to act, and you can't do that if you're not following the deal from day one or at least being on top of what's going on. It's tough to do that when you don't have a position to begin with. We have to add value by watching these spreads and deals constantly and by just sitting there waiting to pounce. This environment is really tough. With interest rates as low as they are, we have a lot of money in the space that has a low cost of capital, so they're able to put on deals with a very low rate of return and still make money. That won't always be the case. We've been through other cycles where it looks like spreads were lousy and then within a couple of years, they were back to pretty wide levels. We're very opportunistic. We're not just playing. If the spreads aren't there, then we're going to pass. Yeah. Do you ever use leverage to attempt to increase your returns? Joe. The Arbitrage Fund, which is a public mutual fund, doesn't utilize leverage. Many players out there do utilize leverage, but we don't. Yeah. Is that because of restrictions on mutual funds? Joe. Well, there are some restrictions in terms of our ability to leverage. But primarily, it's because we don't think it's a good practice, in a hedge fund or a privately managed account, if the clients are comfortable with that and we think that leverage makes sense, then we'll Take a look at it. We just don't do it in the public mutual fund. Yeah. Do you put most of your own personal money into the fund? Joe. Yes. Virtually all of my net worth is tied up in this business. Yeah. In 1998, Warren Buffett said that essentially, through using arbitrage, he feels it's possible to make 50% a year. This was roughly the quote. Do you think that statement still holds? Joe. Well, back in 98 and 99, the environment was one in which the spreads available in the marketplace, following deals, were mirroring the types of valuations that you were seeing in general in the market place. Market caps were inflated. Deal values were inflated. It was a buoyant, frothy market, and spreads reflected that. There were a number of reasons why spreads reflected that. But it was primarily because of the risks associated with the stocks you were buying back then. If you were involved in a deal between Tellabs and Sienna or JDS and Uniphase, these were multi-billion dollar deals with stock prices in the hundreds of dollars, and we know what happened in 2000 and 2001 when these stock prices came into something representing fair value. They plummeted by 90%, 80% or more. So, there were opportunities in 98 and 99, at the peak of the market in terms of valuation, to capture some enormous spreads. Those spreads were really out of whack. The market capital of those deals was far greater than the dollars pursuing merger arbitrage strategies at the time. Through the use of leverage, you could probably get a 30%, 40%, maybe even a 50% rate of return. But the risk you had to assume back in those days was enormous. Yeah. Since starting your firm, what would you say is the worst trade you have entered into? Joe. It's been in those deals that have fallen apart due to fundamental problems on the part of the target company. Yeah. What's a specific one? Joe. Well, we could talk about Cardinal Health making an acquisition of Syncor International. The deal was announced in June 2002, and I think the deal was scheduled to close in the mid-November time frame. In the first week of November 2002, the companies announced that the auditors, as part of their due diligence, had uncovered that bribes were paid out of the foreign subsidiaries of Syncor, so the deal was on hold. That's the kind of deal where you're caught completely off balance by some type of fraudulent activity on the part of the insiders of the target company. That leads to the transaction being put on hold pending an investigation, due diligence, legal settlements, what have you. In this case, while it was a short-term pickup for us in terms of impact on the portfolio, that deal eventually did close, and we were able to position ourselves to make money on this deal and to also increase our position. Yeah. So you didn't unwind your position when you heard that news? Joe. No, because by the time we heard the news, the stocks weren't even trading. The stocks will then open up reflecting a worst-case scenario. At that point, we go back to fundamental analysis. What is this company worth on a worst-case basis? If we're looking at a problem in the foreign subsidiaries and the wrongdoing has been limited to those foreign subsidiaries, then what's the value of the rest of the company, assuming we take a value of 0 for those foreign subsidiaries and assuming that there's some kind of penalty or fine that will result out of that wrongdoing, and we try to put a valuation on this company. Ultimately, we felt the two companies were committed to doing the deal. Regardless of the wrongdoing that took place, the wrong-doing and the dollars involved were small relative to the overall size of the deal. So our job at that point was to determine if Cardinal was going to go forward with this deal and whether it would change the terms. How would it possibly change those terms, and when would this deal close? Now we're going to have a new merger agreement and a new shareholder vote. There may be other issues that come into play. So you have a number of variables that you try to define, such as the extent of the wrongdoing, the fines involved, the extent of the investigation in terms of timing, and how the Justice Department, Securities and Exchange Commission and Cardinal Health will view the merger. You're looking at an opportunity for Cardinal to lower the price, substantially perhaps. So we take all that into consideration, all with an eye toward valuation. Ultimately we have to understand what we're owning, and we felt pretty comfortable, based on what the companies told us through their press release, on the phone, by talking to Cardinal Health, by speaking to lawyers, that the incidents involving foreign bribes had been confined to the Asian subsidiaries. That being the case, it made our job a lot easier. The more typical deals that fall apart are those in which the target company fails to meet its earnings or revenue estimates. That's going to happen now and again in many deals, but sometimes a company substantially underperforms, and a lot of times it's due to the fact that there's a deal on the table. There's a lot of disruption involved when a company is being bought out. Some customers will sit back and wait to see what happens. After the deal closes, employees may quit. Certain facets of the business may begin to suffer because of the disruptions associated with a corporate transaction. Most companies and most partners to a deal will account for that ahead of time. They anticipate there may be some slowdown on the part of customers. There may be some interruption in terms of all business because of a deal. But during the recessionary environment of 2001 and 2002, there were quite a few companies whose businesses just fell off a cliff because of the industries they operated in: telecom, technology, software, hardware. Some of those deals ran into big trouble. Yeah. When will you actually not do a deal? Let's say a deal is announced. When would you look at it and say, we're not going to get involved in that? That's too hairy. Joe. When we don't have any confidence in the buyer, number one. Also, when we don't have confidence that the financing, if there's financing involved, will be successfully obtained. When we view the target's business as being severely impaired and having a strong likelihood of not being able to go it as a standalone company. So for the most part, we're going to avoid certain distressed situations where we think our risk far outweighs the spread we could capture through setting the deal up. Yeah. What's an example that you didn't play right from the get-go? Joe. Well, there are a lot of small, tiny deals that we don't play. We look at them, but they're too illiquid. There's not enough of a spread there. And they're too numerous for me to name. But some of the higher profile deals may have a lot of potential risk for regulatory problems, such as Nestlé's and Dreyer's. We didn't play that deal for 9 months. We played in the last inning, after some turbulence came into the deal, once it began to become problematic. Due to antitrust issues, there are going to be deals and opportunities that we miss. But we've got to have a comfort level that what we're looking at makes sense from a risk-reward standpoint. Yeah. Do you ever give preference to all cash deals or all stock deals, or is there any type of deal that statistically you've found works out more than other types? Joe: not really. We tend to play wherever the deals are. The ratio of cash to stock deals is going to change, and there are many deals in which we're involved that have a component of cash and stock in the consideration. But no, there's no preference on our part. Yeah. Do you ever play relative value deals, like for instance, the POM 3Com arbitrage that occurred when POM was spun off? Joe: we'll look at spin-offs. I guess our presence in those types of transactions is going to be dictated by the valuation work we do. Deals for those types of transactions are a little tougher because you don't really have a defined return laid out for you, but we'll look at any type of corporate transaction if there's an opportunity. Yeah. Can the average investor do this? You have a full staff and have been doing this for many years. Can a retail investor make money playing the merger arbitrage game? Joe: yes, but on a very limited basis, I think. Certain deals will be conducive for individuals to get involved with. It may be a cash deal, it may be a straightforward stock-for-stock deal where they want to continue to own the shares that they acquire. Those individuals need the capability within their brokerage accounts to sell short, but they are unlikely able to capture a rebate on those short proceeds. Can they analyze the deals and be kept abreast of the regulatory issues that come during the duration of the deal? It's tough to do that on more than a limited basis if you're an individual watching positions in your account. You can pick and choose and then be very selective about how you play. A firm like ours has a much broader mandate in terms of the deals we play in our presence across a wide variety of deals, with a wide differentiation in terms of the types of deals, the risks associated with the deals, and the duration of those deals. It's just like any other type of portfolio. Some people feel they can manage their own, but they may not be as well diversified as a mutual fund that focuses on the same sector, and we stay pretty well hedged in the portfolio, and that may not be the case for individual investors who may decide that they like the combined entity and they're just going to stay long and not hedge. In that case, they're not really doing merger arbitrage. They're not really capturing a defined rate of return. They're just basically owning an acquirer's shares at a slight discount for when the deal will get done. I think there are people who are probably qualified to do it individually, but they are few and far between. They probably come out of this business and are basically managing their own portfolios going forward. But it's hard because there are so many moving pieces. If we have 50 or 60 deals on in the portfolio, we're watching another 50 or 60. Within those deals, there are all different terms, the tenures, the durations, the players, the issues, the risks. So there are a lot of things to watch. Chapter 6: Relative Value Arbitrage. Another type of arbitrage that both Buffett and his mentor Ben Graham specialized in was relative value arbitrage. This became a bread and butter part of Buffett's workout strategy. The idea of the relative value arbitrage is to buy an asset when it is convertible into other assets that have more value than it does. The most prominent example of the past few years is the case of POM Computing and 3Com. POM was a division of 3Com when 3Com decided to spin off POM's shares to the public. On the first day of trading, POM shares shot up so much that the stake that 3Com held in Palm was actually worth more than the market cap of 3Com. The market was effectively valuing 3Com's ongoing business at less than zero, business that had been around for 30 years and was immensely profitable. We will discuss this example in more detail later. Another example is from Benjamin Graham's first steps in this arena. In 1915, when Graham was working for Neuberger, Loeb and Company, he stumbled upon the following relative value arbitrage: Guggenheim Explo. Ration Company. The Guggenheim family, now known for its art museum in Manhattan, made most of its fortune by buying and developing mining properties. The Guggenheim Exploration Company was a holding company for many of the family's mining properties. On September 1, 1915, the company decided to dissolve and distribute the shares it held in other companies to its shareholders. On that day it was trading for $68.88. Graham added up the value of its holdings and came up with the table shown in Exhibit 6.1. So Graham figured that buying one share of Guggenheim would net him an arbitraged profit of $7.35. He bought up Guggenheim and sold short shares in the corresponding companies, locking in his profit. Another example occurred in the 1920s when DuPont, capitalizing on the cash it earned in its wartime successes, bought a large block of shares in General Motors. The market at that time, though, discounted DuPont's other businesses in the same way the market later discounted 3Com's Boosie Ness and valued DuPont shares only at the value of its GM shares, valuing DuPont's other businesses at zero. Graham was able to buy DuPont and short GM to capitalize on this spread. One can say, but all of this was 80 years ago. How can such an obvious example of information arbitrage, the idea that information is not received equally by all market participants, exist now, with the existence of the Internet, analysts, computers to analyze these situations, etc. And yet, we see from the first example, Palm and 3Com, that the situation was even more extreme. Buffett first dabbled in relative value arbitrage when he was working for Graham at the firm Graham-Newman. An amusing story about this is that Graham at first refused to hire Buffett because Buffett wasn't Jewish. Graham felt that Jews couldn't get jobs at the mostly waspish Wall Street. So he sought to counterbalance this by only hiring Jews. Buffett, not to be dissuaded, kept sending Graham ideas for stocks until Graham finally hired him. Graham called his results in arbitrage, Jewish treasury bills. When Buffett first came to Graham-Newman, he was 24 years old and raring to go. In the 1988 Berkshire Hathaway letter to investors, he discusses his first foray into arbitrage when he was working for Graham. Rockwood and Company was a modestly profitable maker of chocolate products that was sitting on an enormous supply of cocoa. In 1954 there was a shortage, and the price rocketed up. The company did not want to sell the cocoa outright because there would have been a tax consequence. A young investor by the name of J. Pritzker helped Rockwood and Company to use the 1954 tax code to its advantage. He pointed out a provision that said it could distribute the cocoa to shareholders without incurring the almost 50% tax liability if it were part of a restructuring that reduced the scope of its cocoa business. The company then offered to repurchase its shares in exchange for cocoa. As opposed to dollars, Buffett would buy shares on the open market, sell the shares to the company in exchange for cocoa, and then sell the cocoa for a nice profit. His only risk was that the price of cocoa would fall below the level he was paying for the shares, since he would attempt to do these sales as simultaneously as possible. His risk was negligible. So, again, that was then and this is now. Clearly such spreads wouldn't exist right now, right? But then again, let's look at the Palm 3Com example. March 2, 2000, only 8 days before the Nasdaq's all-time peak, as of this writing in January 2004, Palm went public, initially scheduled to go public in a range of $14 to $16 per share. Demand was so great that the shares priced at $38 per share. This translated to a huge cash bonanza for the company. On the first day of trading, the shares opened at $150, immediately traded as high as $165, before finally settling down and ending the day at $95.06. At this point, only 4% of the company was available to the trading public. 3Com, Nasdaq, Coms, still owned 95% of the company and was preparing to distribute 1.5 shares of Palm for every 1 share of Coms. If the only value of Coms had been its share of Palm, that would value each share of Coms at 1.5 times 95.06. In addition, Coms had approximately $10 per share in cash and it had zero debt, not to mention that Coms had an ongoing profitable business. So one would think that Coms now would be trading where? At least $152 per share, the value of Palm plus the value of its cash, or maybe $177 per share, since at least one analyst thought that its non-Palm assets. Source: Can the market add and subtract? Mispricing in tech stock carve-outs. By Owen A. Lamont and Richard H. Thaler, National Bureau of Economic Research and University of Chicago, Journal of Political Economy, Volume 3, Number 2. April 2003. Published by the University of Chicago. Were worth approximately $35. However, on the day of the IPO, Coms shares ended up at $81. This implied a spread of at least $60 between the value of the Palm shares and the value of the Coms shares, even if one valued all of Coms' other assets, cash in the bank plus a profitable BUSI NES, at zero. See Exhibit 6.2. The stub value. The market implied value of the 3Com assets minus its Palm shares, converged to zero, and finally above zero, by September of 2000 when 3Com finally spun out the shares to shareholders. This would have been an immensely profitable arbitrage. The difficulty in implementing it would have been in finding shares of Palm to short. Recent IPOs are often difficult to short. An example of such a trade where investors lost an immense amount of money occurred in early 2003 in Japan with the Ifuku Fund. A similar situation to the Palm-Com spread occurred when Nippon Telephone became severely undervalued compared to its Docomo subsidiary. The Ifuku Fund made a massive leveraged bet that the spread would close. Instead, the spread widened and within 7 days the fund lost over 90% of its value, closing down when Goldman Sachs took control and closed all of its positions. A similar situation occurred with Long-Term Capital Management (LCTM) and Royal Dutch Shell. Royal Dutch, which traded on the NYSE, and Shell, which traded on the London Stock Exchange, were actually the same company, formed in 1907 by a merger between Royal Dutch and Shell Transport. The split between the two was 60/40ths and should have traded. Accordingly, the value of Royal Dutch shares trading on the NYSE should be 1.5 times the value of the Shell shares trading on the LSE. Instead, the disparity is often much more. Richard Thaler provides Exhibit 6.3, which shows the disparity between the way the shares traded and the way they should have traded, the 60/40th split. In August 1998, this disparity reached an all-time high, precisely when long-term capital management was hanging on by a thread to this posy. Tion as well as many other arbitrage positions that were experiencing a similar widening. It is interesting that at this time, when LTCM was on the brink of losing its $3 billion fund, Buffett offered to pay approximately $100 million to take charge of its portfolio. They turned him down, but Buffett was definitely sniffing around for a good cause. Are we wasting our time, then? Do these situations happen on a regular basis, and, if they do happen, is it unusual for the results to pay off? Mark Mitchell, Todd Pulvino, and Eric Stafford examine every situation between 1985 and 2000 in which the market capitalization of a company traded for less than the sum of its parts. They note that there are two types of risk in this strategy. The first is fundamental risk, the risk that the shares of the two securities might never converge. The parent company, for instance, can go bankrupt, having used the value of shares in the spin-off as collateral before finally collapsing. The other type of risk to the arbitrager is financial risk, the risk that the securities might converge, but first they might diverge in such a way that substantial losses by the arbitrager are incurred, as happened in the LTCM and Ifuku cases above. Mitchell, Pulvino, and Stafford walk through the example of Creative Computers and Ubid. Ubid was an eBay-like auction site started by Creative Computers. Creative spun out 20% of Ubid to the public on December 4, 1998. Like all good.com stocks at that time, Ubid shares began trading in a frenzy, and at the end of the first day of trading after the IPO, UBID shares were trading at a market capitalization of $439 million, making the 80% that Creative Computers still held in UBID worth approximately $80 million more than the entire market capitalization of Creative. The authors go on to assume that an arbitrager would have waited 4 days before trying to play the spread due to the lack of short 126 trade like Warren Buffett. 1. Limited Arbitrage in Equity Markets, by Mark Mitchell, Todd Pulvino, and Eric Stafford, Journal of Finance, April 2001. Able shares in Ubid immediately after the IPO. On the fourth day, the value of the stub value had increased from -$80 million to -$28 million. Attempting to capitalize on this spread, an arbitrager would have shorted 0.72 shares of UBID for every 1 share of Creative Computers. Assuming that Creative was going to spin out the shares to shareholders within 6 months of the IPO, the return to the arbitrager would have been approximately 45%. However, within a few weeks the value of the stub would have decreased from $-28 million to less than $-700 million. The losses sustained by an arbitrager would have been close to 100% assuming the arbitrager met all of the margin calls, as detailed in Exhibit 6.4. Although the prices eventually did converge, the roller coaster was too painful for any investor to handle. The authors assume that all margin calls are met, they assume transaction costs, and they also limit the initial investment in any one deal to 20% of total equity. Additionally, they assume short rebates of 3% a year, where the cash they make from selling the shares they borrow yields interest. Exhibit 6.5 demonstrates their results. The strategy of playing the spread between a parent and subsidiary resulted in an average return of 22% per year between 1986 and 2000. Chapter 7: Pipes and High Yield. Obviously, not every technique that Buffett has used to trade can be used by the average investor or trader. Some of the techniques he used in the 1960s and 1950s, like driving around putting up signs for people to sell him shares in specific cigar butt companies, do not apply to today's internet-driven world. What is important is to identify the common thread that drives each of his investment decisions: the quest for a margin of safety in each trading strategy. Again, this is not margin of safety in the Graham-Dodd sense of buying a company at 2/3 its liquidation value, but the idea of making a trade or investment where you have multiple reasons, hopefully uncorrelated reasons, to believe that the investment will not lose money. For example, in Chapter 5 I discussed the Arcata deal where KKR had an offer to buy the company. Buffett was buying shares of Arcata because he believed the deal would be consummated. However, the key is that Buffett also went through the exercise of asking, if this deal never happens, can I get out of these shares with a profit? At that point, he also analyzed the liquidation value of the company and determined that the exit, while probably slightly longer off, would still result in a profitable trade for him. In other words, he had an out, a backdoor exit available to him just in case the front door exit he had planned for did not work. It is this that sums up Buffett's margin of safety in every case. The use of private investments in public equities, pipes, is a technique that Buffett often exploits to get his hoped-for margin of safety, but this is not necessarily a technique available to the average investor. A public company typically goes the pipe route when other avenues for raising capital are closed off. Normally, a public company that needs to raise money either does a secondary offering or a debt offering. In other words, the company can hire an investment bank like Goldman Sachs or Morgan Stanley. They put together an offering memorandum explaining the risks and the possible benefits in investing in their company, and then they go on the road, meeting investors who might be interested in their offering. Typically, a secondary offering is at a slight discount to wherever the stock is then trading, in order to give the secondary investors an added advantage to purchasing the secondary instead of simply buying the shares on the open market. Additionally, the common stock of a company usually suffers in both a secondary stock offering and a debt offering. When there is a secondary, current shareholders of the company know that they are about to be diluted and that each stock is therefore worth less. Both Dahlia Marshakadite 1 and Mickelson and Parch 2 conclude that immediately after a secondary offering, the stock price tends to decline. Perhaps shareholders are worried about the effects of dilution. Or perhaps shareholders wonder why management chose this time to sell off common stock. In other words, did management view the stock as overvalued? So, like any investor with enormous information about a company's prospects, it made an investment decision. Similarly, after a debt offering, common stock tends to sell off, as well, as many of the recipients of the new debt now hedge their bets by shorting the stock. Additionally, the costs of a secondary are not trivial. The bank takes its fees, which could be as high as 6 or 7%. In addition, the SEC requires various filings to register the shares in advance, which also 1. Investor behavior and the timing of secondary equity offerings. Dahlia Marcia. KT, Louisiana Tech University Working Paper, 2002. 2. Study price effects of secondary distribution. Mickelson and Parch, JFE, 1985. Telegraphs to the public at large that a secondary is looming, causing perhaps an initial sell-off in shares. For these reasons, many companies opt to go immediately into the PIPE route, selling shares directly to private investors without having to take the secondary route. In many cases, this avoids the costs associated with hiring an investment bank to manage a secondary offering. Also, smaller companies or companies deeply in distress may not be able to hire an investment bank to take them through the ropes of a secondary. The typical PIPE comes in one of two flavors: common stock, with a warrants kicker, or debt, usually convertible. A common stock PIPE might work as follows. Company XYZ is trading at $10 a share and needs to raise $4 million. It sells 500,000 shares at $8 a share, a 20% discount, and for every 10 shares of stock an investor buys, he or she also receives 4 warrants with a strike price of $12 a share. 40% warrant coverage at a 20% premium strike price, TIPI. Cali. The shares cannot be sold immediately, but only after a waiting period, usually anywhere from 3 months to 1 year. The investor in such a PIPE can justify his margin of safety in 2 primary ways. 1. The 20% discount. If not specified in the agreement, a PIPE investor can hedge his shares by immediately shorting at $10, locking in the $2 spread. Since he owns at $8, however, usually the PIPE agreement will specifically state that no hedging is allowed. Also, the shares might not be liquid enough for such a hedge. 2. With luck, the share purchaser was attracted to other aspects of the deal beyond the 20% discount. If the company is a legit I-mate investment, then the buyer of the PIPE shares just received a great bargain compared to the common stockholder. If the stock goes up, not only does the PIPE investor benefit from the 20% discount, but also the warrants. From January 1, 2004 to May 1, 2004, there were 436 examples of PIPE deals involving common stock, according to PrivateRaise.com. These deals added up to $5.1 billion in investments. Most, 298, of these deals were on companies with a market capitalization less than $100 million, so they were mostly micro-cap companies. For example, on April 29, 2004, Capital Title Group, NASDAQ SC, CTGI, announced it raised $10.1 million at an average price of $3.60 a share. The day before, the stock had closed at $4.20. Additionally, the purchasers of the $2.8 million shares at $3.60 were granted warrants that gave them the right to buy at any point over the next 5 years 889,252 shares of common stock at an exercise price of $4 per share. The other type of PIPE deal is a private offering of debt that later converts to equity. This can take a wide variety of forms, but it usually involves a fairly high interest rate and an attractive conversion price that is somewhere near where the stock is currently trading. If the debt holder never converts, then he or she benefits from the high yield. If the stock goes up,
the debt holder can benefit by converting to common stock at a much
lower stock price and reaping the benefits of the capital gain. Convertible pipes became notorious in the late 1990s when many technology companies, desperate for cash as the bubble began to burst, offered what became known as death spiral convertibles, or toxic convertibles. These were debt offerings that converted whenever the debt holder wanted, at whatever the stock happened to be trading at, no matter how low. The result was that many investors in these pipes would immediately begin shorting the stock as soon as they took hold of the convertible, in order to drive down the price of the stock as low as possible. While this was usually a rare and unpleasant form of pipe, which ultimately resulted in bankruptcies and lawsuits, this practice gave the pipe offering a bad name. Although Buffett has never engaged in these death spiral convertibles or anything remotely close, he has been an active investor in distressed companies through the use of pipes. In some cases, as with Solomon and Champion, Buffett has been approached by management to be a white knight, so that the company could avoid the grasp of an unwelcome suitor. Such knighthood carried its cost for the company, and Buffett was often granted favorable terms through the use of a pipe. In other cases, Buffett has been an investor in distressed companies, usually securing generous terms with companies in dire straits. In addition to the terms of the offering, Buffett would often achieve his margin of safety by having the offering backed up by significant assets, as in the case of Williams Company, which we will examine later. Gillette, July 1989. There has been a lot of analysis of Buffett's core holdings in companies such as Gillette and Coca-Cola. These are great brands, they have consistent earnings, and their stock prices have gone up enormously since Buffett bought them. In hindsight, they seem like no-brainers. Why didn't everyone buy these stocks? Things were definitely not so simple in the late 1980s when Buffett decided to purchase a stake in Gillette. The company, founded in 1923 by King Gillette, was being stalked by disposable blade inventor Bic. Gillette was surprised by the strength of public demand for the low-margin disposable razors, which quickly grabbed up to 50% of the razor market. Although return on equity was incredibly stable and the company was still growing, Gillette was no longer achieving a growth rate attractive enough for institutions. In addition, the stock price was faltering. Sales were growing at a meager 1% a year. In addition, the company had to increase its debt load to fight off 4 different takeover attempts. This is not normally thought of as the typical Buffett investment. In July 1989, Buffett contacted the CEO, Coleman Mockler, and worked out an arrangement whereby he received $600 million in convertible preferred stock yielding 8.75% a year for 10 years and convertible into common stock at a conversion price of $50 a share. The stock was then trading at $40, but had been rising pretty steadily in the 1980s until about a year or so earlier, when it had flattened out along with its sales and margins. See Exhibit 7.1. In February 1991, Buffett was able to convert into common stock when Gillette was trading at $73 per share, for a 45% profit on his original investment, not counting dividends. Much has been written on Gillette's value to Buffett as an equity investment over the years, but it is interesting to note that it did not start that way. However, the pipe that Buffett did enabled him to essentially have a free ride on Gillette. The one thing that Buffett knew, based on the company's 60-year earnings history, was that Gillette would not go out of business. In other words, he was going to get his 8.75% yield no matter how badly margins got squeezed by disposable razors. He also knew that given the strong brand of Gillette, it would take a lot longer than 10 years, the life of the bond, for anyone to knock Gillette off its pedestal, even if it were attacked on all sides. In other words, Buffett had a free ticket to watch the show in the cut-throat razor blade business while getting his 8.75% coupon no matter what. He could simply wait for the right moment, should it come, to convert at an enormous profit. He did exactly that. For a detailed analysis of Gillette as an equity investment at the time that Buffett did his conversion, I highly recommend Hagstrom's book, The Warren Buffett Way. Solomon Incorporated. Solomon is another company that definitely did not fit Buffett's style. Investment banks are subject to the whims of their times, and very few banks achieve the type of moat status that Buffett covets. Also, investment banks go in and out of favor depending on the market. If the market is down, mergers and acquisitions, M&A, are less frequent. Alternately, IPOs are less frequent, and investment banks earn less money in fees. During those periods, investment banks are dependent on their proprietary trading, which Solomon at that time was well known for, particularly their bond trading group as made famous by Michael Lewis in his classic book, Liar's Poker. Point 3. However, despite Solomon's acumen as a money raiser or as a trading operation, these were not revenues or earnings that could be considered predictable. Nevertheless, Buffett had worked with John Gutfreund, the CEO of Solomon, in the past, most particularly when Buffett took over Geico in 1976, when corporate raider Ron Perelman was stalking the company. Gutfreund called Buffett and made a deal. In 1987, Buffett bought $700 million worth of convertible preferred stock, paying a 9% annual dividend. The preferred would be redeemed over a 5-year period beginning in October 1995. Meanwhile, the preferred stock could also be converted into common stock at a price of $38 per share, with the common at that moment trading at $33. If the stock went up from $33, Buffett would be very happy because he would get the full appreciation of any price move above $38. However, the market crashed a month after Buffett did the pipe, causing Solomon stock to sink to $16. Was Buffett worried? Not at all. As far as He was concerned. At that point he had a very solid bond paying 9% per annum. In other words, he had a free ride on the company. The story would have a pleasant ending if that was all there was to it. However, the Salomon preferred stock almost became Buffett's most costly mistake ever. On August 16, 1991, Salomon announced, with the stock just pennies from Buffett's $38 strike price, that the company had violated U.S. Treasury rules involving the government bond auctions and that all of the top officers were resigning. What happened afterward has been written about in numerous places. Lowenstein 4 and Hagstrom 5 document the incident thoroughly. Buffett basically took control of the company and cleaned house. He fired everyone involved with the scandal, pleaded successfully with the government. Pipes and high-yield 135 Three Liars Poker. Michael Lewis, Penguin Books, 1990. 4 Buffett. The Making of an American Capitalist. Roger Lowenstein, Random House, 1995. 5 The Warren Buffett Way, by Robert G. Hagstrom, John Wiley & Sons, 1994. To be mild in any penal suspensions of trading activity, and guided the company back on course. Suffice it to say, Buffett made money on his investment, both in his steady 9% annual return on the dividend, and from the eventual conversion of portions of his preferred stock into common once Salomon eventually traded above the conversion price of $38 in 1993. Again, this is an example where if it were not for the PIPE investment, it is unlikely that Buffett would have been a buyer of common stock shares of Salomon in 1987. But the PIPE allowed him to get a free ride while at the same time getting a very respectable dividend. This provided a considerable margin of safety, making up for the fact that the economics of the business might not have fit Buffett's sweet spot. Champion International. Another similar PIPE deal was Buffett's 1989 arrangement with Champion International. He bought $300 million worth of convertible preferreds paying a 9.25% interest rate and convertible into common stock at $38 per share when it was trading at $30. The company had almost nothing going for it. Return on equity was a meager 7%. The company had a very erratic earnings history and no real growth to speak of. That said, there were several million acres of timber on the books that nobody knew how to value. Buffett knew that. During the 10-year holding period of the bonds he would get his 9.25% interest rate. In the worst-case scenario, the company could just sell off more timber to pay the coupon. On top of that, timber was a useful hedge against inflation. And, finally, if the company had a turnaround or was able to liquidate the timber, then the shares would substantially appreciate. Buffett was able to cash out his converted shares at a profit within 5 years. All of these PIPE deals from the late 1980s were interesting in that they are often used, particularly Gillette, to describe the features Buffett looks for in an equity investment. It is true that they each became equity investments once Buffett converted his shares, but he essentially got a free look, or a lottery ticket, as Roger Lowenstein describes it in his biography of Buffett. Buffett was able to enjoy the benefits of the bond, which required a different level of due diligence than doing an equity investment, and then ride the capital gains later as the stocks all went up. Even though in the case of Salomon, he became perilously close to losing his investment, in the October 1997 Eddie Tion of Fortune, Buffett said about the Solomon investment, "I'd say we hit a scratch single, but not before the count got to 0 and 2. At the time of these transactions, Buffett and the companies involved were criticized. The complaint was that Buffett was getting a sweetheart deal at the time unavailable to other investors. This criticism is true and the action is hard to defend. However, the rationale was that Buffett's playing the role of white knight saved the shareholders from whatever horror would have resulted had the company been taken over by hostile raiders or incapable management, and Buffett's abilities in a clutch situation were certainly demonstrated when he saved Solomon from almost certain bankruptcy during its 1991 troubles. In the post-bubble downturn of 2000 to 2002, Buffett again engaged in several PIPE transactions. Level 3 Communications. Level 3 Communications, Figure 7.2, was a surprise investment. Just as an aside, it reminded me of the Fischer-Spassky chess match in 1972. Bobby Fischer was a rather eccentric chess grandmaster who became the first post-war American to challenge the Russians in the World Championship. He also was notorious for only liking one first move, moving his king-pawn 2 squares. Anyone who prepared for Fischer only needed to study this move, because he had stated repeatedly that this is the only first move worth playing. Hence, it came as an unbelievable shock when he played his queen-pawn as the opening move in the middle of the match. Buffett pulled a similar maneuver in July of 2002 when he made a private investment in Level 3 Communications, a provider of broadband services. Level 3 was a bubble stock founded by Buffett's good friend and Berkshire director, Walter Scott. In early 2000, Level 3 shares were worth over $100 per share. It was around this time that Buffett was getting the most criticism for not investing in technology. He was getting grief on 2 levels. 1. Many investors were patting themselves on the backs for beating out the world's greatest investor when they loaded up the boat on tech stocks in 1999 and 2000. Buffett certainly missed an incredible move up in the Nasdaq during this period. 2. Was Buffett going a little too far in not investing in technology? Was he ignoring the American dream of constant exploration and conquest, now expanding not only in land and industry, but also through the cyber depths of the Internet? To Buffett's credit, he remained consistent and stuck to his investment philosophy of waiting for a margin of safety. For Buffett, buying Level 3 on the open market at $100 a share did not give him his margin of safety. But on July 8, 2002, when it was announced that Buffett, along with several other investors, had bought $500 million of Level 3 convertible preferred in a private placement, things were different. For one thing, Level 3 was now trading at $2.89, a greater than 95% fall from its peak. Second, the preferred was going to pay a 9% dividend and was going to be redeemed within 10 years. Buffett felt that the company had sufficient assets to at least pay him his coupon over the next several years. It had $1.5 billion in cash and a 20,000-mile network that could always be sold off in a worst-case scenario. Finally, the shares were convertible at a very reasonable $3.41 per share. The news of Buffett's investment was surprising enough to send the Shares up to $4.26 per share the day the deal was announced, putting Buffett's shares already 50% in the money. By the time Buffett had liquidated 95% of his investment in November 2003, he had made 95% on his money. As of this writing in October 2004, the shares of Level 3 are back down to $3.71. Note that these were not distressed bonds that Buffett was snapping up at a discount, an activity in which other investors and traders often engage. This investment in Level 3 was specifically a deal engineered in part by Buffett's friend and partner, Walter Scott, who was running the show at Level 3. Again, this is not a criticism of the approach. Buffett has built his career on the fact that opportunities come knocking on his door rather than the other way around. However, it makes the challenge of trading or investing like Buffett that much more difficult. Buffett would not have bought common stock shares of Level 3 without having that dividend kicker to give him his free ride, not even at the low price of $2.89. And once he did convert to common stock, he was mostly a seller rather than a holder. Nor was there any way to buy the distressed debt of LVLT at that time. The company did not have any debt with those specific terms, nor was its debt as distressed as that of many of its peers due to its strong balance sheet, an aspect that I'm sure gave Buffett his margin of safety in the investment. For one thing, Level 3 was now trading at $2.89, a greater than 95% fall from its peak. Second, the preferred was going to pay a 9% dividend and was going to be redeemed within 10 years. Buffett felt that the company had sufficient assets to at least pay him his coupon over the next several years. It had $1.5 billion in cash and a 20,000-mile network that could always be sold off in a worst-case scenario. Finally, the shares were convertible at a very reasonable $3.41 per share. The news of Buffett's investment was surprising enough to send the shares up to $4.26 per share the day the deal was announced, putting Buffett's shares already 50% in the money. By the time Buffett had liquidated 95% of his investment in November 2003, he had made 95%. Williams Companies. Williams Companies was another recipient of PIPE financing by Buffett. In March 2002, the entire energy industry was in a death spiral due to the collapse of Enron. Energy companies were all being quarantined by the banks in a vicious epidemic of Enronitis. In other words, all of the energy companies were having difficulty getting financing and were quickly selling off assets to stave off bankruptcy. It was at this time that Buffett entered the picture through his Mid-American Pipeline subsidiary. In March 2002, he purchased $275 million of convertible preferred stock directly from Williams. The preferred paid a 9.875% dividend per year and was convertible into stock at $18 per share. The stock instantly jumped from between $16 and $17 to over $20. However, this rise was short-lived as the company continued to report losses and the stock eventually slid below $1. At this time, August 2002, Buffett partook IPATED in a group loan to Williams for another $1.17 billion, this time secured by substantially all of Williams's oil and gas assets. Less than 1 year later, Williams was back on its feet enough, and the Banks were starting to do energy financing again, so that it was able to redeem both of these loans at a nice profit for Buffett. See Exhibit 7.3. While it is difficult, if not impossible, for the average investor to find himself or herself a group of good pipe deals to enter into, there are several key lessons to take away from this chapter. When examining Buffett's past equity holdings, it is always worthwhile to understand how he came to hold those equities and what was involved in the investment decision. It is one thing if he bought common stock on the open market. It is another if he was able to convert to those shares after enjoying several years of 9% dividends. At low risk, Buffett looks at the notion of margin of safety not only in the fundamentals of the underlying equity, but in the structure of the transaction itself. Not every investor can do this, of course, but it is important to realize that having more than one back door in a strategy is an important exercise. Always ask yourself what your recourse will be if your initial plan for a stock purchase or a trade of any sort does not work out. While it might not be possible to get the specific piped deals that Buffett has gotten, it is interesting to note that Buffett took the two absolute worst industries, broadband telecom and independent power producers, and plowed money into them. He did this not with common stocks, but into more senior levels of the capital structure. If an investor did not have access to pipes but did buy senior level bonds in a basket of telecom and energy companies during these periods, he or she would have done very well. Chapter 8. Junk. When businesses need to raise money, they can do so in two ways. Assuming that raising money through profits is not possible, they can sell off equity, for instance, in an IPO or a secondary offering, or a PIPE transaction, or they can borrow money by selling bonds. The interest rate on the bond is determined by a variety of factors, the most important two being what the federally imposed discount rate is, and what rating the ratings agencies such as Moody's and Standard & Poor's have assigned the company. The discount rate is important for the following reason. If I can get a yield of, say, 5% from treasuries and I know this is risk-free unless the government defaults, then a corporation with presumably more risk than the U.S. government better be paying me substantially more than 5% for me to take on that risk. The rating from the ratings agencies is also fairly important. Moody's and Standard & Poor's, in general, do enough due diligence on every company in order to determine the relative safety between the bonds of different corporations. If a company is rated AAA, for example, Berkshire Hathaway, then I have a high degree of comfort that I will be paid back if I loan them money. Hence, when Berkshire Hathaway issued its Squares bonds in May 2002, it actually had a negative yield. The yield was a function of the historic lows on federal interest rates. The extreme safety of Berkshire is determined by the ratings agencies, and the fact that the bond was actually a convertible, so it had extra features other than the yield. This bond is the first, and at the time of this writing, the only example of a bond with a negative yield. If a company is rated in junk territory, B- or below, then the interest rate needs to be high enough to compensate the bond holder for that additional risk. Although bonds are rated by the agencies, once they are issued, the market sets the price and yield. As with any other securities, the twin forces of greed and fear in the bond market will often send prices to one extreme or Other. In 2002, for instance, after the bankruptcy of Enron, many of its bonds went straight to zero. As a result, many investors had no idea what shoe would drop next and ended up selling the corporate bonds of many energy companies en masse, even somewhat stable ones. Similarly, when the prices of internet stocks were falling up to 99%, the bonds also were in a free fall and some corporate debt was yielding up to 20% or more. When Buffett analyzes junk bonds, he doesn't care as much if the company has a stable and consistent ROE or earnings. All he wants to know is, can the company generate enough cash to pay him back? In the 2002 annual Berkshire Hathaway letter, Buffett comments, "Junk bonds are not, we should emphasize, suitable investments for the general public, because too often these securities live up to their name. We have never purchased a newly issued junk bond, which is the only kind most investors are urged to buy when losses occur in this field. Furthermore, they are often disastrous. Many issues end up a small fraction of their original offering price and some become entirely worthless." There are a couple of interesting points in these 4 sentences. First, often these securities live up to their name. In other words, the market is usually efficient. If the market is telling us that these bonds are junk, then chances are they are junk. This is not to say that they will not pay their exorbitant yields, but the risk is commensurate with the payoff and there is no additional margin of safety. Furthermore, the fact that Buffett has never purchased a newly issued junk bond is telling. Many people do purchase such issues. In fact, Wall Street would almost cease to exist if people stopped purchasing such issues. But Buffett has determined there is essentially zero edge to buying into an issue that Wall Street right from the start is labeling as distressed enough to be paying a junk rate, yet in demand enough that many investors are clamoring to pay those rates. Chances are, he figures, the rates are not high enough at the moment of issuance and he would prefer to wait. However, Buffett goes on to say in the same annual letter, despite these dangers, we periodically find a very few, junk securities that are interesting to us. And, so far, our 50-year experience in distressed debt has proven rewarding. There is an important reason why it is only the very few that appeal to Buffett. A bond, unlike a growing company, has a maximum value it can return to the investor, the face value plus all of the coupons of the bond. A business, on the other hand, can keep growing forever. There is no cap on the maximum return of a business. Nevertheless, in extreme cases, the returns of a bond can exceed the hoped-for returns, in the short term, of even the best businesses. For instance, in 1983, the Washington Public Power Supply System (WPPSS) was involved in 5 building projects. 2 of these, Projects 4 and 5, were building nuclear reactors. It was these projects that turned into a $2.25 billion default for WPPSS when it had to abandon the projects after a state ruling that threw into question who would pay for the energy that is produced if it is no longer needed. However, although Projects 1, 2, and 3 had material differences in the obligers, promises, and properties underlying the 2 categories of bonds, the problems of Projects 4 and 5 have cast a major cloud over Projects 1, 2, and 3 inches, from the Berkshire Hathaway 1984 annual letter. This cloud sent the bonds issued to pay for these projects down to 40 cents on the dollar and yielding an average of 16%. Buffett bought $139 million of the bonds. The question was, is the potential reward worth the risk inherent in buying $139 million of the bonds? Buffett knew that there is a ceiling to the amount he could get back. The coupons plus the initial face value of the bonds. Buffett also realized that these bonds might be worth zero if he did not analyze the risks of the defaults on projects 4 and 5 carefully enough. Would it be better, for instance, for him to buy a business for $139 million? However, he states, in the case of WPPSS, the business contractually earns $22.70 million after tax, via the interest paid on the bonds, and those earnings are available to us currently in cash. We are unable to buy operating businesses with economics close to these. Only a relatively few businesses earn the 16.3% after tax on unleveraged capital that are WPPSS investment does, and those businesses, when available for purchase, sell at large premiums to that capital. Viewing the investment in the context of, should I buy a bond or an operating business, allows the investor to avoid many mistakes that bond investors have made in the past. Buffett points out the example of AAA tax exempt bonds in 1946. In effect, the buyer of those bonds at that time bought a business that earned about 1% on book value, and that, moreover, could never earn a dime more than 1% on book, and paid 100 cents on the dollar for that abominable business. This was during a period of substantial post-war growth when businesses were earning up to 15% on their book value. Additionally, in that 1984 letter to Berkshire shareholders, Buffett stated another interesting factor in his decision on the WPPSS bonds. He noted that these bonds were not long-term, and the risk of runaway inflation in the future makes him hesitant to ever purchase a long-term bond. This theme remained with Buffett until the present day, when the fear of inflation has even compelled him to make, for the first time ever, substantial investments in foreign currencies. There is a similarity between the WPPSS bonds and the next junk bonds that Buffett mentions in his annual letters, the RJR Nabisco bonds. In both cases, the sell-off on the bonds was not directly related to faltering economics in the business. RJR Nabisco was the target in the famous takeover engineered by leverage buyout shop KKR and made famous in the book and subsequent movie, Barbarians at the Gates. In order to pay for the takeover, KKR had to issue junk bonds backed up by RJR's cash flow. If KKR had made a mistake in how they valued the cash flows prior to the takeover, or the business faltered for whatever reason, then the potential for full payment on those junk bonds could become suspect. However, RJR was performing fine as a business. The real issue was the blow-up in general of the high-yield market. With the demise of Michael Milken and Drexel, the credibility of all high-yield bonds came into question. And for good reason, as Buffett noted in the 1990 letter to Berkshire Hathaway shareholders. In some cases, so much debt was issued that even highly favorable business results could not produce the funds to service it. One particularly egregious, kill 'em at birth, case a few years back involved The purchase of a mature television station in Tampa, bought with so much debt that the interest on it exceeded the station's gross rev. News. Even if you assume that all labor, programs, and services were donated rather than purchased, this capital structure required revenues to explode, or else the station was doomed to go broke. With issuances like that, which were being quickly bought up and devoured by savings and loans institutions that would soon be bankrupt, it is no wonder that investors decided to throw out the baby with the bathwater. Tear and sell off all high-yield instruments they could find in their portfolios. This explains the sell-off in RJR bonds. Buffett, having dealt with KKR before, see the Arcata example in Chapter 5 on merger arbitrage, determined that the cash flows on RJR were sufficient to pay off the bonds and bought up to $440 million of the bonds during late 1989. In 1991, RJR announced that it was retiring the bonds and paid off the full face value of the bonds, rendering Berkshire a healthy profit of $150 million. As seen in Chapter 7, Buffett's interest in high yield extended to not only purchasing discounted bonds on the open market, but buying them in the form of convertible preferreds directly from the company. This gave him the added 1-2 punch of getting not only the benefits of the high yield, but removing the problem of having the ceiling on his potential return by allowing him to convert into equity at a later date. In the tech and energy company sell-off of 2001 and 2002, Buffett again dipped into the high-yield market on several occasions. For instance, in late 2002, Buffett began buying up debt in telecom company Nextel. Nextel's stock had fallen 95% from its peak in 2000 to its low in 2002. In 2002, it was even flirting with possible bankruptcy. In response, it used cash flow to retire up to $3.2 billion in debt and slashed 5,300 jobs in an attempt to cut costs. For 2002, Nextel posted a $1.4 billion profit, its first profit in 15 years. However, the combination of the recession and Nextel's prior problems still had the rating agencies ranking the company's debt as junk. In this environment, when interest rates were also being cut down to 50-year lows, Buffett was able to buy up $500 million of Nextel's bonds. In early 2003, the markets were reeling in anticipation of the war in Iraq and the uncertainty that would come with it. At the same time, Buffett was coolly buying $100 million worth of Amazon.com bonds yielding 10% in anticipation that they would be called back by the company within a month. With the $1.3 billion in cash and marketable securities that the company had on hand, the company did redeem the bonds, giving Buffett a 22% annualized return for his efforts at relatively low risk.
Chapter 9 Warren Buffett's personal holdings. Most people think of Warren Buffett and Berkshire Hathaway as
the same entity, and this is not unreasonable. The fortunes of both have been inextricably linked since Buffett took financial control of the company in 1965 and became the full-time chairman and CEO in 1968. However, Buffett does occasionally make stock trades outside of the context of his role as chief asset allocator of Berkshire. These are particularly interesting to look at for three reasons. 1. At Berkshire he has to be able to allocate over $30 billion. Many good investments or trades are not appropriate for a cash portfolio of this Size simply because they are too small. Buffett probably takes the best of these small investments and does them for his own portfolio when they are not appropriate for the Berkshire portfolio. 2. At Berkshire, Buffett has more often than not gone the Fisher, Munger route of paying up, for good, growing companies that might be trading higher than book value, or in some cases, higher than their intrinsic value. Many of these investments have worked out quite well. Coca-Cola and Gillette come to mind, and more recently PetroChina, but they are not the classic Graham-Dodd investments that Buffett was schooled on. In his personal portfolio, Buffett has more often gone
back to his roots and picked companies that were trading below book,
or even liquidating their assets. These are cigar butts that Buffett felt obligated to pick up off the ground and smoke one more time. 3. The picks in his personal portfolio are more reminiscent of the types of trades he would do in his hedge fund. He did work out situations that
in many years resulted in up to 50% of the profits or more for
that year. For all of these trades, it is impossible to know the full details of the trade. Buffett never talks about them and is only obligated to file his own ownership when it exceeds 5% of the company. However, we can still pick through the filings and the news reports on the companies and try to examine what happened, when, and why. Laser Mortgage. Laser Mortgage was a mortgage-backed real estate investment trust, right? That quickly got into trouble in 1999 and 2000 when interest rates spiked up. They used heavy leverage and made very concentrated bets that fired horribly when mortgage lenders defaulted on them, causing them to mark down book value significantly. Because of these defaults and mark downs, investors lost faith in management's ability to correctly value its
portfolio and the stock soon plunged below book. In October 2000, the
management threw up its hands and announced it was looking into a possible liquidation of its portfolio and ultimate distribution of proceeds to the shareholders. Buffett began acquiring stock most likely in early 2000 when the stock was trading around $4 and book value was around $4.51. On April 13, 2001, Buffett filed a Schedule 13G filing with the SEC stating that he owned 979,000 shares, or about 6.98% of the company. On April 25, 2001, the Laser Mortgage Board of Directors approved the liquidation and dissolution of the company, immediately approving an initial distribution of $3 per share. In 2003, they made another distribution of 50 cents and on July 5, 2004, they made a final distribution of 0.86 and closed the doors. JDN Realty. JDN Realty was a real estate investment trust that owned 15 million square feet of shopping centers. For each shopping center, the company attempted to anchor the shopping center with a value tenant such as Walmart or Lowe's, who were its two biggest tenants. The company reported steady results until 1999 when they announced they had to restate their prior 5 years' worth of earnings. The management team was hiding executive compensation by not properly reporting related party transactions, detailing up to $5 million. The stock crashed from high to low over 50% and the lawsuits started flying. However, the value of JDN's real estate did not change at all. Both Walmart and Lowe's reaffirmed that they were going to remain tenants of JDN Properties. when the company began trading below its book value. Stepped Buffett. His first filing was in April 2000, when he reported that he owned 1.7 million shares. This was followed by a later filing in February of 2001 where he announced he was up to 2.5 million shares. In Q1 of 2003, JDN merged with DDR Realty for $13 per share. Tanger Factory Outlet Centers. Without getting into the discussion of whether the Internet created a BLE, the technology certainly consumed the public imagination in a way not seen since the advent of the printing press. Rights involved in the development of shopping malls were particularly hurt because of the belief that shopping would soon be dead except through e-commerce. Tanger develops factory outlet centers, and shares were decreasing in direct proportion to the Internet index increases. People assumed that factory outlets were no longer necessary since they could now buy everything they needed from the comfort of their living room. The millennia-old technique of trying on clothes before buying them was deemed no longer necessary. By March of 1999, the company was trading at a 27% discount to its net asset value, much lower than that of its peers. Additionally, the company was yielding a 12% dividend and steadily increasing the dividend, and it wasn't in danger of overdeveloping like many rights do during boom times, since Tanger pre-leases every space before it begins the development of a new strip mall. In April of 1999, Buffett bought 5% of the company, eventually increasing his stake to more than 13% by 2000 and then reducing his stake to below 5% by mid-2001. When Buffett first bought the
stock, it was trading at almost 40% from its high just a few months
earlier, even though business was better than ever. See Exhibit 9.1. Around the same time that Buffett bought Tanger, he also bought a 5% stake in Town & Country Trust, a developer of office buildings. HRPT Properties Trust. On December 2001, Buffett filed with the SEC that he had bought 5.1% of HRPT for his personal portfolio. I think the graphic in Exhibit 9.2 describes it best. It looks like Buffett filed right when the stock hit its 5-year low point. Right before the announcement, HRP, which was a developer of office building space, announced that it was going to be receiving shares of 5-star Quality Care through its ownership in Senior Housing Properties Trust, which was distributing the shares of 5-star. HRP, in turn, was going to
distribute the shares to its shareholders. In addition to HRP's having a
steady income and dividend, plus a divesting of unstable healthcare properties, Buffett probably calculated an arbitrage involving the 5-star shares. Within 2 months he had collected his 5-star shares, and then
promptly reduced his stake to 1.77%. Burnham Pacific Properties
asset value, otherwise known as NAV, and a poison pill adopted to ward off a hostile takeover. Shareholders were getting restless, and suing. Finally, at the end of 2000, shareholders approved a complete liquidation plan.
Buffett bought over 5% of the liquidating company in December 2001, and enjoyed the benefits of its final 6 months of liquidating
properties for more than they were initially valued at. MGI Properties. Buffett first bought shares of MGI Properties in October 1998 when he filed with the SEC disclosing a 5% stake. Later this stake was raised to
8.3% and then 13.5%. In June 1998, the company disclosed that it was liquidating all of its
assets and distributing the proceeds to shareholders. The liquidation value was estimated at $33 and the stock at the time was trading around $20. We don't know what Buffett's acquisition price was, but it is fair to say he believed in the liquidation value and assumed he was getting a
decent arbitrage between the price he was acquiring and the eventual
liquidation value. Around 1998–1999, when Buffett was making many of his right purchases, reports were appearing in the media that seemed to suggest that these right purchases were part of a bigger macro statement on rights in general. However, this was definitely not the case. In most of the situations, Buffett was buying purely for the liquidation value and the ensuing arbitrage. Bell Industries. Bell has been around for 50 years in a variety of businesses. It is a mini conglomerate that began a transition to the IT services business in the late 1990s and began selling off its other businesses. In 1999 it sold the Precision Metalcraft division, an electronics distribution division, and its graphics imaging business. On December 13, 1999, Buffett filed with the SEC that he owned 5.93% of the shares. We don't know the exact reasons for his filing. Perhaps he assumed that there would be more liquidations and more distributions of the results of those sales. Buffett sold his shares within 2 months when the stock spiked upwards, probably because he had bought them. Not a bad investment technique, if you can manage it. In Exhibit 9.3 you can see the spike in volume that occurred on the left-hand side precisely when he announced his holdings. Another type of arbitrage that Buffett has engaged in with his personal portfolio is closed-end fund arbitrage. A closed-end fund, something that
Buffett's detractors often accuse Berkshire Hathaway of being, is a fund
whose shares trade on the stock exchange like any other company. Unlike an open-end fund, a closed-end fund has a fixed number of shares and no longer accepts inflows or outflows of money. In the next chapter on closed-end fund arbitrage, we examine another example from Buffett's personal portfolio with Baker Fentress. Although 99% of Buffett's net worth is in Berkshire Hathaway stock, it is interesting to see him dart in and out of stocks through the years, using Graham-Dodd principles and snatching profits where he can. It is worthwhile to note here the holdings of the Buffett Foundation. Although its portfolio is not quite the same as his personal portfolio, which Buffett seems to actively manage. Exhibit 9.4 shows the holdings as of June 30, 2003, as filed in the Foundation's 990-P.F. filing. Chapter 10 Closed-End Fund Arbitrage. A closed-end fund is a publicly traded investment fund. The managers of the fund raise money by going public on an exchange and then using the proceeds of the offering to make investments. The managers typically charge a fee, for instance, 2% of assets annually, and 20% of annual profits. This is different from a mutual fund where the investors purchase shares in the fund directly from the fund itself. A mutual fund always values itself based on its net asset value, NAV, which represents the fund's total assets minus its total liabilities. For example, if XYZ fund has $100 million in stocks and no debt, then its NAV is $100 mil. Lion. When mutual fund investors want to redeem their shares, they are able to sell their shares back to the mutual fund at the NAV price. A closed-end fund investor sells his shares on the open market, so the shares may or may not trade at NAV. Closed-end funds can invest in anything from bonds to illiquid stocks to private equity investments. At the time of this writing, many private equity firms such as KKR or Apollo are starting up business development companies, which are a form of closed-end fund. Typically, a fund begins trading at a premium to its net asset value. Then, over time, a discount sets in so that the closed-end fund is trading at a lower price than that suggested by the net asset value. There are many reasons a discount results. Closed-end funds are not popular investments. Many people do not even know they exist. After its initial IPO release, a closed-end fund might languish and the shares slowly drift down, out of nothing but ignorance. Poor performance frightens off investors. If a closed-end fund begins to underperform its indices, investors will begin to not trust the managers and sell the shares accordingly despite the discount to NAV. The NAV might include capital gains that have yet to be taxed. The shares will properly reflect this tax liability by trading at a discount. There are too many illiquid or hard-to-value securities in the portfolio. For instance, many private equity firms will not be able to
properly evaluate their portfolio, and this will cause investors to take a
more conservative approach when evaluating the NAV. The benefits of investing in a closed-end fund are that they often pay high dividends. In addition, many of the funds trade at a discount to the NAV. Closed-end funds typically dividend out all or most of their profits. Much like REITs, there are then two reasons for investing in a closed-end fund that is trading at a steep discount to its NAV. 1. The discount will potentially narrow. For instance, if an activist buys many shares and then liquidates the fund, the discount will instantly narrow. 2. The high dividend that one gets at a discount. Baker Fentress, now BKF Capital Group, was one of the oldest closed-end funds. In 1923, they bought Consolidated Naval Stores, which later became Consolidated Tomoka Land Company. Consolidated owned 16,000 acres of real estate in Daytona Beach, Florida, and, 76 years after Baker first bought it, was one of the primary pieces of value that Baker owned. At the time, in May 1999, Baker was trading at a 26% discount to its net asset value, an extreme discount compared with its peers. At that point, they announced a partial liquidation plan and a distribution to shareholders. Shortly after this announcement, in August 1999, Buffett filed with the
SEC that he owned more than 5% of the company. It also appears
that he never reduced his holding, so he may have continued to hold on to his shares of Baker Fentress, now BKF Capital Group, after its partial liquidation. See Exhibit 10.1. Although closed-end funds usually trade at a discount, the discount normally stays consistent and seldom varies. Dominic Gosbaro and J. Ken Tun Zumwalt of Murdoch University, along with Richard Johnson from Colorado State University, discuss that while the discount remains, it does tend to mean revert. 1. In other words, if the discount quickly gets larger, it has a tendency to snap back to historical norms. In their paper, they even use Baker-Fentress as an example. However, discounts in closed-end funds do not necessarily eventually narrow, unless they hit an extreme as just described. In the 2004 paper by Sean Masaki Flynn of Vassar College, the author discusses that blindly playing a portfolio of going long discounted funds and going short funds trading at a premium is not a successful strategy and often offers negative returns. Point 2. At the end of this chapter I interview two hedge fund managers, Zeke Ashton and Manish Pabrai, who specifically play this strategy and discuss how the average retail investor can get an edge. Closed-end fund arbitrage 161. Exhibit 10.1 BKF Capital Group Inc. from June 1999 to July 2004. 1. Evidence on the mean reverting tendencies of closed-end fund discounts, by Dominic Gosbaro, J. Kenton Zumwalt, and Richard Johnson, The Financial Review Volume 38, 2003. 2. Arbitrage in closed-end funds. New Evidence, Sean Masaki Flynn, Vassar Call. Leger Department of Economics Working Paper, 2004. Buffett, as usual, did not simply play a blind closed-end fund arbitrage strategy but always had an out. There are not many examples, but the Buffett strategy in the closed-end fund world was 1. Find funds trading at a discount to the NAV. 2. The components by themselves were deep value situations that were
also possibly hard to value, as in the Baker-Fentress example, thus
suggesting why the discount was larger than it should have been. 3. Look for a catalyst that would get the funds trading closer to the NAV. One possible catalyst would be if there were a change in management where the new management had ideas about stock picking closer to Buffett's. B. Another catalyst would be if there were a possible liquidation that
would get fund assets distributed to shareholders at prices closer to
the NAV. Circa a third catalyst would be if Buffett, or Munger, in the case of the fund of letters described below, were planning to take control of the fund in order to initiate either A, since he would be the manager, or B, or both. Two other examples of Buffett taking advantage of severe discounts in NAV occurred in the 1970s. In the first instance, Buffett and Munger began buying up shares of the fund of letters. The fund of letters had its start in the go-go 1960s, precisely when Buffett was winding down his partnership
because of a dearth of opportunities in the stock market. The booming
economy of that time period plus the rise of the notion of conglomerates fueled the fire of speculation. Jerry Tsai with his Manhattan Fund and Fred Carr with his Enterprise Fund were among the «market wizards» of the day, with Carr racking up gains of 177% in 1967 and 44% in 1968. While the S&P 500 went up, only 25% and 11%, respectively. Carr started the closed-end fund Source Capital in 1968 to take advantage of the public's demand for this type of speculation. The strategy was to simply keep the money moving and go from one hot story to the next, hence the term, go-go. This was momentum investing at
its finest, only seen again in the late 1990s when anything with .com in
it attracted the momentum dollars. When the market for go-go investing fell apart in the early 1970s, Carr and his funds were greatly discredited and investors fled. Source Capital, which had a NAV of $18 per share, was trading
at a 50% discount of $9 per share when blue chip stamps, controlled by Buffett and Charlie Munger, began accumulating shares.
They eventually owned 20% of the fund and Munger took a place on the board of directors. After Carr left, Source Capital became a haven of value investing under the leadership of George Michaelis, featured in John
Train's book The Money Masters. 3. Michaelis became known for his method
of valuing companies, called the Michaelis ratio. 4. Michaelis total return equals yield plus growth, where yield equals return on equity times payout ratio, price to book value, growth equals return on equity times reinvestment rate, payout ratio equals dividend per share, earnings per share.
Reinvestment rate equals 100% minus payout ratio. In other words, there was a heavy emphasis on buying return on equity
and steady growth, possibly at a discount to book value. This was an interesting compromise between Graham-Dodd style investing and the growth investing with which Buffett and Munger often wrestled. By 1975, the shares had doubled and Buffett and Munger began to liquidate their position. They did this not because of any feelings about Michaelis, who ended up returning an average of 18% annually during his reign, but more as a result of the efforts to simplify their holdings. It was during this period that Buffett and Munger, to appease the SEC, began to merge their operations in Berkshire, diversified retailing, and blue chip stamps into one unified public company under the umbrella of Berkshire Hathaway. Another example of Buffett's investments in closed-end funds was the Fund of Letters in the late 1960s. See Exhibit 10.2. I say Buffett here, but it was really more Charlie Munger and one of Buffett and Munger's closest friends, Rick Gayraw. The Fund of Letters started in the late 1960s as a public venture capital fund. Because of the fees that brokers made during the public offering, the fund had started with $60 million in assets but immediately went to $54 million in assets when the brokers took their fees. This type of laissez-faire manage. 3rd John Train, The Money Masters, Harper Business, 1994. 4. See www.sarahsratio.com for more information. Ment style caused shareholders to ultimately bail, with the fund ending up trading at a severe discount to NAV. At this point, Munger and Gayraw bought up the shares and became activists, ultimately taking control of the fund. They immediately changed the name of the fund to the New America Fund, and changed the style to value investing. It is through this vehicle that they made purchases in capital cities and the Daily Journal, which is now the collection of legal newspapers in California that Munger still owns and runs. It is public on the NASDAQ Small Cap Exchange under the symbol DJCO, as shown in Exhibit 10.3. Ultimately, New America Fund went from a low of $3.75 to a high of $100 per share by the time Munger and Gayraw liquidated the fund in the late 1980s. The story of New America Fund was repeated, but without the help of Buffett and Munger, during the dot-com boom as well, most notably with the closed-end fund VC, started by the venture capital VC fund Draper Fisher Jurvetson. Draper had had many successes in the late 1990s with early-stage dot-com investments, most notably with free email provider Hotmail.com, sold to Microsoft for $400 million shortly after the company started, when it had zero earnings. The fund went public with much fanfare in June 2000. The idea was that retail investors could now participate in all of the rich gains that their wealthier peers enjoyed during the late 1990s. At last, there was a high-tech, high-profile VC firm available to the public. The stock opened above $19 and ultimately hit a low of $7.10 in August 2002, despite having a NAV at that time of approximately $12, a 40% discount to NAV.
Hedge fund Millennium Capital, run by Izzy Englander, began buying up
shares of MeVC, ultimately ousting management and taking over the company. Shares have since rebounded to over $9 and now trade at a slight premium to NAV. Exhibits 10.4 and 10.5 demonstrate the premium discount history of MeVC since its inception. If closed-end funds trade so often at a discount to their net asset value, then it stands to reason that there might be shorting opportunities with funds
that trade at a premium. This is particularly the case at IPO time for a closed-end
fund, since no fund will set its IPO at a discount to the net asset value. A recent example is Apollo, the private equity firm run by Leon Black, who used to work for Michael Milken at Drexel Burnham. Apollo IPO'd a business development corporation called Apollo Investment Corp on May 5,
2004, selling shares at $15. The stock immediately traded down and has
been below NAV ever since. See Exhibit 10.6. Another interesting example is with closed-end bond funds such as Capital and Income Strategies Fund that usually IPO around $20 when their NAV is around $18. The stock usually hovers around $20 until finally breaking down. The stock held steady at $20 until finally the bid was dropped and the
stock immediately fell to its NAV and lower. See Exhibit 10.7.
Many critics of Berkshire Hathaway consider Berkshire a closed-end fund that should trade at a discount to its net asset value. Nothing could be further from the truth. Berkshire is an active business with over 50,000 employees spread out through its many subsidiaries and holdings. Chapter 11 Interviews with Two Buffett-Style Hedge Fund Managers interview with Zeke Ashton. Zeke Ashton is a hedge fund manager at Centaur Capital and a contributor
to the Motley Fool investment website. Yeah. Can you tell me a little about your background and how you got into
the hedge fund business? I started out in the risk management business. I went to work after college for a little company called Wall Street Systems that specialized
in basically treasury financial systems, mostly global financial
risk management. Things like foreign exchange risk and interest rate derivatives. We did various things like risk metrics, which was a big risk control package that J.P. Morgan developed. I lived in Europe for about 5 years, most of it in Germany, and spent some time in Italy and Switzerland. Yeah. What were you doing there? Basically consulting work, building and installing these risk management systems for the treasuries of large banks. In my case, my client was Siemens, which is kind of the General Electric of Germany. It has a tremendous amount of financial and various other risks to manage centrally there because it has plants in 80 countries and customers in 100 currencies, and it has to make sure that when it converts all that stuff back to its home currency, it doesn't lose a gazillion dollars in the process. Interestingly enough, one of my coworkers gave me a Peter Lynch book back when I was an intern with the company, when I was still a student. I read that book in about 4 hours, and when I put it down, I thought to myself, in a perfect world, this is what I would love to do. That was just before the internet became a popular phenomenon, and I didn't really know exactly how one got into that line of work. I had this opportunity in front of me because I'd been overseas as a student and spoke some German, and this company needed somebody
who was eager to learn and was willing to move to Germany and spoke a little bit of the language. They hired me to do that out of school, sent me over to Europe and
kind of threw me in there, and it was a great experience because I learned a tremendous amount about how the global financial markets, the foreign exchange market and the money market, interest rate, derivatives market, the equities markets, are all sort of connected in a certain way. They're all assets that generate streams of cash flow. That was helpful to me when I finally picked up some books to follow up on my interest in stock market investing back in 97 or 98. I picked up some books about Warren Buffett. I was a reader at the time of The Motley Fool, which was a very accessible source of investment information. So I got very serious about it as a hobbyist in early 98 and began to run my own portfolio, and I was so anal about it that I even wrote myself quarterly letters. Buffettology was one of the first ones I read, and then American Capitalist by Roger Lowenstein, which is probably the best book on Warren Buffett. You have one view of what Buffett is like, and then when you start to dig deeper, you realize that the way he runs money now and the way he sort of projects himself now as kind of this grandfatherly buy and hold, till death do us part, sort of investor has really been taken to extreme lengths by the media. And it's diametrically opposed to what he was doing earlier in his career, when he was really compounding money at the 20% to 25% range in sort of a bear market environment from 56 to, at least 73, 74, when the bear hit its kind of bottom. He was out there buying net working capital stocks, as he'd been taught by Benjamin Graham, and when his problems went from too many ideas and not enough capital to too much capital and not enough ideas, he really was forced to make the transition into buying these much higher quality businesses that he has the luxury of holding for a long period of time. Yeah. Right. Zaw. I was very fascinated by having a case study of a man who, purely through rational capital allocation, was able to grow a very small amount of money and compound it at high rates of return over a 40 or 50-year period to become the world's second or third wealthiest man, purely based on investing acumen, not based on building a company that turned into a global worldwide monopoly like Bill Gates. He didn't inherit a lot of money. Something about that just really appealed to my nature, and I'm sort of a studious guy by design and love to get in there and figure out the system, find out what the probabilities are that this or that will work. I came home from vacation when I was living in Switzerland and started a little limited partnership. I got a couple of coworkers who were in Europe with me, for whom it was very inconvenient to invest in mutual funds, to toss in $10,000 each or so, and I started managing the money. Not long after that, I submitted an essay on investing to the Motley Fool. They liked it and published a couple of my things, and even Tually they offered to hire me and move me to Alexandria, Virginia. I saw that as a huge opportunity to make the transition from the boozy
nest that I was in, for which I was rapidly losing interest as well as loss.
ing its demand after the euro and the Y2K thing. So I moved to the Motley Fool. I continued to run this little ITED partnership on a pro bono basis in my spare time. I looked at 1,000 companies maybe in my 2.5 years there and wrote a
couple hundred articles. I tried to develop myself as an analyst and
a money manager. Ultimately in August 2002, I did open up the fund to outside investors, changed the strategy a little bit to make it more
of a hedge fund, and have been doing this for 2 years. Our track record has been very good. Late last fall, Matthew Ritchie, who was a good friend of mine and
helped to get me hired at the Motley Fool, came and joined me at Centaur, and we're having a great time. We work very carefully and closely together and try to invest the capital that's been entrusted to us with a value sort of orientation, although we don't necessarily consider
ourselves completely traditional. We're willing to chase or go get value in whatever guise we think
it happens to be in. We try to not to bind ourselves too rigidly by any one set of rules, but at the end of the day, it all comes down to how much cash you think an asset can produce over its life. And so we try to reduce virtually everything that we can, in some way, shape, or form, to whether we think the price today is a good
price and has a margin of safety that will give us a 15% annual
IZED return, which is generally our equity hurdle rate. Yeah. How do you quantify the margin of safety? ZA. You know, it's hard. If we could put our strategy in certain buckets. We have one strategy where we look for smaller, high-quality
companies that are trading at, say, single-digit price to free cash flow
ratios, and they have everything else right, strong balance sheets, good brands, some niches, they are managed correctly, this sort of thing. If we had enough of those to go around all the time, we would do nothing but that. Some are growing at 2% a year and some
are growing at 8% a year. If you buy a group of those that are all high quality, all managed by enlightened people who are
shareholder oriented, you pay an average of, say, 7 times free cash flow for that group of fine companies, then you're going to do well over time. Yeah. Let me just play devil's advocate. Wouldn't you say the market is ing these companies in the single-digit cash flows because there's some anticipation that they're going to stop growing, or growth will be negative? ZA. I don't think that's the case. Most are priced to low multiples because they're boring. I believe that in today's world, you can divide stocks into 2 groups. Those with a buying constituency and those without a buying constituency. For example, it's estimated that the U.S. mutual fund industry is
about an $8 trillion industry. Somewhere around $2 trillion of that
is either S&P 500 funds or S&P closet funds. So there's a $2 trillion constituency that has to buy only the companies in the S&P 500. If you've ever been to a Berkshire Hathaway meeting, you sit there and think to yourself, there are people lined up at 6 o'clock in the morning to listen to the CEO of this company answer questions. For about 5 hours, the doors open and grown men and women run and knock each other over to try to get the best seats. I call it the running of the bulls, and I think it's the funniest thing I've ever seen. That grown men and women are willing to do this. They listen to this man whom they obviously worship, some in a more enlightened way than others, but you think to yourself, how is it possible that Berkshire Hathaway can be undervalued when clearly there's this constituency of people who are going to buy the stock? The reason is that the constituency you see at the Berkshire Hathaway meeting is such a tiny, tiny drop of capital when you compare it to a constituency like all the S&P 500 index funds in the world. As you know, Berkshire Hathaway is not in the S&P 500, and because it lacks that buying constituency, it's my theory that Berkshire Hathaway is occasionally very cheap relative to its intrinsic value, but even now, when it's trading at very high historical valuations relative to book value and whatever else you want to use, it's still trading at probably 80 cents on the dollar when you look at it from an intrinsic value standpoint. You would think that there should be a premium to all of the relative metrics that we use as investors, simply because of the track record, the culture and the man who's running the money, but it doesn't have one. Would you say it's because there's an expectation on the part of shareholders that Berkshire Hathaway's growth is going to stop? I would argue that it's not. It's just that Berkshire Hathaway does not have the huge buying constituency that, say, AIG might have. Yeah. So with these companies, including Berkshire Hathaway, that don't have a constituency, it's not necessarily the case that there's going to be a future constituency. They might be forever valued cheap? Yes. Yeah. Until they have negative growth, and then they'll be valued less. Yeah. The risk you're referring to is, of course, what we in value circles
call the value trap. I personally believe that if you have enlightened management
that's shareholder-oriented, a value trap doesn't really exist. It can exist on a single stock basis, perhaps. I'm willing to concede that. But on a portfolio of them? I don't believe that's possible because ultimately that enlightened management team will, if they're good capital allocators, make smart acquisitions. They will buy back stock at attractive prices. They will continue to pay out a higher and higher level of dividend until they bring in various people. But you know what? As long as the stock continues to be relatively valued, i.e., if it never trades at more than 8 times free cash flow on a per-share basis, but the company is reducing the outstanding shares by 6% a year and growing the business by 3% a year, you're going to still get a reasonable sort of equity return relative to the risk you're taking. Again, a lot of these companies are excellent. Generally they're smaller, because they're neglected. Or their small stocks are small companies. Some of them happen to compete in industries that don't get a lot of buzz. But ultimately, they get bought out by a bigger competitor, or something happens. The catalyst comes, as we say in value circles, and you end up making the money. Yeah. Do you have an example? The fall of 2002 was a very, very good time to be buying some of these stocks. It was kind of the nadir of the 2000 to 2002 bear market, which, depending on whom you talk to, may or may not be over yet. In any case, internet companies had fallen into such disrepute that nobody wanted to own an internet stock anymore. There were jokes about them. It had almost become the new swampland in Florida joke. We noticed a little internet advertising company called ValueClick and went out to visit the company. This was a true Ben Graham net. Working capital play. The company had $3 a share in cash and it was trading for $2.30. If you looked at the business from an operating standpoint, it was just barely breaking even, but it was profitable and cash flow positive in general because its big cash balances were kicking off some interest income. But the interesting thing it was doing was buying even smaller
publicly traded internet marketing companies at even bigger discounts too.
cash. The leader in the industry was DoubleClick, and even DoubleClick was pretty much hated and almost fell below cash at one point. We looked at ValueClick's model and talked to its management team. The manager didn't strike us as a genius in capital allocation. But he was very, very good at the day-to-day operations of the business. He was not a big spender, and he knew how to keep costs in line with expenses. The one thing we realized was that as soon as the advertising market turned around, a huge number of the advertising marketing players had been cleared off the table by consolidation, and many of them just went out of business. But those that were any good got taken over by ValueClick, DoubleClick, and some of the other players. Second, the business had a massive amount of scale to it, because it didn't cost them very much to run the advertisements out there. Once they had built their infrastructure, the thing did turn around. About 9 months later, the economy started to turn around a little bit and advertising went up. The scale of the business was becoming obvious. They had a couple of good quarters. The stock rocketed from $2.50 to $4. We started selling because we thought the thing was only worth
$4. I think we sold the last of our shares at $5, and the thing rocketed
onto $12. It hovered there, but then the company announced earnings that weren't good enough and the stock's been knocked back since to the single digits again. That's the way these things happen. The frustrating thing is that not only do they eventually get a catalyst and actually get catapulted in value, but generally once it gets going, it goes way beyond what you thought it could ever plausibly be worth. My friend Whitney Tilson calls it the value investor's lament. You always sell too early, because you have to sell in order to keep the margin of safety. You always have to sell at fair value, or maybe the high end of fair value. But you never want to hold an overvalued stock, because you could be holding ValueClick when it gets whacked back to the single digits. You don't want to do that to yourself after you've gotten the profit. Yeah. Let's go back to, say, November 2003, and these internet stocks have gone up 50% from their lows, and there aren't too many examples of companies trading below cash. How do you switch gears and find the margin of safety for your investors during a period like that? The problem as an enlightened value investor is that you never want to deploy capital unless you really do see a reasonable discount to fair value and a reasonable margin of safety in the stock price. So we, like a lot of value investors, inevitably started building up cash as we started selling the stocks that had kind of gone to fair
value and above. Fortunately, the market tends to be fairly merciful. I mean, there
are 9,000 stocks that trade on the 3 major U.S. exchanges, and at some point or another, if you dig enough, there's always some trading at a significant discount to fair value. We have some statistical screens that we run through a computer software program that helps us identify the stocks that are obviously statistically cheap. For example, we have one, based on this net working capital Strategy that Benjamin Graham popularized but that nobody really uses anymore. In the fall of 2002, we might have 40 names on that, and as we'd go through and look, for 30 to 35 of them there are legitimate reasons why the things are trading below net working capital. But for 5, they were perfectly decent companies and not horrible assets, and they were clearly trading at below the value that they should have been trading. Typically we prefer that most of that value is in cash, not in accounts receivable or inventories or that sort of thing. We also screen out those that have burnt a significant amount of cash. When we ran that same screen at the end of 2003, there were only 3 names on it, and they were 3 names that we'd looked at previously and had decided there was something flawed enough about
the business that even at that price there was no margin of safety. So,
these things do change. You have to go where the ball is, and of course, if you're going to pay 10 times free cash flow, you have to get a higher quality company with a little bit more growth or whatever it is that you're looking for. Yeah. Can you give me an example from November or December, 03? ZA. We found a company, and the reason this one was available because it's just somewhat illiquid, called Atrion. The ticker symbol was ATRI, which is still in our portfolio today. It's a little medical device company that grows the top line pretty significantly, or has over the last 5 or 6 years, but had actually
bought back over a third of the shares in the last 5 years. And their
capital allocation was phenomenal. But nobody could own it because it was too small of a stock, and it actually dropped back a little bit on some top-line weakness. It was available in the $20 to $25 range, which made it at 7 times free cash flow or something. We continued to buy it, and we paid up to 11 times free cash flow for it, up into the mid-$30s because we thought it was a very high-quality company. We thought the management team was outstanding at both managing the business and allocating capital, which is a very, very tough combination to find. The business was actually highly diverse and had a high margin for such a small company, and none of the big institutions could buy it because it just didn't have the liquidity. But for us, managing a
smaller pool of capital, the liquidity wasn't an issue, and the company's
located about 40 minutes north of us, so we were able to check around to make sure that their reputation matched our view of it. We're quite happy to get it, and we continue to hold it. We bought a ton of Berkshire Hathaway in March 2000, which was probably the all-time best time to buy Berkshire Hathaway. The
problem is that if you buy Berkshire Hathaway at a kind of once-in-a-lifetime
opportunity, at least once in our generation opportunity, when Warren Buffett's being raked over the coals for his refusal to buy technology stocks. We bought these shares at perhaps $1,500 and now they're at $3,000, so 4 years later, you have a double, whereas if you buy a
net working capital stock and something good happens, like it did
to Value Click, if we'd have sold at the right time, we could have had as much as a 5-bagger. We ended up getting 2 bags in a 9-month period of time rather than a 2-year period of time. Yeah. What percentage of your fund do you typically put in the average posy
on that you have? ZA. We've gotten less concentrated than we used to be for a couple
reasons. Number 1, the bargains are probably less now than when we started doing it, but also just because we're not as comfortable holding say, 10% positions as we used to be.
But if we have absolute confidence in, like, Berkshire Hathaway,
it was upward of 10% of the fund, which was a very small fund at the time. So it probably doesn't even qualify as a fund. It was just a pool of friend and family capital when we did that. But usually our maximum position, which we call the double, is 7.5%. Our standard position on what we think is a truly
outstanding investment that will reach our 50% annualized hurdle
rate and has a margin of safety is usually 5%. On our net working capital strategy, you're buying a mediocre asset at best that's priced as if it's going out of business, so our POSI TION sizes their range between 1 and 2%, usually depending on the quality of the business. Yeah. How many positions can you hold at any one time? We'll hold between 25 and 30 long positions at any one period of time. Very easily. Yeah. Here we are in August, 04. How many positions do you have on? Right now? We've got probably 27 longs and 6 shorts.
Yeah. How do you decide to short a stock? We basically look for the mirror image of all the stuff we look for on
the long side. We think of the market as this big bell curve. A bell curve is based upon value per dollar, per investing dollar that you get. Most of the time, unlike a standard bell curve where the bulge is
in the middle, in our markets, the bulge is usually on the right side, i.e., the overvalued side, because more stocks typically are overvalued
or fairly valued than we would like for them to be. We try to pick our long investments out of the far left end tail of that bell curve. That's just the cheapest stuff on the market and hope fully, in terms of value, to get the most value for the dollar.
When we're shorting, we try to pick out the 5 or the 6 stocks
that we think are the most overvalued. We call it the cream of the crap, the most overvalued stocks with the worst business with the most hideous management that are doing everything that will
basically guarantee their shareholders will never see a dime of their
cash back. We typically like it when they're a little bit bigger in size so there's enough float out there. A lot of scam companies will issue a press release or try to get their CEO on CNBC, and they're not above bringing on a boiler room shop to send out mass emails to people saying,
"Hey, buy this stock at 80 cents. It's sure to go to $3 tomorrow." To protect ourselves from that, we try to get companies that have enough
of a float that it would take a significant amount of buying power to push their stock up dramatically. Typically we like to short them just after they've done one of these pipes or after they've done a secondary or something where
they have brought in a significant amount of new investor base that's
likely to not want to take any pain. Yeah. What's an example of a short that you've done? Commerce One Software was a $15 billion company back in 2000. This was the company that was going to be B2B. The share price reached over $1,500 per share, split adjusted. They'd done some
reverse splits since. We started shorting it at about $3 a share at a time when we bought Cali
knew this business was a cash incinerator. They were burning several $100 million a quarter. They had taken out massive real estate liabilities at the top of the market to house their 1,000 employees, which are now down to 200. So the real estate was sitting empty, and they were paying the rents. Their biggest customer was SAP, the big German software Payne with whom they'd done a partnership back in the heady days. And SAP had just terminated the partnership and was now their biggest competitor. So they had about $300 million or $400 million left. They were burning it at somewhere close to $70 million a quarter. Their market was drying up. Nobody was paying for these things, and in fact, they ended up selling what was left of their original B2B software and are now trying to sell this new conductor software. So we shorted it and let them burn cash for another 7 or 8 quarters. We covered at about 60 cents simply because it got so cheap that we were worried that SAP or somebody might decide to take it over. We got a really good return on it. There was a tremendous amount of float out there, because this thing used to have a $15 billion market cap. There were still some institutional holders that were holding on, and we knew they had to sell at some point. It was burning so much cash. We knew there was no market for their software
anymore. We could tell that all of their revenue, which used to be
license revenue, which is what you get when you sell the software, was now maintenance revenue, which is just very low margin, and requires that you have a lot of highly skilled guys who will help support the software. They were diluting the stock by about 20% a year, and they were in the capital raising tailspin whereby they would have to
do these kinds of toxic bonds or toxic equity offerings, where they
would sell some stock at $1 a share, but then they would issue warrants for a similar number of shares if the stock went up above $1.30 or something. One thing we've learned about shorting, though, is that the longer you short, the better the chance that something unexpectedly good
can happen. Yeah. What sort of screen do you use to find margin of safety in a short
situation? ZA. We have a screen that basically tells us which companies are running on fumes when it comes to cash flow. You've probably heard this analogy before, but cash flow is oxygen for the organisms we know as corporations. Businesses have to have positive cash flow to live, and anytime a company is burning a significant amount of cash, particularly if they don't have very much left in the bank, then they're going to eventually die of cash asphyxiation. Only two things can happen with a company that's burning cash and whose business is not working. They're either going to be able to raise more capital, which usually means the shareholders are going to be massively diluted, which is good for the shorts, or they're
not going to be able to raise additional capital, which means it's going
to be good for the shorts, because the company then goes to zero. I've been amazed at how many ways there are in the modern capital markets for these companies to try and get more capital and stay alive another quarter. So that's why we never try to hold them to zero anymore. You know? As soon as we look at shorting as an IRR game.
We try to maximize our annualized return. So basically, if we're short
a stock and the thing takes a 30% dive, in 6 weeks or 8 weeks, we typically are gone. We never invest based on ideas that are kicked out by a Metchin iCal screen. There's always a very, very intense qualitative review that goes along with it. The screens are just designed to kick out
candidates, nothing more. Interview with Manish Pabrai.
This section is an interview with a hedge fund manager who focuses on Buffett-style investments. Manish Pabrai is manager of Pabrai Investments and also a frequent contributor to realmoney.com and thestreet.com.
Yeah. Give me a little background on yourself and how you went from
the IT services business to Buffett-style investing and the hedge fund business. MP. First of all, I cringe whenever anyone says hedge fund, but yeah. Why is that? MP. Well, I think the connotation is that the fund is, in some way, hedging,
leveraging, shorting, or delving into derivatives. The fund is none of
those things, so basically a better description of it is a private mutual fund or a private investment partnership. That's just semantics, but PLE just short form all private investment partnerships as hedge funds.
Yeah. Did Warren Buffett consider his partnership a hedge fund? MP. I was surprised when he talked about it recently. He basically said,
well, Charlie Munger and I ran a hedge fund of sorts. I think he used that as a sort of short form. But I think if you go back to the Buffett partnership letters, there's no such term. It's very clearly a private investment partnership. Again, the style of that fund
included either special situations or just great businesses at a discount.
But all the action and all the money are in the workouts in CL situations. Yeah. You mentioned in one of your letters that laser mortgage takes up intellectual energy. It allows him to keep his hands dirty so he doesn't have to mess around with Berkshire's $50 billion in these
situations. MP. That's right, and I think Munger's exact quote was, 170,000
employees and $150 billion of capital are innate. Quate to utilize that motor. So we need all these other special tie-ons to keep Warren amused. A few years back, there was a charity event where they auctioned off his wallet, and he put a stock tip in the wallet, and the stock tip was First Industrial Realty, right?
Yeah. All right, so tell me how you got into all this.
MP. I had an IT services company that I sold in '98 and then got more into investing in the fund business. My entry to investment funds was very accidental. I think when you learn about Buffett, it's like peeling an onion. There are many layers that you have to go through before
you get to the essence, and I think I'm still not at the essence because
all these nuances about management and so on are more difficult to grasp onto. The first layer for Buffett is that he just buys these great boosy nesses at a discount to what they're worth and holds them forever. I was very intrigued by that in the mid-90s, and I thought, okay, this thing is pretty simple. I love figuring businesses out. I was still running my IT services company at the time, and I had $1 million of cash with me in '95. So I said, I'm going to start investing this million in public markets, and I think it will do better than market indexes. I wanted to find out how much better I could do. If you compound money at a healthy rate, let's say 20% or 30% a year, it grows pretty spectacularly. So I thought it'll be just interesting to see where this million ends up, and if I were to compound it at 26% and I ignored taxes, it would double every 3 years. So I said, let's play a 30-year game. I was 30 years old at the time, and I said, let's see at 60 how close I can get to $1 billion. My
thinking was that even if I missed it by 80% or 90%, that'd
still be fine. Yeah. That's not bad, right? MP. So I started to spend about 15 or 20 hours a week doing investment research and starting a concentrated portfolio, a few big bets, and
That did very well. I think from 95 to 2000, I averaged 60% a
year. I would tell a bunch of friends, hey, I found this great business. You should buy the stock. And these guys also made a lot of money making some of these investments. In early 99, a group of them approached me and said, look, you
tell us stuff, and we sometimes act on it, sometimes don't. They wanted to set up a fund for the friends, and they wanted me to
manage it. So they said, we'll give you $100,000 each, pull together $1 million bucks, and you can manage that money. That way, we're not
dealing with stock tips and whatnot. And I thought for me to manage
another pool of capital would be basically no work, because I was already doing the research for my own assets anyway. I said I would do it if they let me set it up in a format exactly like the Buffett partnership. I like those partnership rules, no fee until 6%,
and then 1/4 profit above that comes to me, 3/4
to partners, no disclosure of holdings, and I like that format of writing a letter to partners and so on. They didn't really care, so that's how the fund got started. I was still running my business at the time, and it was really a part-time endeavor with $1 million. In 2000, the business
got sold, and in the fall of 2000, I went full-time into running the funds.
I have a rule that if on Monday morning, I'm not fired up to go to work, then I do two things. One is I don't go to work, and the second is I hit the reset button on my life. So in early 99, I was getting so much more ingrained into Buffett and whatnot, and with declining interest in IT services, that I didn't feel like going to work. So I started
a search to bring in a CEO for the IT firm, and I actually then applied
for a job with Buffett to learn from him. I got turned down. Yeah. Did you go out to meet Buffett? MP. No, I just sent him a letter with a resume, and he sent me a response in a week saying, look, I work alone, and the kind of posy
Tion you seek doesn't exist at Berkshire. So he says, good luck reorganizing
your life. I'm not the answer. I was very disappointed when I got the letter, but after I got it, a friend said, look, why don't you set up your own fund and get the CEO search going? I never thought of the fund as being a full-time vocation. I thought it'll be something on the side. By November 99, the CEO I brought in had started at the company, and then I think in early 2000, he said that he got a phone call from someone who wanted to buy the business. So now the buyer was looking at this new CEO as continued new management, not me, which was awesome. So then we did a transaction. This person stayed on, and they didn't even talk to me about any sort of employment contract. In hindsight, just luck worked very well. In the fall of 2000, the fund had about $2.5 or $3 million in assets, and I really wanted to spend full-time on just the investment funds. At that time, I thought, let's run
this for at least 13 years and see how close we can get to the Buffett partnership. There were 2 or 3 nuances. One is that he went from
$100,000 to $100 million in 13 years without spending much time raising money, and he had a 29% a year return. Both of them were
spectacular. So I said, I just want to see how close I can get to both benchmarks. The fund rules won't allow you to advertise or solicit or
anything, so I was just curious to find out if you just sort of put your head down and run the fund, will your partners actually send you money and will they refer you to others? On both counts, it's worked out far better than I thought. The way I look at it, I'm about 3 years ahead of schedule. I have a spreadsheet that shows me the Buffett partnership's increase in assets over time, and then I did a CPI index delta for inflation from then until now, and I think I'm about 3 years ahead in terms of assets versus where he was. Amazingly, the returns so far have been ahead, though I think if I end up anywhere close to him, that'd be
just awesome. That's some of the history, but when the fund started, the focus.
And, in fact, even my understanding of the Buffett workouts in special situations wasn't that great. I think I'd read about it, but I never really grasped onto the power of the model. I think in the fall of 2000, I visited one of the authors, Timothy Rick. I had read his book and noticed he was in Munster, Indiana, which is pretty close, and I just emailed him and said, if you'd like to get together for lunch someday. I met with him and then subsequently he was the one who really highlighted for me how the special situations route was the way to go. If you look at investing in terms of probabilistic terms, those are the
ones that do have the highest probabilities, absolute no-brainers, etc. So in absolute returns, a buy and hold forever strategy,
even if you buy a company at a discount, would, in general, be somewhat inferior to the special situations, especially if you held it forever.
The concept is really simple. Let's say you take a business like Coca-Cola, and say you buy it at half of what it's worth and you held
it forever. What would happen is that your eventual return would approximate the return in equity the company was generating. It wouldn't matter what discount you bought it at, because over time it
would get to full price. The gains in stock price you would see would
be approximately mid-range gains and return on equity. Yeah. Have people done research on this and proved that to be true for companies over time? MP. It's intuitively obvious. Let's say you buy an apartment building for $1 million, and let's say it's generating $100,000 a year in cash
flow for you. Let's say that cash flow goes up at 10% a year. The
value of the building will track with that cash flow. It will go to $1.10 million or $1.2 million, and I'm assuming discount rates are the same. Interest rates are the same, and all of that. But if you take all those
variables out, returns on investment will track return of equity. That's one edict, and the second edict is that there's no business
on the planet that can generate returns in equity in excess of, let's say, 30% a year and be able to forever redeploy the capital that it's generating. Take a business like Microsoft. Historically, Microsoft's
return on equity used to be well over 30%, but the problem is that when they generate all the cash, they're not able to redeploy it
back. That's why they've got such a big cash hoard. So if they're not able to redeploy the cash back, now that cash is earning 1%, so your return on equity does not compound at 30% a year at Microsoft. It can only compound at 30% or 35% a year for the amount of actual capital deployed in the business, and the actual capital deployed in the business is not able to absorb all the capital that the business is generating. There is no business that I'm aware of, in the country or in the world, that can endlessly generate return on equity over 20%. And redeploy all the cash to generate. From that, you will infer that the
Upper limit returns that you can generate, if you made no mistakes.
Whatsoever, would be 20% a year. There's an upper limit bound. On buy and hold forever, and the upper limit bound is about 20%. In reality, it's actually less, because when you get to a portfolio, and you get to mistakes and you get to management redeploying cap, ITOL with some mistakes themselves, when you get to all those real world situations, the real number is much below 20%. So let's look at Sequoia Fund, probably the best research shop on the planet that I know of, and probably the best buy and hold investors that I know of. Sequoia Fund generated 16% or 17% a year for the last 32 years. If you take Berkshire out of the portfolio, the returns on their investment excluding Berkshire Hathaway are about 13% a year. So the best buy and hold investors, with the best research team, just kick ass in what they do. Look at the portfolio of businesses. They buy amazing businesses. It's banging out 14% or 13% a year. And now the flip side. You go to special situations and you just flip the map, or you just say, okay, I'm going to buy $1 for 50 cents, and when it gets appraised at $1 or 90 cents, I'm going to get rid of it. Now your returns are simply a function of how long it takes to get to convergence. If you bought $1 for 50 cents and sold it for $1, and convergence took 1 year, you would generate 100% return. If convergence took 2 years, you would generate a 37% or something return. If convergence took 3 years, you would generate 26%, and if convergence took 4 years, you would generate 18%. So up to 4 years of convergence beats buy and hold. This very simple math became obvious, and the fact is that buying great businesses is all good because you have a few more tax efficiencies and all of that. But really, the pop in terms of getting better returns on assets is first of all to sell fully priced, or near fully priced, assets, whether they're special situations or not, and then go back and buy at 50 cents on the dollar. Yeah. What do you think of Buffett saying, my favorite holding period is forever, MP? I think Berkshire has the model. The problem with special situations is you have to continuously be able to find these opportunities to
take advantage of the market, what I would call market anomalies.
If you have a huge pool of capital, it becomes a problem because you can put a lot of capital to work in a company like Coca-Cola, American Express, or Gillette, but the Finovas, the MCIs, or the First Indus Trials of the world, those sorts of investments are very random.
They're not very good to look at in a portfolio that is
150 billion. Generally speaking, you'll have a very hard time trying to put that amount of capital to work in these sorts of situations. Typically, a lot of the special situations are going to get just thinner and thinner as the market caps go higher. I think Munger said that the first few $100
million at Berkshire Hathaway came from running a Geiger counter
over everything. You know, you're at the beach trying to find metal under the sand, and you're running over everything and find some thing. But he says that subsequent billions have come from making a few select investments. I think if you have unlimited capital, then the special situations isn't going to work so well because you will not be able to deploy capital. Buffett made a statement 2 years back. He said, if you gave me $1 million of capital to manage, I would pretty much almost Ante that I will make 50% a year. For a guy who's very humble. That's a pretty cocky statement. But I think the reason he makes that statement is he would just make 100% doing special situations. Yeah. How do you go about, right now, finding special situations? MP. You don't. You let the game come to you. So basically, you do nothing. Just read and think, and occasionally, you read the paper and you'll see something. For example, I think I made an investment in a company called Frontline. Frontline was a case where the value of the company was, I think, $14 or $15 a share. It was losing money in
the near-term market, and the price went from $15 to $3, and so there
was mispricing. Basically, you're looking for market anomalies whenever there's extreme fear in some sector, or whenever there's some big clouds over some companies, you're likely to get mispricing. The question is, am I able to see through the clouds, and do I know the business well enough to be able to see beyond the temporary negativity of an industry or a company and see what the value of the business is versus the price at which it's being offered, and if it is enough of a delta, step in. If you look at broad-based special situations, like a Frontline, or I bought a funeral services company 3 or 4 years back called Stewart Enterprises for less than 2 times cash flow, there were clouds over those businesses when they were bought, and they're okay businesses. I mean, Frontline is not such a great business because it's eventually a commodity. Stewart has some mood around its booziness, but in both cases, the primary driver for buying the business was an ultra-cheap price and a huge discount to what it was worth. Yeah. What were the valuation parameters? How did you analyze it?
MP. Well, let's go through Stewart for example. This is going further back. The thing with Stewart is that there
was a big roll-up in the 80s and 90s of these funeral services opera tours, and the 3 big ones were Service Corp, Stewart Enterprises, and Carriage Services, and in the glory days, they took on a lot of debt, issued a lot of stock, and bought a zillion companies, small mom and pop funeral homes. Stewart ended up with like 1,000 funeral homes, about $1 billion in revenue, and about $1 billion in debt. The debt load was such that they had, in the year 2000, I believe, a $500 million note coming due in 2002, about 22 or 23 months away. The company was generating about $100 million
a year in cash after all interest payments and everything. So in 2
years, they were generating $200 million, but they were still $300 million short, and there was no clear answer as to exactly how that note would get settled. The existing lenders in that space had taken so
many losses in that area that they were not willing to make any
additional loans or roll over existing debt. So Stewart would have to refinance, pay the debt off, or find another lender. The street had just witnessed one bankruptcy out of these 3 big players, and so they painted them all with the same brush, and all
the funeral services stocks collapsed. In fact, Stewart went from, I
think, $28 to $2 a share in about an 18-month period. I looked at it at $1.91 a share. This was a company that was generating $100 million in cash flow, after all, and it had a market cap of $190 million. So you could buy a business for less than 2 times cash flow, which
is unheard of, right? This is a very predictable business because you know exactly
how many people are going to die each year. Maybe they'll charge 300 basis points more or whatever else, but someone will be willing to make this loan because the economics of the business are so solid. So,
I said, first of all, I don't believe that this debt is not yet settled.
second, I said, even if there's no lender on the planet willing to lend to them, it's not a single street plant, it's 1,000 different funeral homes, each of which has the same brand it had when it was born. So what I decided is I need $300 million. I can go to the first. I just
put 200 funeral homes on sale, go back to the people I bought them from, and say, I'll sell it back to you at half the price I paid you. I
think that easily 200 or 300 of these guys would take that business back in a heartbeat. So my sense was that they could sell these funeral homes pretty much back to the people they bought them from, get the cash, pay the debt, and move on, and still retain a lot of value in the business and still be underpriced. So we put assets into Stewart, and literally less than 2 months after I made the investment, the company announced that it was going to sell all its international funeral homes. They had about 300 funeral homes overseas, and they said that those funeral homes, because they were in so many different countries, were not generating any cash flow to the business. So the $100 million a year they were generating would be unaffected by that sale, and they estimated that that sale would bring in $300 or $400 million at least. The stock went from $2 to $3 on that news. Another few weeks later, they said there were 3 definitive buyers fighting over who would be able to buy the 300 homes, and the bidding had gotten the price up to $500-600 million. The stock
went to like $3.50 or something, and then when they closed the
transaction, it went to about $4.50 a share. Stewart subsequently went to between $6 and $8 a share after that. So that was a classic no-brainer. No downside, significant upside investment. Yeah. Let's say you're the average retail investor right now. Other than reading the newspaper, are there any other techniques that you can use to try to find these opportunities? MP. I do look at the New York Stock Exchange every day, and I look for names that are familiar. Then if something piques my interest, I'll do a drill down. In general, you want to look at stuff that's hated and unloved, like I had bought level 3 bonds. That's another classic. Well, actually amazing, special situation because that one is going to give you like a 45% return a year for 7 years, which is just unheard of. Yeah. Did you buy prior to Buffett getting in? MP. Yes, about a year before. There was a rumor circulating at that time
that he might have invested, but it was confirmed a year later when he
did the convertible issue with Longleaf and Bill Miller. I felt good about being ahead of the Messiah. Laughter. Yeah. On a slightly different topic, basically these are mostly Graham-Dodd style plays as opposed to the 70s or 80s Buffett-style plays, when he did Coca-Cola, for instance. How do you reconcile the fact that most
of Graham's money he made actually on Geico, which was more or
less a buy and hold forever play for him completely outside the boundaries of how he normally can add value? MP. Most of the money on Geico was made because it was a great boozy-ness. But if you look at Buffett's purchase of
Geico, a huge portion was bought when Geico was under severe Tress. He was buying it like about $1 a share. Geico's very
unusual, and to find those sorts of investments is very rare. This was a company that was available undervalued, and some would argue, even today, that it has a sliver of the market share that it eventually
will. It's got an ability to grow its business pretty dramatically over a very long period of time. From my point of view, there are a couple of things that come in.
One is, can you actually see it? Coke is a good example. If I look at that business independently, I just won't be able to see a long, huge runway and all that growth ahead of it without hitting blips and other major issues along the way, and even changes in consumer behavior.
All these issues would cloud my judgment about something like
that. So I think that if you can identify a Geico, but I'm thinking if you look at Graham, how many did he find? Yeah. 1 MP. Exactly. And when the investment in Geico was made, it was at a time when Geico was undervalued. I think that sometimes it's dumb luck. From my perspective, I think
sitting around trying to find a Geico and just waiting until you make that
investment is somewhat foolish because it's very, very hard to find. You are going to learn more about the business after it becomes part of your portfolio. And I think Geico is that type of company. In fact, the very best investments are great businesses that are
bought at times when they are under severe distress. So Buffett did
that with American Express, right? He put 40% of his partnership assets into American Express in the 60s, right? But again, he sold it out. He never kept the stock through all that run. My sense is that any special situation is fine as long as your math
is giving you 2-to-1 returns in 2 or 3 years or less. In some
sliver of them, you actually buy great businesses, and I look for that. The ideal situations are the ones that actually have an underlying great business, because then there's a decent chance that you'll have increases in intrinsic value while you're holding the business, which
means that you never get to the point where it gets all valued. Ideally,
the thing is going along at a slight discount to what the market price is. And that works out great. But most of them are what the market's going to do. If you look at Frontline, for example, it went from $15 to $3 a share. When it got close to $12 or $13, I was selling. It's close to $40 a share today.
Yeah. Wow. MP. So if you had a Geico in your portfolio and it was worth $15 and went
to $3 and you sold at $15, that would look like a reasonable decision. And then subsequently the street takes it to 2 times intrinsic value.
What do you do then, right? From my point of view, it's better to sell it rather than trying to play mental games. Yeah. You brought up an interesting point about American Express. How
Buffett put 40% of his assets in that situation, something which Graham almost certainly would never do in terms of that size of his portfolio. What are your feelings on diversification?
MP. I am not confident enough to put 40% into a single asset.
Mainly because I think I'm not Mr. Buffett. I feel that I want 10 bets. Ideally uncorrelated, in 10 different industries, and I'm very happy to leave it at that. I know if I take 10 down to 8, my returns will go up. I just feel that there are macro factors and even macro events that cannot be analyzed. I'm just not willing to go above 10%. Chapter 12 P/E ratios, market timing, and the Fed model.
While Warren Buffett is usually considered the world's greatest
Value investor, he has repeatedly stated that simple indicators, such as P/E ratios, P/book ratios, and so on, are completely useless. Despite this, fund managers, investors, and the media have repeatedly hopped on the price, earnings, P/E bandwagon when making macro
predictions about the direction of the markets. For instance, a recent book
about investing has asserted that the U.S. markets are in a bubble because the trailing 12-month ratio of the S&P 500 is 25. Analysts and pundits have also pointed to the 1974 and 1982 bear market bottoms when the market
P/E ratio was less than 10. Assume that the 50-year average P/E ratio is 15 and that the market
tends to mean revert, as asserted by all the people who claim P/E ratios are too high at any given point. I did the following experiment in order to test if Buffett's claim that P/E ratios are meaningless is true. Since 1900, this simulation uses the S&P 500 Total Return Index, the
index plus dividends, and uses P/E data compiled by Global Financial Data to buy the S&P 500 whenever the P/E ratio is lower than 10 and to sell
when it is higher than 20. See Exhibit 12.1. P/E ratios are in the top pane and the S&P 500 Total Return Index is in the bottom pane. The 5 trades that occurred were all successful, as shown in
Exhibit 12.2. And it is interesting to note that the system caught most of the bull
move of the 1920s, the 1950s, and bought at the bottom in the 1970s. However, this method underperformed the method of simply buying on January 1, 1900, and holding until now by a factor of 6,000. Changing the parameters didn't result in anything better. I tried making the higher parameter 25, 30, and 35. I changed the lower parameter to 15. At the risk of curve fitting, I tried stepping through the parameters in an attempt to optimize the result. Nothing beat the buy and hold method.
Nor did shorting help. In the above example, if you had shorted rather than sold the market every time P/E ratios hit higher than 20, the result would
have been 5 unsuccessful short trades. Does this mean buy and hold is the best strategy? Absolutely not. For one thing, there were several periods of longer than 10 years, the most recent
being from 1964 to 1981, where the market was completely flat and almost
any other investment would have been better. But it does mean that P/E is mostly useless when not taking into account any other aspect of the market. Buffett has said that he is not a market timer. For instance, in his 1992 letter to shareholders, he wrote, "We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children." And yet, as excellent Buffett-esque investor Whitney Tilson one has pointed
out, Buffett has made market calls no less than 6 times.
Market call number 1 in 1969. Buffett retired from the hedge fund business and returned his investors' money with the statement, "I just don't see anything available that gives any reasonable hope of delivering such a good year, and I have no desire to grope around, hoping
to get lucky with other people's money. I am not attuned to this. P/E ratios, market timing, and the Fed Model 193.
Market call number 11. Buffett's Prescient Market Calls. Whitney Tilson, 1999. Motley Fool website. www.fool.com. Market environment. And I don't want to spoil a decent record by trying
to play a game I don't understand just so I can go out a hero.
Over the next 6 years the market returned minus 11.8%, topping off a huge bull market run that essentially ended in the late 1960s. Although his market call was dead on and he left the hedge fund boozy ness at this time, I do think his bearishness was more excuse than reason
for his decision. He was already the controlling shareholder of Berkshire
Hathaway, and he had already decided that the economics of insurance were much better than the economics of running a hedge fund. In a hedge fund you only get 20% of the profits, in insurance.
Assuming the cost of float is kept to a minimum, and to his great credit, Buffett over the past 40 years has been particularly good at this. The owners of an insurance company get to keep 100% of the investing professor. It's by 1970, rather than having to split the profits with the limited partners. In his hedge fund, Buffett was now the majority shareholder. Only 1% of the profits of Berkshire Hathaway in 1970 came from textiles, the rest was from insurance, banking, and investments. Market call number 2. In 1974, Buffett made his famous quote to Forbes, "I feel like an oversexed man in a harem," when referring to all of the buying opportunities out there. 1975 was one of the biggest bull market moves ever, with the S&P going up over 70% over the next 2 years. Market call number 3. Tilson reminds us of Buffett's quote in the August 6, 1979, issue of Forbes, where he states, "Stocks now sell at levels that should produce long-term returns far superior to bonds. Yet pension managers, usually encouraged by corporate sponsors they must necessarily please, are pouring funds in record proportions into bonds. Meanwhile, orders for stocks are being placed with an eyedropper. Can better results be obtained over, say, 20 years from a group of 91.2% bonds of leading American companies maturing in 1999 than from a group of Dow-type equities purchased, in aggregate, at around book value and likely to earn, in aggregate, around 13% on that book value? How can bonds at only 91/2% be a better buy?" In typical self-deprecating fashion, Buffett referred to this market call in a July 2001 speech when he said, "Now, if you had read that article in 1979, you would have suffered." Oh, how you would have suffered. For about 3 years, I was no good then at forecasting the near-term movements of stock prices. And I'm no good now. I never have the faintest idea what the stock market is going to do in the next 6 months, or the next year, or the market call number 4. Tilson quotes Buffett from the 1986 annual meeting. "I still can't find any bargains in today's market. We don't currently own any equities to speak of, except for the core holdings of Geico, the Washington Post Company, and Capital Cities, ABC." Although he more or less cruised past the crash of 1987 because of this prescience, it was during this period that he figured he could weather a more than 10% correction by making pseudo-equity investments in the form of convertible preferreds. He did this with Salomon, Gillette, and Champion,
where in each case he was able to get a preferred stake in each company, paying between 9 and 10% yields and convertible into equity should the stocks rise. Happily, they all did, at different points over the next decade. See more on this in Chapter 7. Market Call Number 5. Tilson reports that in the 1992 annual report Buffett writes, "Charlie Munger, Berkshire's vice chairman and my partner, and I are virtually certain that the return over the next decade from an investment in the S&P index will be far less than that of the past decade. Making this prediction goes somewhat against our grain. We've long felt that the only value of stock forecasters is to make fortune tellers look good. Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children. However, it is clear that stocks cannot forever overperform their underlying bourse-nesses, as they have so dramatically done for some time, and that fact makes us quite confident of our forecast that the rewards from investing in stocks over the next decade will be significantly smaller than they were in the last." Tilson prophetically concludes this market call with the statement, "The next 3 years will have to be pretty grim to validate Buffett's prediction." His article was written in 1999, and up to that point, the decade full Lowing Buffett's 1992 call was outperforming the prior 10 years. However, the next 3 years did turn out to be pretty grim, and with this prediction Buffett was also correct. From December 1992 to December 2002, the S&P 500 was up a sliver below 100%. From December 1982 to December 1992, the S&P 500 was up 210%. Market Call Number 6. In the November 22, 1999 issue of Fortune, Buffett predicted that the stocks were about to fall dramatically when he wrote that the Dow was at 11,194 and 2 years later it was at 9,900. Market Call Number 7. Buffett wasn't through yet, and the December 2001 issue of Fortune reprinted a speech he had given at the July 2001 Allen and Company's Sun Valley Conference. In it he stated his reasons for being somewhat bearish on the market for the next 17 years and reaffirmed his belief that over the next decade we can expect to see 7% annual returns. So you can't really have it both ways. Buffett might not make specific investing decisions based on market timing. For instance, there is no evidence he uses puts or any hedging techniques to hedge his portfolio when
he thinks the market is going down. However, he does make macro-level
portfolio decisions or even huge personal life decisions. His decision in 1969 to close his fund, based on his feelings about the market. One can argue that this is not the case. When the market is frothy, it is evident in his portfolio from a bottoms-up approach. That is, his investing for those years is scarce simply because there are fewer opportunities. However, diving into his July 2001 speech, as reprinted by Fortune, it is evident that Buffett does at least develop macro-level explanations for why there might be a dearth of investment prospects. Specifically, he notes first that the stock market is not necessarily related to growth in the economy. For example, from 1964 to 1981, when
the market gained 0.1% over a 17-year period, he noted that the gain in gross national product (GNP) during the time was
373% as opposed to only 177% from 1981 to 1998 when the market went up over 9,000%, to quote Buffett. So what was the explanation? I concluded that the market's contrast ing moves were caused by extraordinary changes in two critical economic variables and by a related psychological force that eventually came into play. Here I need to remind you about the definition of investing, which, though simple, is often forgotten. Investing is laying out money today to receive more money tomorrow. That gets to
the first of the economic variables that affected stock prices in the two periods: interest rates. In economics, interest rates act as gravity.
Behaves in the physical world. At all times, in all markets, in all parts of the world. The tiniest change in rates changes the value of every financial asset. He notes further that from 1964 to 1981, interest rates on long-term
government bonds went from 4.2 to 13.65%, and from 1981 they went from 13.65 to 5.09%. Putting this further to the test, let's look at long-term government
bonds and P.S. dating back to 1900 and buy the market whenever 1 P.E. the earnings yield is greater than bonds. In other words, an investment in
the average company yields a greater dollar amount than a similar passive
investment in a bond. There are modifications we will make to this initial assumption, but first let's test out the basic so-called Fed model. Before examining the numbers in detail, let's take a closer look at the Fed model in Exhibit 12.3. In Exhibit 12.3, the S&P 500 monthly chart from 1900 to 2004 is represented in the bottom pane. The top pane is the earnings yield of the S&P 500, represented by the thick black line. The thin gray line is the yield of the 10-year government bond. The horizontal axis is the timeline from 1900 to
2004. The question an investor has at any given point is, will investing in
companies yield me more money than I can safely get in government bonds? If a government bond is yielding 10%, for example, and that's money I can put in my pocket safely, and the average company is only earning me 5% on my money, then there's no need to invest in stocks.
This is an extreme example, but it expresses the point. As we can see in the graphic, the question did not really come into play.
For the first 7 decades of the 20th century, there was a slight flirtation with it in the late 1920s, however, which erupted into the Great Depression. And then earnings yields were higher by a fairly wide margin
until the late 1960s. And why were these yields higher by such a wide margin? People
assumed that since bonds were so safe and a company's earnings were so volatile and unpredictable, the only way to get the prescribed margin of safety would be if earnings were significantly higher than what could be achieved by the appropriate risk-free bond. However, Buffett's point,
repeating a point made in the 1920s by Keynes when analyzing Edgar
Lawrence Smith's book Common Stocks as Long-Term Investments, is that companies retain their earnings. Then they reinvest the capital so they could then return even more. In other words, their earnings compound, as opposed to a government bond, which only returns a fixed coupon. It is this
point that makes stocks a more attractive investment than bonds, even
when the earnings yield is lower than the government bond yield. However, when the earnings yield first breached the 10-year yield in 1969, the vertical line in the graph, this flashed a warning sign to Buffett, who promptly shut down his hedge fund and decided to watch the action.
When the earnings yield was significantly higher than the 10-year yield. The second vertical line in Exhibit 12.4, Buffett got his buy signal, and made his oversexed in a harem comment. After another brief dip and subsequent lift in the earnings yield representing the 1980-82 bear market, the earnings yield went more or less permanently under the 10-year yield. At any point, a traditional value investor using the Fed model could have argued that the market was overvalued. And many investors did, in fact, argue that. But other than brief pauses, the market was basically a skyrocket until early 2000. It is this regime shift that occurred around 1982 that makes the traditional Fed model difficult to use as a forecasting method for stock prices. However, just because there is a regime shift does not necessarily mean there is no longer any relationship between bonds and earnings. From 1982 on, it is more important to look at the relative relationship between the two. In other words, if bond yields move quickly relative to earnings or vice versa, then the market is most likely being either irrationally pessimistic with regard to the earnings potential of stocks or irrationally optimistic. To prove my theory, I plotted the earnings yield, trailing 12-month core earnings of the S&P 500 back to 1982, and did the same for the 10-year.
Note. Then I divided the bond yield by the earnings yield and bought the stock market whenever the ratio hit 1.5 standard deviations below its 10-day moving average. Given that the yields are correlated, I'm simply buying the market when bond yields tank faster than earnings yields, or when
earnings yields go up faster than bond yields, regardless of whether one is
above the other. I'm then selling the market when the ratio gets back to its 10-day moving average. To summarize the results shown in Exhibit 12.5, 14 trades were made, 10 of which were profitable, giving the system a 71% success rate.
The average gain per trade was 11%. The overall point, it seems, is that relative difference is of more interest
than static difference between the yields, contrary to what the Fed model suggests. Basically, it is clear that purely looking at P/S or purely looking at the Fed model, which dates back to 1900, doesn't do us any good, but it is also clear that through the years Warren Buffett has made some very prescient
calls timing the market, and his justification for these calls was some derivative
of the Fed model, the public's expectation of earnings growth and the compounded value of that earnings growth might change over time, as well as the market's feelings about earnings versus bond yields. However, any
sudden movement, and by sudden, I mean over the course of months or even years, could result in one of Buffett's famous signals. The key is not
simply waiting for a P/E of 5 or interest rates less than 2%, but to aggressively act when the spread, in whatever direction, becomes irrational. Chapter 13, Buffett and disasters. At the time of this writing, halfway into 2004, the Nasdaq and Dow are down on the year and the S&P is slightly positive. Volume is increasingly petering out and the daily ranges are hitting new record lows. One of the reasons given for this lack of exuberance is the threat of terrorism. If terrorists strike again on American soil, nobody wants to be left holding the bag. Although the United States has been spared a second major
attack until now, with so much bloodshed having gone on in places such as
Spain and Russia, the idea that Al-Qaeda might still be able to launch a major attack is seen as an overhang on global markets. After September 11, 2001, when the markets shut down for almost a week, nobody had any idea what would happen to the U.S. markets when they opened. Many wondered if they would even be able to open. To Dick Grosso's credit, he was able to organize the reopening of the New York Stock Exchange and instill confidence back into the U.S. markets that business would continue as usual. However, even with the reopening of the markets, to say people were nervous about the future prices of their stock portfolios would be a severe understatement. It was into this void of confidence that Warren Buffett went on television
and said, "If you were a holder of stocks and a believer in the long-term
growth of the U.S. economy on September 10, then you should be a believer." On September 12, the idea is this: we have seen this before. The United States had not experienced the specific psychological and financial damage
caused by September 11, but the nation has nevertheless undergone shocks to the system that we have survived, and will continue to survive, thanks to
gradual increases in the overall stability of the system. With the help of my colleague Omid Malekin, I took a look at 10 potentially systemic shocks that have occurred over the past 70 years.
In each case, we looked at where the S&P 500 was the day before the shock, the day after, the panic low during the ensuing week, and then
where the market was 1 week later, 1 month later, and 6 months later. A summary table of the results appears in Exhibit 13.11 at the end of this chapter. The invasion of Poland, September 1, 1939.
The market barely blinked at the invasion, reaching its panic low a few
days after the event and then not looking back for almost the next year. See Exhibit 13.1. Several possible explanations for this are: some sort of crisis event with Germany was certainly expected and built into the market. Perhaps the United States felt that the situation with Germany would be somewhat contained with the countries immediately surrounding it.
After a 10-year depression, there might have been an expectation that war in Europe, for which we would be supplying the arsenal, would be a boost to the economy. The bombing of Pearl Harbor,
December 7, 1941. Perhaps the worst event in the United States history up until the 9/11 attacks. The bombing of Pearl Harbor brought the threat of an attack on American soil to life. The market took several years to recover, although again a buy during
the dip strategy would have worked well. See Exhibit 13.2.
The North Korean invasion of South Korea, June 25, 1950. This was the first real clash with the post-World War II Soviet Empire that spread into the global Cold War. The market fell from $19.14 to $18.11 the day after, reaching a low of $17.27 a month later until rallying up to $21.03 6 months later. See Exhibit 13.3, Kennedy's announcement of nuclear missiles in Cuba, October 22, 1962. The idea that nuclear weapons were being aimed at the American shores from just 90 miles away was enough to send the market down several percentage points. See Exhibit 13.4. What is most interesting is the ferocity
with which the market rallied in only a few months. The Cuban Missile
crisis did not begin and end the threat in 1 week. The threat, emboldened by a policy of mad, mutual assured destruction, continued for the next 30 years and is still not an issue that the world can ignore, and yet, the market
more or less determined that if a nuclear war resulted, there would be bigger
problems than the stock market, so the party started in 1962 and continued for the next 7 years, resulting in the biggest bull market in history until the 1990s came along. The Kennedy assassination. November 22, 1963. Everybody who was alive then has an "I remember that moment" story about when Kennedy was assassinated. The impact struck the United States to the core. Our young, youthful president who had stood up to the Soviets and made them back off, was dead. It was inconceivable, and the market reacted appropriately that day, closing almost 3% down from its prior day
close. But the bull market that had begun under Kennedy's reign had another
6 years to go, and a week later the market was higher than it had been on November 21. 6 months later it had gone from a low of $69.48 on the day of the assassination to $80.73. See Exhibit 13.5, Oil Embargo, October 17, 1973.
While a host of events served as a prelude to October 19, 1973, the actual
announcement by OPEC that it was raising oil prices almost 70% sent the market into a swoon unrivaled until 1987. See Exhibit 13.6. The market quickly fell to its panic low 3% lower, and then 17% lower
6 months later. However, it is interesting that 1 week after the embargo,
the S&P 500 was actually 2% higher than it had been the day before the embargo. One shock was not enough to bury the market, however. At the time there was a series of negative events, including